They tell you the war is over there. They tell you the economy is just a series of disconnected numbers on a ticker. But if you look at the real-time supply chain, the sovereign-backed infrastructure, and the massive capital shifts happening under the surface, you know the truth. We are in the middle of a silent, high-stake war for the future of the Main Street economy. And the map just changed again. With the explicit demand that all nations sign the Abraham Accords as a non-negotiable anchor for any regional peace deal, we aren't just looking at diplomatic maneuvering. We're looking at the forced integration of global supply chains. This is a new sovereign floor being laid out in real time. I've been documenting this shift for months. What you're about to witness is not a standard market recap. It's the live documented audit of the more economy, the new operational architecture that is being built and dismantled right in front of our eyes. We pulled some of the most critical archives from our live sessions that you haven't seen. We're gonna put them together, and it's gonna last about 3 hours. So sit back and dive in. So everything you see in these archives is tied to a single proprietary lens, a new framework, the MORE, M-M-M-O-R-E framework, simply pronounced MORE, the MORE economy. We aren't watching this economy that we managed to see before. This is a framework for it. So massive capital outflows, massive capital flows, tracking the largest institutional and sovereign money management, macro realignment. The Abraham Accords could be something that ties right into that if we have more people sign onto it. Momentum, we see a lot of momentum with the AI movement right now. Operations, this ties more into this individual stocks. Realignment, we're seeing a whole lot of realignment across different industries in different areas right now, especially inside stocks and their earnings, which is driving the stock market right now. We see earnings pushing the stock market forward. So this is a framework that many people haven't even thought of. It's actually one I coined, the MORE framework. So I did a long dive video on that, like almost 2 hours on the MORE framework, if you want to take a look at that. But just think about that when you're looking at all this. This wasn't even coined then, and how it actually plays out today. So once again, the MORE economy, because this plays into where we're at, where we're going to, and what we're watching. So sit here, take a second. The MORE economy that we're in right now, the MORE framework. And let's get right into the archives. Thanks for tuning in. Let's get to it. Sit back and get ready to dive in. Welcome to this live broadcast with Marcus Sturtevant Sr. and Mr. Stephen Davenport. The global economy is currently staring down at one of the most significant energy and supply chain bottlenecks in recent history. So we look at the 2026 blockade of the Strait of Hormuz. The question is about geopolitics. It's about the economic clock of war. How these disruptions ripple through everything from global inflation to your personal portfolio. Joining me today to decode these institutional shifts is a returning favorite and leading voice in market strategy, Stephen Davenport. Today, we're asking the tough questions. Is the Strait straight? We'll be breaking down the energy crisis, why this blockade is unique and how it could trigger global inflation, the domino effect, our supply chains, disruptions and dispute now, fertilizer, food, and other areas. And then institutional strategy, what the smart money is doing in navigating the risk of private credit and institutional portfolios. Stephen, it's great to have you back. Let's dive right into the mechanics of this crisis.
It's great to be back. I think that when I think about what's happened in the last 2 or 3 weeks, I think it's gone much further than I ever expected it to go. I think that for the U.S. to now be trying to squeeze Iran with their own blockade of Iranian assets and Iranian funds is just taking the enemy's ideas and making them your own. I feel that there's a lot to learn from how you can conduct war without having to really get your troops on the ground. I think that's the main thing that I would say the last 2 weeks have taught us, is that you can enact pain on your opponent just by trying to touch their economic and other assets. So I think that what's happening is just a progression in terms of the type of wars we used to wage and the type of wars we wage now. I think that the banking system, the financial system, the relationships between countries who demand or need the oil, I think the biggest thing that keeps Iran the way it is and has not pushed it further is China is the number one client. And so China being the number one client for Iran's oil, I think they would have something to say and something to do if we were to destroy Targ or do anything to really hurt the infrastructure of the country, because China and Iran have a pretty strong relationship, and China can't find that oil in the same quality, in the same way other places. So I think that they need Iran, and they need Iran to stay active. So I think that overall we know there's going to be something going on here, and it's going to have to involve China. So I believe that the meetings that Trump's going to have with Xi in the next month, he would like to be in a position where Xi could help Trump with moving the Iran closer to a final peace deal. So I think it comes down to the main powers again of the world, in the U.S. and China, and it feels a little bit strange because Iran and the Middle East oil, the U.S. has become energy independent. It really doesn't need to be involved in this, but it finds itself as an ally of Israel, stuck right in the middle.
Gotcha. Yeah, that's a broad take, but not quite as broad. A little concentrated in there. Perhaps you just spoke about how we're in different type of warfare now than what people are used to seeing. The economic impacts are definitely something that we're seeing. Just going, I know back when this war started, I was looking at some data and it was saying how, 6 weeks to 8 weeks after the first shots are fired, stock market's usually higher. The stock market is higher now, even after the pullback today. But historically, that's how it happens. But now let's think about the clock of war, the timetable that we've gotten out here into this 8th week. What do you see some of the lingering effects being if this war is to drag on?
Well, I think that, it takes time for all of these subsidiary uses of oil and natural gas to go through the system. So people had an inventory that they were working through, and now that inventory isn't being replaced. So I think we're going to start to see a greater impact in inflation, a greater impact on some of these companies not being able to deliver any of the products like fertilizer and helium and other byproducts of energy. So I think that we're going to start to see people. I think that the market has looked past a lot, and they've looked past it because they said this will be a short and quick event, and therefore it will cause a spike, but that spike will dissipate quickly once we get the resources back online. Well, we're not getting them back online, and I'm not sure how quickly we are going to see them back online. So I think that the two things that I'd emphasize are, one, Republicans in Congress really need this to be over so they can focus on the midterms and potentially focus on the issue that everybody wants to talk about, which is affordability. Affordability hasn't been addressed, and I think it will be a problem unless we get this over quickly. And the second part of this is, how many of our allies have we burned bridges with? And that'll cost us long term in terms of how we want to operate together against, the axis of evil, as we used to call it, China, Russia, Iran. You might include Nigeria in there. I think that there are countries out there that we look at and we say, we can't imagine how they could be influencing our economy, but they are. And I think that when you look at Iran, I'm sure that, we all appreciate what it means for energy markets, but I'm not sure it should be affecting the U.S. as much as it is. So in my mind, we have to decide, are we really going to let these countries get away with changing the rules and how they operate, Or are we going to try to operate as we have with NATO allies in Canada and Mexico, as we've done for 100+ years?
Gotcha. Yeah. I mean, I don't know if the other countries are changing the rules, right? Are they kind of just adapting to what we've done as we've come in and kind of like increased the American exceptionalism trade that we have going on? I don't know. I don't know if they're just adjusting more. But yeah, come November, it will be interesting. I heard today where the Republicans were looking to push a skinny reconciliation bill through, but it doesn't include a lot of things that they have. So they have a lot of problems going on within their party, as do the Democrats. They have a lot of stuff going on. So our political environment is definitely a thing that plays into this whole axis thing that you were talking about, right? Other countries joining together, they see that maybe America can't even get together within our own borders. As far as being energy dependent, yeah, I think we are like continentally energy dependent. I don't know if America's quite energy dependent. I guess if you take in the Venezuelan oil and, I don't know whose oil that is over in the Strait of Hormuz, but, we do have oil. Can China come buy oil from us? I know, and let's dig a little bit deeper. You mentioned people don't realize the global impact of these things. Generally, they just think about the debt that China and USA have, but what are other ways that this impacts people? Main Street.
I mean, I think when you look at the chip fab and the whole chip industry, I believe that what you've seen here in the Strait of Hormuz, I saw a recent commenter say the next strait that will be an issue is the Strait of Taiwan, and 80 to 90% of certain nanometer chips are going through the Strait of Taiwan. So when you think about Taiwan Semi, United Micro, and some of the capabilities that are in Taiwan, and Taiwan is still battling with China over this idea of whether it's a sub-state or whether it's an independent country. I think that one issue, when you think about the demand for AI chips, and if a country like China were to implement some type of a blockade, I mean, I think they were thinking about blockades, but I don't think they were thinking quite the way the blockade is unfurled at the Strait of Hormuz. And I think that type of action, not involving any troops on the ground, simply, putting your fleet and putting your air forces along to prevent chip fabrication, which environmentally and otherwise, I mean, chips are a huge source of value add. So when you think about disrupting oil, which is a commodity, you can do some substitution of other commodities of nat gas and other things for that capability of oil. You can't substitute a 5 nano for a 3 nano. The chips manufacturer and the chips technology is so critical to these server farms and AI technology that I think the disruption would be significantly more. If we saw a 10% decline because of the Strait of Hormuz, I think we would see a 30% decline if something were to happen in the Strait of Taiwan. So when I look around the world, I look at the way that Russia and the Ukraine have perfected the use of drones. Ukraine has become a force in production, development, and implementation of drones. And now we're seeing them start to help others, like Israel and others, to try to become better at it. And you look at what happens. It's a progression of drones weren't a factor when we had the Iraq war. Now we have Iran, and drones are, 80% of the effort around aggression is around drones. And you just look at that and say, this technology and this ability didn't exist 5-10 years ago. I mean, I remember some people, using drones for photos, but in terms of militarily using drones and being able to control and link up with satellites for precision usage, I think that we're seeing a whole new world. And I guess I'd say by energizing drones and by looking at the way things are falling in these different conflicts, the bad guys or any people who are looking for aggression against their neighbor, we're seeing a lot of maps on how to use them and what to do. And I think that's going to make the likelihood or proclivity for more violence between these countries higher. And I think all of us would like to think, hey, what did we learn from COVID? I guess we learned that we need to be more self-sufficient, and you need to have resources doing many different things in your country, because you never know when that partner or that ally is going to change. And when it changes, so does your opportunity for economic growth and other things. So I guess I'd say, Marcus, my worry is we're becoming better and better at using more and more weapons and more ideas of how to hurt and infiltrate and overcome another country. So I don't think that's necessarily a skill set that I was hoping, you know what I mean, that 2026 would be the year of drones, or the year of economic damage.
Yeah, that's the shift in drone warfare, like you said, Ukraine and Russia, and it's something that we experience over here in the Strait of Hormuz for sure, where you see, I think we mentioned it last time, where you see $1 million missiles getting taken out by $500 drones or something to that effect. I know since the last time we spoke, I saw a company out west that they're now making 3D printed missiles. So to go to the war effort, we've heard the White House brought in defense companies maybe last week and auto manufacturers to tell them they need to increase production for the war efforts, or just for our defense efforts, air quotes for those listening. So you definitely see a move and a shift. And I think Ukraine was helping us with the drone warfare as well, like how to defend against the drone war. So it's just,
Yeah, and I think it's cybercrime also. I mean, I think that there have been some attempts at various cyber activities. And I kind of believe, after CrowdStrike and some of the problems we've seen, our processes and our infrastructure are challenged. I don't think that we are prepared as we should be in some of these areas of cyber, drone warfare, or even what I'd call chemical. Because I think there are chances that if you look at what, we're talking about nuclear materials in Iran, and I don't think that we know where they are in terms of delivering those materials, or how far along they've gotten. So it's, to me, what we're seeing is, when we push people to the wall, we don't know exactly what they'll do to fight back. And so far, I think it's been mostly clean. But I would say that if it got worse, I think it would start to really disturb things. And the last thing I would say is, China has always had a weakness in demand and the need for foreign energy. And I think that in doing so, they've dealt with Iran because they like the idea of buying, oil on these shadow carriers who are not recorded or aren't under the right flags. And that type of activity, they can get a lower price per barrel. They're building up their reserves. I think that just like the U.S. had strategic reserves that were significant, we've had to burn them down and lower them. And so China has been smart in trying to build it up. So I think that all areas, Marcus, are on the table in terms of what's going to happen and how. I think there's been more uncertainty now than there was 2 weeks ago, 6 weeks ago, 8 weeks ago. And I just find that the more we get into this, I think the further and farther and harder it's going to be to get out of it. As we haven't talked about troops on the ground in Iran, but in my mind, there's two major areas that could cause the market to really have a problem. One is troops on the Karg Island, or troops on the ground around the strait, or China ship being either captured or blown up and containing China oil when it's going to China, and it gets not just rerouted but destroyed. I think China would have a bit more of a problem. So to me, that's where this thing could keep going, and I don't like the direction it's going.
Yeah, it seems like the negotiations are very tentative at best, as is this ceasefire, which is very fragile. I mean, shots have been fired from both sides. They're now taking ships from both sides, I think, have been seized. Uh, some have been shot at clearly with missiles or guns, or they've been attacked. Ships in the Strait of Hormuz. And then, like you said, it's just this is we're at about 8 weeks. This thing can stand longer, but the market, like you said, you don't quite understand why the market is not reacting worse. It's like the market has already looked past this. So the market's looked past this, saw the worst case scenario maybe as when Trump said he was going to annihilate a civilization. So maybe that was when, because we saw that was right when it started, that 12, 13 straight day move. Want to shift up. Speaking of cyber defense, first on before we shift, I want to say thanks to everyone who's listening, watching. Hit the like button. Let us know where you're watching from. You want to leave some comments. Me and Mr. Steve would be more than happy to answer them, whether it's now or even later after the stream. But let's jump back into, so this, you mentioned cyber defense inside of this, and that ties into software and the SaaS sell-off that we just saw. Today we saw ServiceNow get destroyed. The IGV actually has been on that. So that's a software ETF for those who don't know. And we're not making any recommendations again, but it's been moving up. But today it was down for one of its worst days in years, and semiconductors continue to grow. Where do you see the AI trade, semi softwares, and the cyber defense? Because the IGV has a heavy concentration with CrowdStrike and Palo Alto.
I mean, I think this is going to cause companies to realize even more that they need stronger defenses. I think that we're going to see some more disruptions, and I think those disruptions are going to, emphasize to people that the enemy is getting stronger, not weaker. And I think that when we look at these countries trying to cooperate together, we've got to know that Russia and China are probably supplying data to Iran in terms of the location of troops and materials for Israel and the U.S. And I think that if we think those, satellites for those countries aren't working for Iran, I think that we're probably kidding ourselves. And I think that when we also think about if China's cyber were to be put for Iran's benefit, I think that would have a significant impact. Russia has a huge cyber force, and I think they would have a bigger impact in this war, but they've tried to stay somewhat neutral. And I think that by providing data, they're already over the line, and I think it's just a question of how far over the line they go. I believe that, the battles are going to be fought in the Bitcoin space, and how do you control that, and how do you manage that, and how do terrorists and other people use it to benefit their forces and to you. If we were to see more cyber attacks, I think they would probably, be focused on the areas of the U.S. defense system and the U.S. economy, in which case I think that we have a very large area to guard, because of our dominance in a lot of different spaces, whether it's bonds or equities or commodities. I think there is a pretty large infrastructure here that is going to be very hard to defend when we look at these countries who are now Iran's ability. That's one thing. It's a $92 million person country. But once you get Russia more involved, once you get China involved, you suddenly are really looking at resources that could significantly impact not just the battlefield, but the economy, the economic fields.
Yeah, I mean, I think Russia's probably the leader in cyber attacks. They've been, since 2016, people can talk about Russia and cyber and those type of things. And then they're a large country, but I'm not sure how large their population is. They might compare to Iran. So Iran and Russia, they're definitely all intertwined for sure when it comes to those things. I mean, they were given information. But if you're Russia and you have the Russia-Ukraine conflict, the U.S. has done the same thing, right? These are wars by proxy, right? Everything's a proxy war. inside of this?
I think the question is for Russia is, do they have a bigger plan?
Of course.
Do they have a plan for, Poland is next? I think that that's what NATO is really worried about. I think that they've seen the war has pretty much come to a standstill between Russia and the Ukraine. There's certain areas of the countryside that make it very hard for other areas to get taken. And those defensive postures and those positionings, we know what Putin wants. Putin wants access to Crimea. He wants to keep that shipping location, and he wants to have an access via land to that. I think that Crimea has been gone now since 2016. I'm not sure this battle was at all about Crimea as much as it was about making it a permanent link to the Russia. And I guess I'd comment about Russia in terms of the population not being as large. I would say in terms of militaristic economies, their economy is pretty well developed in the military and the sciences, such that I think they represent maybe a country that definitely, what do you call it? It definitely fights at a weight much higher than it's scheduled, right? It's a much
Punches above
tougher
its weight.
fighter, punching above its weight. Yeah. So I think that overall, we don't have, I don't think we have the desire to be involved in some of these circumstances much longer. So in terms of the population of the U.S. and how much longer we want to be spending this money on the, international wars, I don't think they're going to really, with our debt levels and the amount of money we're paying for interest now, I think there's a serious problem with inflation that would really make and disrupt our ability if we keep spending the money the way we're spending it. I'm hearing that we're getting low on supplies of munitions and that we need to call a ceasefire because we need more time to build back up our resources. So,
Extended cease. Go ahead. I'm sorry.
No, that's it.
Gotcha. Yeah, I was going to say extend the ceasefire. We're in the ceasefire, I think. Yeah, very salient points. And so, obviously wanted to share some value to people. We just sat here and talked about the war and how cyber security should be a priority with everything coming. We didn't even talk about the AI aspect of it yet, because AI is just a whole other thing why you probably need cybersecurity. But like I said, we've seen even and once again, not investment advice or recommend any fund, but the BUG, the bug fund, ETF that tracks cybersecurity, that one's had a rough time as well. How would you tell investors from your chartered financial analysis mind, how would you tell investors what moves they should make right now? Because it seems like you should just invest part of what you have in cybersecurity, right?
I think everyone needs to have at least one exposure to cyber. I think you need to have either an ETF or an individual name with one of the leaders like CrowdStrike. So I think that overall, it's just another type of software that every company and every individual really is going to need. So I think that we should take this downturn in software in this space and say, this is an opportunity. I look at the race now with semiconductors again, and I'm kind of wondering if they're being bought up because people think I don't know. I wish and I hope that we're not going to see a replication of what's happening in Hormuz over in Taiwan and Taipei. I think that if there was, I think it would be much more damaging to the global economy, and it would also be much faster because the needs for those chips and those company earnings and everyone's growth forecasts for the next 3 to 5 years are all dependent on semis and nano semis. So I think it's one area where the security of Taiwan is really the security of the U.S. technology sector. And I think that right now, Taiwan is in a dangerous position because I think Xi would like to take the distraction of what's happening in the Ukraine and the Middle East and say, I'll just exert a little more influence back home because the U.S. is down one carrier. It's harder now for them to actually support. And one of the mentions was we don't have enough missiles to defend Taiwan now that we've used down our inventory over in the Middle East. So I think that the whole idea of our fleets in our system was we could conduct a multi-ocean war, an effort. We could have an effort going on in the Pacific and an effort going on in the Atlantic or in the Mediterranean. I think what we're seeing now is it's a lot harder to execute, especially when one of those resources, I think they talked about it being a fire in the laundry room, but I think it was actually, Iranian forces that caused it to run out and have to evacuate and get out of the strait. So I look at things and say, we've had some successes with our weapons and our technology, but no war is perfect and no war delivers everything that everybody wants to it. So I think that what we're seeing now is really just a period of thought and reconsideration during the ceasefire, because I think that people have to evaluate how long can you keep fighting and how do you want to keep fighting? Do you want to keep fighting an aerial war? Do you want to keep fighting a war of missiles and cruise missiles? Or do you want to start to progress to a land war? I think the last one is the last thing that we want. I think that overall, Americans polling and everywhere were really against the idea of this leading to ground troops putting at risk. I don't know. What do you think of what do you think ground troops would mean for the markets, Marcus?
Okay, so I think we already had ground troops in there when we went and got the pilots out, and that, the markets were happy that we got our pilot back. But if it was like in there for more than kinetic purposes, we're in there fighting, because I think we'll probably have to put boots in there to get the uranium out, the enriched uranium. I just don't see them just giving it to us. Like, even if they do, we'll probably have to escort the inspectors through there, right, to get the stuff out. And that's going to be some visual effect, for the people in Iran, because who knows what they've been told over there, right? So if they see some American troops come through there, what's been sold. So that could just definitely make it hotter, even if we're in Iran in a quote unquote, air quotes, y'all, peaceful situation, right? So I do think if this escalates, if this stays as it is, and trust me, it's bad, but if it just stays and extends, it'll eventually, in theory, you kind of play out like Russia-Ukraine, right? You remember how intense Russia-Ukraine was when it first started? It was on the news every morning. They were talking about Russia-Ukraine, and markets went crazy for a little while. They dipped, they came back up, and it just kind of adjusted to it and went back to earnings, right? Which is maybe why we're seeing these markets move the way they're moving now, because earnings have been really strong in spite of this war, in spite of private credit, in spite of AI, maybe because of AI, I don't know, but earnings have been extremely strong. So maybe we should just shift to what do you think of the market? But to answer your question, because I didn't answer, if we have boots on the ground, like unexpectedly, because you got to let the message be signal, right? But if there's something just happens and we get a news flash that American troops were in there fighting and or engaged in a battle that the American people didn't know about, stock market's going to crash because oil prices are going to go up. There's been the correlation. I was talking to Jake, and when this first started, he was like, what do you think about the stock market? And the stock market was going up a little bit, but oil prices were also going up. I said, that's not going to work right now. We got to have something that's going to, and this was, a month ago, we got to have that event where the market flushes, even if it's not the deep flush that you usually get. And we have to see the market come up, oil prices go down for a while. So if we saw troops on the ground, those oil prices are going to shoot back up above $120, $150 a barrel. And in turn, I think the consequences would be the stock market would go down. Not one for one, but maybe they'll go down even more and at a much faster pace than we saw at the beginning of this war.
I think the whole verbiage of this being temporary and this being quick and us being out easily has proven to be wrong. So I believe that our understanding of, and it's been a while, we haven't been fighting, actively in different spaces for a while. And you look at us and say, how do you adjust to new technology? How do you adjust to new tools in the battlefield like drones? How do you adjust to cyber blocking? I heard that some of the, what was going on with Iran was it was jamming a lot of the communication devices for anyone who's trying to pass through the strait. So they know what channels they're on, and they would, and you think about that, it seems like a simple thing, but I'm not sure everybody has a clear idea of how narrow it is. It's 21 miles straight, but there's 2 miles in one section that goes in, there's 2 miles in another section that goes out, and there's 2 miles in between. We really only use 30% of the strait to get through. So when you think about controlling that strait, and I saw today there was talk about Iran laying more explosives in the strait, and there were people were shooting at the boats who were dropping off the. I think that Iran is. If we would take the U.S. and Iran and look at ourselves and say, in the mirror, who are we? Iran is a century-old, 1,000-year-old civilization. Their religion and their faith and their things, they've been in place for a while. They don't look at things the way the U.S. does in terms of, I really want to release this before Friday's 5 o'clock news hour. That's not the way Iran operates. Iran controls the media, so they don't react to the media. We react to the media. We are people who are looking for quick solutions and quick ideas. We're not looking for a long-range effort here. This is Israel's fight. They really were the ones who were endangered, and we felt as their ally that we had to support them. Our interest in there is really about Israel. It's not about the U.S. So my question is, do we have the stomach for a longer-term engagement here? I think we're going to get tired, and I think it's going to get very, very dangerous for Republicans in the midterms if they let this go on past June.
June?
I think it has to be over by June, and the meetings with Trump and Xi, I think if it's not, those meetings could go very badly, and then you open up the whole rare earth thing again, and you open up, they're not going to be happy if we keep resources and missiles in Taiwan to protect Taiwan Strait. I think that's going to be their issue. And I think that the Iranians have given everyone an idea of, let's control the strait, the Strait of North Carolina. And, everybody now is looking at these short waterways and thinking, hey, we could control this, and therefore we could cause this much pain to the global economy. And I think it's just the straitjacket of war.
Yeah, it's almost like what you see with the bureaucracy in Washington. You have Tom Tillis, who's, his one vote can stop the whole banking committee with Kevin Warsh. Then I don't know if you recall, for a while there, Joe Manchin, I feel like, was the most powerful man in America, because whatever he did was how whatever legislation was going to go through. And then you also have now, like you said, a little place 2 miles wide, 20-something miles long total. I mean, it's not very wide, but those boats are big, so you can only have so many coming through there. I recall when this first started that you sent me a text and you said, did you buy more energy stocks? You were like, if you bought more energy stocks, I was like, I'm pretty much fully there. How would you, I was already, and with energy stocks, oil stocks, you asked about oil stocks, not energy stocks. I was like, I pretty much have oil stocks already covered. We'll see how it has grown. Those positions have grown. But what did you look at when it was going in there from a,
First of all, the thing I like to do, I believe that Trump would be good for energy stocks when he became president. So I told people, go long energy, whether it's a 1-year put option on, the XL, the
XLE?
sector ETF, yeah,
XLE?
or it's ISO or whatever it is, some of the refiners. I think that when you look at energy, the one thing I'd say to people is try to make it a long-term gain. I really think that whenever we trade, if we don't do long-term trading, meaning a year and a day, we're really taking a huge hit from the tax perspective. And that makes the return requirement of the decision you make has to be even higher. So I would say to people, I think you should stagger in. I think you should stagger up. And I think that you should be always looking to try to get to that year and a day when you're trying to take advantage of one of these market moves. And I think that will there be energy be higher a year from today? I don't think so, but I think it's going to go higher before it goes lower. So I agree with you that I think we're going back above 100. But again, if the scenario is that we do get a resolution by June, I think we might see some violence in the next few weeks. But I think there will be a lot of pressure to get a solution. And that solution will probably mean that oil comes back down because the strait is opened again.
Yeah, hopefully that strait is open within the next few weeks for sure. And like you said, positioning, people are looking at it, they say, okay, gas prices are up, so I'm making a ton of money in these energy stocks right now, but energy is a really small sector in the whole entire stock market anyway. So you'd have to have a lot of energy even to be overweight in energy to really capture a lot of this. With those energy stocks, the big ones, I generally like to think of those more, like utilities. I'm planning for the dividend. That's why I put them in the portfolio a long time ago. People are going to get gas, but these companies usually play a healthy and safe dividend that they can cover. And then they buy back into their company. So they do all types of things that are just increasing their shareholder value. But like you said, Mr. Steven, they're not going to appreciate at the same rate. Even if they go down from this point next year, you probably will still get in real return once you count in the dividend, something close to whatever this market is going to do,
Yeah.
Have you noticed the shift with the energy stocks now? It kind of was like metals earlier this year, how it's kind of getting memeish.
Yeah. I think the energy space is always a good source for dividends. So I like the energy space because I think that there's a lot of investors that realize it's a cyclical sector. It's not going to have continued growth and stability. It's going to go up significantly, come back down, and then it's going to go in cycles. And I don't like cycles. I like consistency, but I do love yields in the 3 to 5% level. Just as an aside, because I like to be in a live environment, they just announced that they arrested a soldier for a $400,000 bet on the capture of Maduro on
Wow.
Polymarket.
Say that again.
So-
So people listening. Wow.
So what we talked about earlier in this podcast was the idea of corruption, and to find that within the half an hour, there's an announcement of an arrest for a soldier who was involved in the Maduro planning, and he made a bet on Polymarket. Something about $400,000. I don't know if that's how much he made with a small bet, or that's how much he put, and it had a larger influence. But my point is that these markets, especially Polymarket, are really pretty new. And I don't think we really understand what controls are in place and what should be in place and how much I mean, the blurring of the line between what's investing and what's just outright guessing is, speculation is really becoming very, very hard for anybody to figure out. What do you think of the difference between futures markets and all-in markets?
Got you. Well, you can invest in future markets, right? You can, but you can only trade poly markets. They come out and tell you that they're trading. Poly markets are very interesting. Like I said, maybe that was Samuel I was talking with from Business Insider. We were doing that. I was telling like I've never actually played the poly markets. I've seen poly markets. I see how they work. I see that poly markets are pretty good at predicting things that are happening. But when you mention something like a soldier making 400K off of an event, that could shift the poly market, and they're already knowing the events that are going to happen, So how much is causation? How much is correlation inside of poly markets? I think a bigger thing with the poly markets is that the mentality it's going to create, I think it'll cause people to gamble way too much. You know what I mean?
Right.
Like, how are you going? Because you can bet on literally anything. I know the government said they're working on things to regulate poly markets more. They what contract did they have that they took off? It was about someone being assassinated, or
Khomeini?
maybe it was someone from Iran. Yeah, it was the Ayatollah. They were talking about when they were going to get assassinated or taken out, and like one of the Kalshi or poly markets, one of them came on, was like, well, we can't have those kind of bets. Another thing with those is, so like we just saw an example of, I saw someone speaking like, what if you're at a live event, or someone who plays on the game, and you're like not even a first derivative of this person. and you somehow find, you just happen to come to their house before the game with your cousin or your friend. They all know each other, and you see like they're wearing red shoes that night, and there's a bet on that. You know what I mean? Like how do you even punish that person?
I don't know. I think that, the first free throw, is it going to miss? Like the first, like some of these things, I really wonder, like is it a skill? I guess that's my point. Is there a skill in determining a winner? Do you believe there's a skill in determining the winners in markets?
I believe there are definitely signals that you can look at in determining winners in markets. Sometimes the markets just do things that don't make sense, right? Like sometimes companies go up that I don't know why they're going up. Sometimes company goes down where they just reported great numbers and everything's looking good, even out in the forecast. I would definitely rather invest in stocks, equities, trades, things like that, where I can see everything, see in the backside versus playing the poly market. And the poly market is just like I said, it just seems so addictive that being there playing that stuff all the time. So but they definitely point the direction of things that are happening.
I think it was interesting because people were theorizing that there was a lot of activity in oil futures and energy futures and market futures, and that was where the crime was going to be committed. And to see that it happened in poly markets, I don't know if that gives me more confidence in some of the rules and regulations around futures and options, because they are more established and they have clearer rules and they have clearer litigation. I mean, I got to think this is going to be a very interesting case of, how do we prosecute this? How do we show that he wasn't just guessing? Because I look at things and say, you can think there's something that's going to happen, but you don't know that something is going to happen, do you? If there's if you and I sit down and we plan that we're going to paint, a park in Charlotte green, and we put a polymarket event that this park is going to turn green, we could have been involved, but we're not necessarily. As it got closer, we could have just been guessing that those people were going to do this, and therefore, we're making a projection, just like a speculation, just like anyone else, right?
Right. Or even more diabolical is that you would put the poly market bet that the park was going to be green, and then bet that it doesn't get green and paint it like blue. That's how you catch them on the other side. Yeah, poly markets are definitely an interesting foggy thing. Speaking of foggy things and what people may not be able to see through, we hear about the fog in the markets and the private credit fog. I like to think of it maybe now as for those people who may have drank in their time before. I feel like private credit is more like beer goggles. I think that's how people are looking at the world, right? Like
I think it reminds me of the punch bowl. There was an expression that you gotta make sure that you exit before the punch bowl gets pulled from the party. And I think there was a party where people were looking at these items that couldn't be covered by regular debt offerings and bank support. So they were supported by this secondary market. But I look today and everybody says everything is looking more uncertain. JP Morgan's in the process of setting up a new fund for private credit. So if I see the number one bank, and maybe I'm wrong by a few $1 billion in the US in terms of reputation, putting an investment in building an infrastructure around private credit, is it because they see an opportunity and they're going to dominate because of their name and reputation? Is it because there are really a lot of scattered and broken assets that they could pick up cheaply and then put them in their funds and then show great return when they build some more liquidity? I wonder if they see a market opportunity here, and we're missing it by focusing on the failures when we should be focused on who's going to make money from the rebuilding of private credit.
Right. You can private credit, full disclosure. I had a meeting with some of my clients today with a private credit guy. And we were talking about it depends on what you're in, but yeah, JP Morgan and these other banks. JP Morgan's not the only bank that has a private credit fund that's building a private credit fund right now.
They're building a new one, I guess. They're starting a new fund, which you wouldn't do if you think the asset class is going down. You wouldn't necessarily be lining up your clients.
You mean like selling structured notes during the housing
Yeah.
decline, but also on the other side, hedging where you're also betting against the credit default swaps?
Yeah,
And
there's a
issuing both.
lot of ways for them to make money. I agree that they could be doing something that, but I always like to think that, hey, these banks are doing these things because there's an opportunity here. And I'm trying to figure out, you know, why would you put the best reputation in the marketplace at risk over a space like this, where in my mind, it is still a little bit foggy? I mean, do you think it's clearing, or you think we know more about private credit now than we did 6 months ago?
Think everyone probably knows a little bit more about private credit now than they did 6 months ago, just because people probably didn't even know what it was. People who were even invested in it probably didn't even realize how they were invested inside of it. I think private credit is still going to bump some more. It's going to bump. Now, I actually did add some of the alternative asset allocators into one of my portfolios in the mix to Blackstone, BlackRock's. Once again, not investment advice. Blue Owl, one of their funds, even actually pays a higher dividend. So stocks like that are really beaten up. I mean, private credit works for a long time. I'm not going to trade these in the next year, but maybe, 5, 10 years from now, they'll be up. In theory, they should be up and to the right. I think private credit funds, I think what's happened has been good for private credit, actually. Not the people losing money, but the fact that it's been brought to the light more, because private credit was created, back in the BDC, back in the 80s to help Main Street. And then it really expanded after the banking crisis when they put more regulations on the banks. So this is supposed to help Main Street. But as we always see, people find ways to make money maliciously inside anything that the government sets up. Look at some of the people who got those PPP loans back in COVID, like some multi-million, got a whole lot of those. So I think private credit, like I said, maybe it was last time, I think you come on, re-rate those books, tell people what the real par value is, so we can just clear this fog and let investors know what they're investing in. People need to realize that these funds are illiquid or semi-liquid at best. Don't plan on getting your money out within the next 5 years or so. And realize that it's just a diversifier as well, right? It plays a different part inside your portfolio. Don't have everything invested in private credit.
Yeah, I think that we're looking at an asset class that is pretty small in the overall scheme of things. I think they talked about it being 1.5 to 2 trillion. And I know that seems like an enormous number, but when you compare it to the market for securities or the market for fixed income or the market for real estate, you realize how this is, the area of crypto. I think it got up to, when Bitcoin was 120, I think it got up to almost 2 trillion in crypto, but now it's, back down. And I think that when we look at these markets and these spaces, we need to take a global perspective and say, look, in terms of things, in terms of how much I should own, it should be somewhat proportional to the market cap of the whole industry, right? And if we look at that and say that puts it at a 1% position, it puts crypto at a 0.5% position. I think that's the way we should be talking about these things. And I honestly think CNBC and others do a disservice to the investing public, because we spend a lot of time talking about asset classes that 99% of the listeners aren't holders of, right? Is that doing what when they gave you the rights to broadcast, was it so that you could promote an agenda and issues that are, relevant to the average listener, or is it to try to educate and inform the average investor and the average listener? And I just feel like we've gotten carried away a little bit with the discussion of crypto, the discussion of some of these assets, because in reality, most people aren't going to own them. They're not part of the story. What we want the story to be is good companies making good decisions. I think at Intel, hey, he took a situation with Trump where he went to the White House and he was going to get denied access to all these things. He convinced Trump that what you should do is invest in us and not necessarily disparage us. And now you have an earnings blowout tonight. I think what that says is, hey, there's different ways to make money. And if you're making it on Intel's new exposure and operations in Arizona and building up the U.S. capability for our chip sector, that feels a little bit better than some of the activities we saw with triple collateralized items in private credit, right?
Well, I mean, Intel is now, subsidized. They were boosted by the government. They pay the government a percentage of their returns. So Intel is a personal one for me because I've been watching that stock for a long time, just watching it go up and down, in and out of Intel personally. Had some clients there for a while now, but yeah, to see their crazy returns and their blowout quarter, I think they were expecting, analysts were expecting like 1 cent to 7 cent for their returns for their earnings, and they per share, and they had like 29 or 30 cent per share. So they really blew out everyone's expectation. Yeah, right. So that's really crazy. And I think they reinforced their guidance for the rest of the year. We on this call, but it's just like when you see things like that, and the investments that have happened with Intel, it's an effort to onshore. So maybe once we get everything onshore with this chip production, maybe that's when the Strait of Taiwan becomes less. I don't want to say relevant because Taiwan Semi really does make.
I think that's what I mean. Taiwan Semi is included in that Arizona foundry,
Right.
investment. They want, but I've heard that all of the foundries there are having trouble finding labor. They're having trouble finding qualified workers and people who want to work in, a suit environment where you got to have a mat suit on to not have any charge or not do anything to damage the chips. And so I think it's going to take time. I don't think we're going to go away from depending on the Strait of Taiwan anytime soon. But all I'm saying is it really is an area where we could be focused over here and worried about what's going on in Iran. And then, while you're focused over there, your enemies are focused somewhere else. So I think it's going to be a very interesting, June with the visit of Trump to Xi. And Xi has another term, so he's, got some more time. And I think his
She's
ambition
for life,
is,
right?
huh?
She's
Well,
for
he
life,
could
right?
probably, as
They changed
Putin
the
has
law.
found, he's able to get a lot of support for. I think he does 6-year terms, but
Or is that Russia? Someone that is definitely for life now. Like they got elected for life.
but it's really a question of do they want to disrupt and gather all this energy? But if you look at it, could we walk away from Iran right now? I mean, could we just say, hey, we're going to focus our energy on in Asia, in the Pacific, and move those resources? I don't think we could, because I think that Iran would continue to control the strait and they would only let their ships through. And I'm not sure that NATO and some of the other allies are necessarily going to love the fact that the U.S. started this, created this as a hot point, and now walks away to try to solve China. It's
Oh, right. I'm sorry to interrupt you. I was going to say, and then we speak about, so we start off with the investment side of this, like investments, Taiwan Semi's investing into Intel. We have these Middle Eastern countries that, you remember last year, I think it was last year, when the president went over to the Middle East and secured all these investments, like up to $1 trillion, I think he said. How are they going to pay for those now if they're, everything's getting bombed? I don't think they've made all these investments yet. You hear a lot of investments, and then it's like, I'm waiting to see these investments. You hear investments,
Yeah,
wait for these investments.
I
Speaking,
think that we're going to have to wait and see on a lot of things.
right.
And
Speaking on investments and things close to home, we're both down here in Wall Street South, down here in the Charlotte area. I saw again today where they're putting up legislation about building data centers. People don't want data centers built around here. So what's your thoughts on that with the data center and just the investment by that?
look, I think our energy infrastructure is probably not ready for it. So I think we need to really think about whether we make some of these data centers self-sufficient. If you provide your own power, then I think you can have a facility. If you're going to go on our existing grid and be the main draw on that grid, then you're going to have to pay for infrastructure and development of a new grid, because you're going to make that grid less stable. I think that I wonder how small towns, like let's say you passed legislation and said, all right, they have to be energy independent. Okay, who's going to be the regulator that goes onto the facility and makes sure the server is using its nuclear fission properly? Who's going to be the one that tries to make sure that there are no regulators or use of power or use of batteries that is using dangerous materials? I think that we as a country have not really thought through how creating all of these server farms close to all of this important activity around AI is really going to lay out. I think we have ideas, but I don't think that's why I've said, as I've said before, Marcus, I'll say again, I think that we're going to have to solve the problems involved with the auto driving and self-driving. And those things will cause a disruption in our labor market and a disruption in our systems that is going to, be challenging for this country. And I think that when we solve that problem somewhat, we're going to have an idea of all the layoffs and the other things that are going to get caused by AI in the future. And so I think we have to climb mountain one before we address mountain two. I think it's really hard for us to see all of the things we don't know yet because this is all new to us, right?
Right. And you just gave like a real life case of like, you said, if they build these data centers, who's going to check out these centers? That's how technology disrupts some jobs. It destroys some jobs. It innovates some jobs. Maybe the person used to work in there now, someone has a job that does that. How honest they are or whatever with that job, that's up to be seen. I was thinking about AI and the dominance and the technological revolution. And I mentioned on podcast before, a few months ago, I was talking about horses and cars, right? And I said, we still have horses, but we don't have very many horses compared to how many we used to have, right? The price of horses were, so forgive me with these numbers, they were either, and this is like right when cars came out, it was either like $1,500 to $2,000 for just like a good horse. And the same type of car was like $10,000. But then what cars came down, it might have been $100, $200 and $1,000, but I think it was $1,500 and $10,000, like the gap. But then Ford started mass producing these cars and the gap came down to where cars were pretty much the same price. And then people were like calculating. This is one of Henry Ford's things he was telling people. He was saying, you got to calculate how much you paid to upkeep your horse, another $100, $200 a year. The cost of cars are going to be less. So like the cost of cars came down, people and horses went away. We still have expensive AI, right? So people's jobs are still going to be there. And now if you want to buy a horse, a nice horse is going to cost you just as much as a nice car, but there are a lot less horses.
Yeah, I mean, I don't think this is all going to happen quite as quickly as everybody does. I'm more of a gradualist. I think we got to see gradual stability before people will put AI into the sensitive areas. Like I look at, what happens if I get an AI health teledoc and I get an AI response and they tell me to do something and I have a huge reaction to it. Is the medical company that use the technology going to be where I go to sue? Is it going to be the AI developer who I sue? Who's ultimately responsible? I assume the medical company has to verify it before it becomes part of their process, and they're ultimately responsible for any advice given. But I could see, just like the CrowdStrike problem, who's protecting who and who has the right to sue if there is a problem. So I think our society is going to have a little time to digest this. And I don't think it's clear where and how some of these things are going to be regulated or understood.
Yeah, it's definitely one of the big things. The regulation, how people are playing it out right now. So I know we're running up on a little bit of time here. With your practice right now, with all the geopolitical stuff going on, just how are you managing your active portfolios? How are you managing your portfolio?
I'm buying puts still on the XLK. I believe that the XLK is still overpriced in terms of technology. I think the software has corrected, but I still think there's going to be some pullback in the hardware space as well. I think that SPY puts are in place because I believe that overall the market has, too many challenges and too much uncertainty. And therefore, I think that inflation is going to be a bigger issue. I don't think the Fed is going to be able to lower. So I think that this wash is almost a non-issue because I think when he gets in, I think eventually he'll have, the ability to lower rates, but not in time for the election. I think they were hoping he gets in May. He lowers rates May, June, July meetings. And those lowerings significantly affect the economy going into the election. Now I'd say he's not going to be able to probably lower rates once this year, maybe near the end in December. And that's going to be too late to do anything significant in terms of making the affordability better for a lot of Americans. So I'd say that right now, I'm looking at things saying, I think we are at a point where you should be, in my mind, below average in your allocation to risk. And I think you should probably be above average in your allocation to dividends and income.
I know the last two times we were on here, you mentioned that you saw the market going down 10%, and it did the first time. Hasn't gone down 10% the last time. Where you you seeing you think there's 10% again?
I see, like I said, the main issues are ground troops and something to go engage with China. I think both of those main issues would cause almost a 20% correction. And I believe that the recent run up has been, a false move by the market. So I think that there's 8 or 9% that is easily going to come off if things get more serious in the Middle East. And then I think there's another 10% that might come off if it involves China and technology. So I don't think it's really likely that we're going to see. If I were to guess, the S&P will not be over 7,000 at the end of this year. I think it will be closer to 6,000.
Really? Well, that's more than 10%.
I think it
Where
is,
we're at
but
now.
I think there's a possibility for more than one thing to go wrong, right?
It's like 15, 20%. That's down. That's a big move. That's more shocking right there. There you go. Wow. Okay. So you do see, so you have your puts play. But what about, so historically, after the election midterm years, the market should 20 something out, like one time out of the last 21 midterm elections, the market has gone higher. What are your thoughts on that?
I think that midterms are hard because they take the existing government that has been doing things for 2 years and they challenge them with, the idea that they're going to lose control of one of the houses. So you really need to hit the ground running in the first term of a president in the first 2 years. And I think it's, they're in a position now where it could become irrelevant. And if the Republicans were blocked and Trump was blocked from doing a lot of the things he's doing because of the majority of Democrats, I think he struggles, and I think the economy and some of the things that he's trying to put in place permanently, I think they struggle, and I think overall the market would like the idea that there is this kind of battle and there's no one thing that's happening, because the market likes uncertainty in some ways. It likes the idea that no one has control over it going up or down. No one party.
Yeah, it likes gridlock. That might be a better way of putting it. I think the market might like actual certainty. But I know exactly what you mean as far as people are speaking. Before we hop off, let's talk about people are going into safe places. They think the market. So you're going down. If you think the market's going down, but everyone doesn't have enough where they can buy options and puts, like they can't maybe do covered calls or anything in that effect. And the dollar seems to be, the dollar's been moving, crypto's been moving, gold's been moving. Where are you seeing as places to hide right now? And
I think, Marcus, that we should take the 8 or 9% move up and say things got more expensive. That was it. I made that money. I didn't defend as well as I should have last time in creating a defensive portfolio. So sell 10% of your equities and get yourself into safer things. I still believe the commodity, the story is going to be strong, gold and silver. I've also, for my clients, started to look at uranium. I think uranium and the nuclear is going to be a bigger part of the future. If you tell me in 3 or 5 years, I think the U.S. has more nuclear than it has today. So I like those as safe targets because I think they're longer term investments. I think in most cases, you and I agree that, there are some really good companies with good dividends. And I think that those companies will continue to be, the healthcare companies of the next 5 or 10 years. So I still like Merck. I still like Pfizer. I'm not recommending these for people to buy. Everybody needs to have their own tax and investment advice, but I think that stocks like that to pay a 4 or 5% dividend are a good store of value and are going to probably go up, as well as giving you the income.
Yeah, that's some real solid advice. I guess see if there's anything else on here. Is there anything else on here you want to cover today, Mr. Steven?
No, I think that was it. I'd say keep your eye on Z. I think Z is the key. His meeting with Trump and how it evolves in the Strait of Taiwan are really going to be a bigger issue than people are focused on. And so what I want people to realize is we see the problems we see. It's the problems we don't see that we need to be thinking about. And that's why I like the idea of, thinking about what could happen with Taiwan, because you don't want to be having to spend a week to analyze and figure it out. And then the market's already moved in the directions you should have gone, right?
Yeah, you can't try to time the market, right? You should already be in there. Maybe just increase your position or maybe decrease your position. I guess let me ask you a couple quick questions before we go off, and you can do these, let's say higher or lower, okay? Higher or lower. Gas prices in the month. Next time we meet in like a month. Higher or lower?
Higher.
Food costs.
Higher. Transportation of food is going to continue to go up as oil goes up.
So core inflation, things going up?
Yeah, that's usually X food and energy, though. Are you talking about the full one or the X?
Both, core and headline.
Okay,
Just
I would say
inflation
that
in general.
the headline one is going up. I'd say the core one is probably going up at a slower rate.
Gotcha.
It takes longer.
Employment.
I think employment in the U.S. is going to decline. I think we're going to continue to see companies who are using AI already to try to make their operations smoother and more easily implemented with AI technology.
And I guess the last big one, interest rates.
I know people are going to hate this, but I think interest rates are going up because I think the inflation will cause a spike and it will concern the Fed. And I could see the Fed not having WASH in place until September. And I could see that causing, a vote at the Fed to raise rates, which I think Trump would react almost violently to. So,
yeah. And then I'm going to say some months. You tell me when to stop. Okay. If this war is still going on, 3 months from now,
I'd say it will still be going on in 3.
6 months,
No,
3,
I think
6.
it will have to be resolved before the election.
There you go. All right, man. It's been a really good conversation. I think we've definitely given people some.
I think we solved a lot of the world problems, Marcus, because I think we're trying hard,
We are trying hard. Hopefully people are, because I mean, like we said, we speak about a lot of things that may not get put out into the mainstream media and people hear it, but we definitely know facts and we're giving facts to people and actionable steps that people can take.
Just came across, that was a $400,000 profit he made on that Maduro trade.
I wonder how much he bet to make that profit. Either way,
I just wonder what do you think he's making? He's probably making $40,000 as a troop.
Yeah, not enough to make that bet. So I guess over or under 4 more people will be indicted or charged like this guy by the time we meet next time on Polymarket Bet.
Over or under 4? I'd say it's an over.
All right. Cool. There you go. A lot of overs.
It's a pleasure, man.
Thank you, Mr. Steven. Anyone, y'all got questions? Y'all need anything? Leave them in the comments. We'll get back to you later. Thanks for joining us. We'll talk to you next time.
All right. Be well, people.
Be well. All right. You just finished the first phase of this month's audit. If you're seeing the patterns, you're already ahead of like 90% of the market. People are stuck in the fog once it clarifies. And once again, we're not just mapping theory. It's something called more. It's a different way to track institutional capital and different ways to see what's working in this economy. Like I said, I got like a 2-hour video on the whole introduction of more. So if you want to check that out, it's over on my YouTube channel, Marcus Sturtevant. Senior. So also in that, we just finished that conversation with Mr. Stephen Davenport. A lot of things happening that hadn't came to fruition yet. This next part, we jump into a live session with me and Mr. Clem Miller, a professor over at Georgetown University, and he's been inside the trading business for a while. He's also the co-host of the Skeptics Guide to Investing with Mr. Stephen Davenport. And we go into the world where we're at, Chairman Warsh, Fed Chairman Warsh, oil, some fascinating conversations on inflation, how he actually invests inside the market and some of the factors he's looking for as well. So actually, we should look at the Moore framework next to some of his staples and ways that he does it. It's a rich conversation. Stay tuned. Let's go. All right. Good evening. We're a little late this evening. Good evening, everyone. Welcome to tonight's live session. I'm joined by Clem Miller, and we're jumping on at pivotal moment for the markets. Just hours ago, the Federal Reserve concluded its April meeting, and as many expected, they decided to hold interest rates steady at 3.5 to 3.75%. But the whole is only half the story. We're seeing significant tension from the FOMC, the most since 8-4 we've seen since the early 90s, and backdrops of almost $120 Brent crude and rising geopolitical intentions. Tonight, Clem and I are going to pull the curtain back just a little bit. It's a different vibe, a little more laid back. We're going to talk a little bit about the Powell Warsh transition, where with Kevin Warsh's nomination advancing in the Senate today, so it looks like he should be clear for the vote. Inflation versus energy, maybe we'll talk a little bit about that just to see how the PCE forecast can play out. We know energy inflation was a big part of what happened last year, or energy deflation, the deflationary pressures of energy. And then higher for longer. Why these markets hope for aggressive rate cuts in 2026 is hitting the wall. I mean, I just don't think they're going to do it. We'll see. And Clem, there's a lot of noise out there on Main Street right now, but we're here to provide this signal, man. So let's just dig right in. How are you, Clem? What you thinking about?
I'm good, Marcus. Everything is great. It's been a relaxing day for me. A nice day today on the markets. So that's good. Makes up for a couple days ago. Or was that yesterday? Seems
Yes.
like it was a couple days ago. God, it was yesterday, wasn't it?
Yeah, when the market was down.
Every day brings some new volatility.
Got that right, man.
No, but I'm doing well. I'm just, watching what's going on. The Middle East situation is interesting. Both sides are playing, a cat and mouse game. So it's very interesting what's going on. A lot of countries are getting hurt by that. A lot of economies are getting hurt by what's going on with the higher oil prices. Asia is suffering. Europe, to some extent, is suffering. You had this event today, which I think is more significant than what people are attributing to it, and that's the UAE dropping out of OPEC. So I think that was very interesting. I guess some could say it's a long time in coming, but I think it's pretty significant. It shows that this so-called unity that the Gulf states has may not be all that much unity.
Yeah, the UAE's pullout definitely was something that withdrawal from the OPEC today was definitely unexpected. I think they kind of like dropped it. I guess over there it's probably like the middle of the night, right? When they dropped it early in the morning over here, or later in the evening. It was early in the morning over here. I do recall that.
And effective May 1st, so that's pretty quick.
That's Friday.
Yeah, I mean the thing about that one is that even if you take the Iran war out of the picture, which of course it's impossible to do, but even if that didn't happen, the UAE was quite upset, has been for a long time, with Saudi dominance of OPEC. And so what would happen is Saudi Arabia was the swing producer. So basically they could control the price of crude oil. If they pumped a lot, price of oil would come down. If they ratcheted back production, the price of oil would go up. But that power was in Saudi hands, while they expected other countries in OPEC to restrain their production more or less permanently. And obviously the UAE was one of those countries which was constrained by OPEC. So now they're no longer going to feel constrained by OPEC. And so that should be good for lowering oil prices once the Iran thing is resolved.
Once the Iran thing is resolved, yeah. Once it's resolved, man. I think I saw gas today. The national average is like 423. Like,
yeah,
gas is expensive. How much is it up there in DC?
It's around DC, Baltimore. It's a lot. A lot. I actually in downtown DC, I saw it the other day. I think it was $6 or something like that. I remember it was really, really high. I saw a gas station down there.
Are you getting jet fuel?
I don't know.
$6 a gallon. That is really high.
I mean, it was in downtown DC, so it was a lot. It was a lot of money. I couldn't believe it.
Must have been right there by Howard University. I don't know, man. That's very interesting that it's that much. I mean, I think down here, I know down here because I got some gas this morning. It's like $3.63 right down the street.
Oh, that's pretty cheap.
Well, when this conflict started, so for context for anyone listening, when this conflict started, it was $2.41, but it's definitely lower than it was at its peak.
Yeah.
So it's definitely come back down. And with that, I mean, we're just talking about, I know we're going to talk about the Fed. People come here to talk about the Fed, but like you said, it's OPEC stuff dropping today. Like, and for those who don't know, Clem is an international professor. I'll let you say what you are, Clem. Clem understands geopolitical events, right? He teaches this stuff. But what I was going to say is, so like the UAE, for example, you say now they can expand their oil production, but it's different than if they would have done this some years ago, because a lot of other countries have become a lot more oil independent, mainly the USA.
Yeah. Well, yeah, I mean, the USA has obviously a lot of oil, okay, but it's not necessarily in the right places. There's a whole, it's not a situation where, oil independence and energy independence are kind of vague terms, right? You may have on net more exports of energy than imports, or you might have, but it's all based on an energy levels, and you're still importing stuff into certain coasts of the United States, and you might be exporting other stuff, or LNG might be offsetting crude oil. So it's kind of a whole fuzzy thing. And besides energy independence of a particular country means absolutely nothing when oil prices are set on a global basis.
Expand.
Yeah. Expand on that.
Mm-hmm.
Okay. So, it's not like, it's not like if you had absolute US energy independence, or let's say crude oil independence, we couldn't have an oil price here that's like $10 cheaper than global oil. It just doesn't work that way, because you're going to have arbitrage, right? It's like anything else, right? You're going to have arbitrage where it's going to make sense for oil producers to sell where they can get more money, right? So, you arbitrage to a global oil price.
Interesting. And I'm not, go ahead.
Yeah. I mean, not to get more technical than that, but you do have some frictions regarding various qualities of oil. You have some frictions regarding where the oil is exactly available in terms of, like, is it available on the West Coast or in the Gulf of Mexico or the West Coast? And so there can be slight differences that are explained by these frictions. But by and large, there's sort of one crude oil price for the world, right?
Right. Well, I mean, you have Brent crude, which is, and then you have WTI, and then there's even more oil than that. There are other types of oil.
Well, there's lots of different oil, right? But Brent is a composite. Okay, people don't realize that there used to be a Brent oil field, right, where you used to be able to get a lot of oil from. It was like a huge oil field. And then it basically got exhausted. And so this concept of Brent crude is it's like an index. It's like a composite of a lot of other crudes. And so they're all sort of light crudes. And so because they're light crudes, that composite tends to have a higher price than those that are heavier crudes.
What about the West Texas Intermediate?
The West Texas Intermediate is somewhat heavier, not really heavy, but somewhat heavier.
Is that price based on a blend of different?
It is based on a blend. It's based on a blend of oil that comes into a particular pipeline system at a place called Cushing, which or near Cushing. I guess it's either West Texas or in Oklahoma. Forget. But the composite price is West Texas Intermediate. So both those basically are composite prices based on different qualities of crude oil. And West Texas Intermediate is generally it's more referred to in the United States than it is overseas. Whereas Brent crude is really the benchmark that people talk about, overseas. So, one way to think about that is the West Texas Intermediate is like using the yard and the foot in the U.S.
I was going to say standard and metric system.
Whereas Brent is like the meter of the rest of the world, right? Overseas, you come out of the United States, people talk about Brent more than they talk about. But still, Brent, you can't. What's weird here is you can't really buy a barrel of Brent because it's just an index, right? Okay. You can't buy the bottle of Brent, right? You can buy an index that tracks it, which is the Brent index, and you can buy futures and options and so on. But those are like financial instruments. They're not, they're not the actual barrel of this mix.
Yeah, not the tangible portion. You can't touch that oil. You can just buy an index. And for those,
you used to be able to buy Brent. Used to be a real oil, right?
You can go buy a barrel from your house.
But it exhausts, the field exhausted, but you're right when you said there's more than WTI and Brent. There is, there's Arab Light in Saudi Arabia. There's UAE blends. There's Nigerian blends. There's Venezuelan blends, and all of these are slightly different based on the quality of the oil that comes out. Lighter crudes versus heavier crudes generally.
Right, and people use different kind of crude oils and gas depending on the time of season, right? Like summer has a different kind of gas, and winter has a different kind of gas. Like there's so much in this gas that people don't realize.
Right. And different refineries have use different types of crude oil. So just to give you, I'll give you an example with which I'm familiar. Is in the Gulf in Texas, you have oil refineries that process heavy crude oil. And where do they get this heavy crude oil from? Mostly actually from Venezuela and from even more so the Alberta tar sands, right? And so that they process this heavy oil into lighter oil-based oil products. But only these refineries, among refineries in the United States, only these ones in the Gulf can do that. And that's why when you had the all this discussion about Venezuela and knocking out the head of Venezuela, Maduro, and basically seizing the oil and whatnot, the oil in Venezuela is valuable for those refineries in Texas. So that's where that comes from.
Of course it is.
Yeah.
And with the, we went and locked up the oil in Venezuela, and by locked up, I mean gained control of it. And then now we have this Strait of Hormuz situation with the oil. It's a lot of oil, but they, like you were talking about pipelines, they integrated that pipeline where they're pumping it from the east to the west of what country are they pumping it across? I'm talking about the other pipeline they have out there.
You mean in Saudi Arabia?
I don't think it's Saudi Arabia.
The Red Sea.
Yes, it goes to the Red Sea. Yeah, it goes to the Red Sea.
Yeah.
So they're having, so they're finding ways to, I guess, divert oil, but there's so much oil that we're getting behind. This stuff's just sitting in the strait. Ships are being taken. It's just, it's madness.
Yeah. Well, over the years, there's always been talk about Iran seizing the Strait of Hormuz. Like my entire life, people have been talking about that. And, it's one of those things where after a while I started thinking, oh, that's just talk. It's never going to happen. Right. It would have happened already had it.
Yeah.
But no, now it's happened.
Well, that's a big tool they got.
It's a huge tool. And they've got a lot of the U.S. Navy tied up dealing with that.
Exactly. And I was talking with Mr. Stephen Davenport. We were doing a live session last week before he went away on this trip, and he was talking about the Strait of Taiwan, right?
Yes.
That's how that could be another choke point, how that could be, Xi could be sitting over there looking at what we have going on with Iran. And like you said, our Navy's over there and saying maybe it's the chance. But I don't know. Y'all are skeptics. So I'm a little more sanguine.
Well, I would say on Taiwan that that an invasion is not as likely as some kind of blockade, right? Some kind of serious blockade. And I don't really think that China is ready to entertain that. I think Taiwan's got some good defenses. I think the United States will try to defend Taiwan. And I think Japan will try to defend Taiwan as well.
Yeah, moving on Taiwan, I mean, that would throw the markets even into more peril right now if that was to happen.
Well, it would upend the entire technology industry if that were to happen.
The chips, can't get the chips over here. Taiwan semi where they make the base.
And other industries too, not just technology, automotive and so on. But if we saw something like that on the horizon, I think you would see me get out of technology stocks that I'm in.
That Intel you loved.
I hate Intel.
I remember Intel's been parabolic, man. Like the crazy moves with Intel this month. It doesn't make sense. It's very interesting. Well, I think we talked enough about the war over there, the oil. Let's shift a little bit more towards the Fed. Today was presumably Jerome Powell's last meeting as Fed chair. I've watched the meetings. I watch all his meetings. I watch him for his body language. Like he's not really going to put anything. Sometimes he says things that drops the market. Like he came out at Jackson Hole a few years ago and he was extremely hawkish, meaning that he was saying it's going to get rough. There's going to be pain. That's what he said. There'll be pain. The market's went down crazy. Today he was up there. It seemed like I don't know if you watched it. Today it seemed he was up there just kind of like, it was like, this is my last hurrah, but I'm not going anywhere until this Lisa Cook or until my thing's over. They asked him about Lisa Cook and he didn't really say anything about that. What are your thoughts on where we're at with this Fed right now? And just where we at in Fed?
Well, a lot depends on the political legal situation that, with Powell and with the Fed, with Lisa Cook and so on. And what I anticipate is that, based on what some of the justices have said in the past, I expect that Lisa Cook will be allowed to keep her job. That's what I expect. I anticipate that Powell might stay there longer than maybe he anticipates, because I don't think the pressure is going to go away from Trump and folks. I don't think it's going to go away. So I think he's going to be there longer than perhaps he himself anticipates. I forget when his term ends.
I think he has 2 more years.
Yeah, he may be there for all those 2 years. It's quite possible.
Wow, that's a big take. No, I don't know, Kim.
I don't think he wants to do that, but if the pressure continues, then he might well do that.
I mean, he's an attorney, so he knows, he's a trained attorney. He definitely knows the pressure. I think one of the points he made when he was speaking was that when he said they talked with the DOJ, but they didn't like completely give him the all clear. They wouldn't come back and try to bring this thing back up again.
Yeah, they said they might.
Yeah. So yeah, until that's like all clear, he might stay. But who knows how long he's going to stay.
And look, anybody they don't like or trying to put pressure on, they're going to do something. I mean, well, look at what they did with Jim Comey today.
What did they do to Comey?
You remember those things, that thing with the shells and the 8647 from last year?
I remember they indicted him and arrested him last year.
Yeah, well, that was for a different thing, and that was dropped. And this time, you might remember a year ago, he was on the beach and he claims to have seen this shell formation. I'm sure he put it there himself, but the shell formation says 8647. So now the 47 is definitely Trump.
Okay.
Right.
Oh, take him out.
So well, the debate is about the 86.
Maybe take him out.
And yeah.
The restaurant.
Yeah, it's that's what people are saying.
Exactly what it is.
And in restaurant language, it means like I don't know. What do you think it means? Take out the trash.
If you're going straight off those numbers and you say 45 or 47 represent Trump, 86 means like get out of here, it's gone. 86 that order. The order's gone. Right? I work in restaurant, so I know this lingo. Like 86 that order is gone. So yeah, I don't. But did Comey work in restaurants? Does he know that terminology?
It doesn't mean kill him.
No. Well, I mean, I don't know what he means. So I don't know. I don't think so. Why would you put that in the sand? Why would you put kill the president in the sand?
Right, exactly. And why Comey claims he never heard of 86 before.
If you haven't worked in a restaurant,
I've never heard of 86 before either. I've heard of deep six. So that's what I thought, 86 might mean, but it's not. 86 means something in a restaurant context.
Yep. 86 is take them out, man. If something's 86, if you order something, Clem, you hear them say they're 86 on whatever you order, don't eat it if they bring it to that table. They meant to throw it away. Don't eat that. Don't eat that. I digress. Yeah, so, and then even decided Chairman Powell stand there longer.
So they're indicting him for that as a threat to the president.
Yeah, someone else was getting indicted as a threat. Oh, no, it's the FCC and the Disney. So that thing's very interesting as well. Did you see that?
You mean with Kimmel?
With the FCC, now they're going to review Disney and ABC's license. Yeah, I think it came from Kimmel, something he said.
Yeah. That's where it comes from.
Yeah, it's just
this car, he doesn't believe in the First Amendment, basically.
Maybe he's weaponized. I don't know. He's out there. But once again, I feel like I digress. Back to the so how is
it's important though. Politics is important because it interferes and intersects so much with what's going on with investments and economics and what will the issues with Fed independence are all tied up with politics. Right. So you can't separate that out. Right. So, I mean, that's the big issue. That is the big issue with the Fed, whether they're going to be independent or not. It's not whether they lower interest rates by a quarter point. That's not relevant. Okay. Not at issue. Right. It's whether they can be independent. It's an institutional issue, not a, are they going to lower rates or increase rates or keep rates steady, for until the next meeting? That's like people agonize over these dot plots. I don't care about dot plots.
You sound like Kevin Warsh. Some of the things he's going to do, right? He's going to get rid of the dot plot. What are your thoughts on the meetings that Powell gives? Because I think Warsh is going to cut those down, if maybe not eliminate them as well. Like after The press conferences after the meetings.
You mean the press conferences?
Yeah, like the one he had today. So Powell pretty much does after every meeting.
Right. Well, I personally, I think it's better to have more transparency than less transparency. Okay, I do think it's better to do it that way, and I think there is an investment reason for doing so, because if the Fed does something that surprises the markets, there could be an overreaction by markets. Okay, so it's in the interest of the Fed, it's in the interest of public policy that the Fed do enough signaling that it's not disruptive to markets. So that's from the public policy perspective. There's a flip side to that, which you and I were talking about earlier, which is that it's very difficult to invest based on what the Fed does, at least currently, because the Fed tells you what it's thinking. And it's priced in, it's baked, that what the Fed is doing is baked into markets already. So it's not like you can say, well, I disagree with everybody else and I'm going to bet on the possibility of a rate cut. No, they've already told you in advance what their thinking is. So, I mean, they haven't, they don't come out and say, we're going to do a rate, we're going to do a rate cut, or we're not going to do a rate cut. But all this signaling from meeting to meeting to meeting and gradualism and so on, it tells you in advance what it is. So I don't think people should invest based on what the Fed does or doesn't do. Now, do I think transparency and gradualism is a good thing for the Fed to do from a public policy perspective? Yes, I do. But I don't think that one can invest on that basis.
Gotcha. Yeah. And I mean, I feel like previous Fed chairs did a lot less, a lot fewer meetings and Fed speak than Powell. And part of it may be that it seems like every governor is always speaking somewhere between, not like collectively, they're either out speaking to students, which is now televised, or on some panel, or they're just, writing a white paper, just coming out.
But when you've got all these governors doing that, I think it's very important for the chair to do it too. Otherwise, it could look like, it's like the old story about the elephant, right? Where, if you look at the elephant, the blind man, the elephant, you can touch the tail.
Feel it.
It feels different than if you touch the ear.
Right.
So if you're hearing from multiple or only from a few of the Fed governors, you might get totally different perspectives on what's going on at the Fed. And really, the chairman is supposed to, aggregate those and give the consensus view.
Yeah. So I think you just said my point for me though. It's like if Fed governors are out here speaking in between the meetings, like, and I get that like you said, you touch one part of the elephant, it feels one way, touch the other part, it feels different, and the blind man doesn't know this is all one elephant. So yeah, that's the Fed governor, 12 districts, all these 19 people in this room having this conversation, and the chairman guides the vote, but he still only has one vote, so the chair can't come in and particularly control it. But if I think I heard Powell say it today, he said you need the chair to come out and, like you said, make his statement. But part of the problem is you may have, when you have other people talking, you get a bunch of mixed messages. So you can't have either the governors talking or the Fed talking or the chairman talking. You have to have like a combination of both or just the chair. What are your thoughts on that?
I think it's good that the others talk. Okay. I just think that if the others talk, then the chair has to talk too. And the markets should listen more to the chair than to the and economists and so on should listen more to the chair than they do to the individual members.
Okay, so we said earlier, or you said earlier, like that the Fed, you can't really invest off what the Fed's doing right now, just because the moves, they really haven't done anything. They're sat still. They've been paused. They've been on hold. So inside of that, the mindset of the investor, a self-fulfilling prophecy, kind of, right? I was talking earlier. Go ahead.
With all the transparency, then what the Fed's going to do is already baked into what markets are going to do. So, you can't. It offers limited room for being able to invest. Invest on. I'm talking about investing on anticipation. Betting against the broader perspective, right? Betting against the market. You can't do that when the market, it's clear what the Fed is going to do, right? This is not, to use a sort of a more modern example, this is not a poly market, right? Where there's, or what is it? Kalshi, where it's not a betting market where there's a binomial or a binary decision, right? It's all built in, right? So it's like a 90% chance that the Fed is going to do basically what it says it's been going to do, right? And only this sort of 10% chance that it might not. And all that, by the way, all that is because the Fed has become more transparent. It used to be the Fed wasn't transparent or wasn't transparent enough. And therefore, there had to be a lot more of the tea leaves reading, right?
Right. People, you're talking about back in days when people were doing channel checks and going to sit in parking lots. You couldn't. And vocal, those guys didn't talk, right? They didn't speak
you
a lot.
don't need tea leaf reading now with that. So, I think just to even, let me broaden this out a little bit more. The Fed basically controls short-term interest rates, like very short-term interest rates. That's what they control. They don't control long-term yields. They don't try to control long-term yields. And as a result, and it's long-term yields that actually are the influence on stock markets, on equity markets.
Really?
It's the long-term yields.
Mm-hmm.
And the Fed doesn't control that. So, you have to look at markets about what is going on with long-term yields. You can't look at what the Fed does to tell you anything about long-term yields. Okay, you can't, right? Because they don't control it. Some central banks have actually tried to control long-term yields, right? And in fact, the Fed, you could say that when the Fed did QE, that was about controlling long-term yields. You can kind of say that, right? But not really. The Bank of Japan has actually done its policy of, its zero policy of long-term yields being zero, and they've been doing that. I don't know that they may have abandoned that or partially abandoned that, but for the longest time they were keeping long-term yields at zero.
Yeah, how'd that work out for Japan? They're good now. Their stock market's, a lot of producers over there. Shout out to Japan. A lot of people from Japan actually listen to the podcast. So
really?
Yeah.
Well, I love Japan. and I've been there several times, and we're going to be going back. So
I think you were in Japan one of the times I sent you a message. So yeah, Japan, South Korea, Vietnam. It's crazy how many people over here watch it. Thanks. Big shout out.
Love Japan. You should go.
Maybe. I think it might be South Korea. I did a TV spot over there live. That was pretty cool. So we'll see. You never know. You never know. So, okay, we have, and what you said definitely is true as far as with the investing. I think people, like I said, is there a self-fulfilling prophecy when people see these interest rates going higher? And I say that juxtaposed. I was sitting with David Snyder earlier today recording, and he was saying a lot of contrarian things. Wait till that comes out. It's going to be a good one. One thing he said is you can fight the Fed, that's really contrarian. And then he broke down like why the Fed's losing credibility, right? And one of the reasons he says with Main Street, they consistently say 2% interest rates. And then they consistently we're actually running 3. I think it's 3.5 after today, 3.5, 3.75. So we're running way above that. And he just pointed out how business owners base their investments off believing what the Fed's going to tell them at this 2%. But then some other business owners are actually raising their prices by like 3%. That's how the inflation is creeping in. What are your thoughts on that? You think the Fed's not the signal it was before?
On inflation rates.
Just in general. Yeah, on the inflation rates. Like, because I mean, we saw the Fed last year, the end of last year, the end of 24, they cut rates 100 points. The 10-year, like you said, they don't control it, went up 100 points. Mortgages went up.
Yes. So on inflation, you know, I always have to laugh when somebody says, oh, the inflation rate is 2.7% or 3.8% or whatever, right? I mean, why don't you make it to 2 decimal points, right? I mean, precision, it's like false precision. I don't think, I mean, there's the CPI, right? There's the PCE. Okay, there's the CPI urban, right? There's the PCE urban, there's the CPI without energy and food, there's the PCE without energy and food. There's this new thing called the trimmed mean. Have you heard of that one? The trimmed mean CPI or PCE, where basically they have the whole list of goods and they cut off the highest inflation and the lowest inflation ones. It's almost like a median, right? Across product categories, except they take off the tails, right? The upper tail and the lower tail.
Do you know what that number is? That's weird.
Yeah, well, look at it. I think it's called they call it the trimmed mean.
Yeah, no, I've said, do you know what that number is? Like what that's running? Okay, yeah, I was wondering like what the difference in between that and like core and headline inflation, like you're talking about stuff pulled out. That's
yeah. I mean, my point is this: there are so many different iterations of inflation that it makes the whole concept kind of suspect, right? I mean, yeah, okay. So there is inflation, obviously, right? Inflation is higher than it should be. I think we can say that. Prices are because of cumulative inflation year after year after year are much higher than they were in 2020, right? Because of COVID, post-COVID expansion or recovery sent prices up through the roof, right?
relief checks.
We haven't had a recession, a contraction, a big economic contraction that would have brought prices down. Haven't had it yet. And now we've got tariffs and we got the Gulf that are sending them up further. So, and I think from a political standpoint, now let's talk about politics here, right? From a political standpoint, you know, people were told in 2024 that prices were too high and that we're going to bring down prices. They weren't told, oh, we're going to bring the inflation rate from 3% to 2%. No. They weren't told that. They were told that we're going to bring the prices of, I don't know, bananas or something. We're going to bring that down. Eggs. We're going to bring the price of eggs down. And so that's what people expect. They expected the actual price to come down, not the rate of change in the price, which is what inflation is about. So I don't think, I think, you know, the Fed might argue about, well, it's 3.2% versus 2.9%. It doesn't matter. It's like, that's false precision in my mind.
Okay. So I posed a question.
Yeah.
I posed a question on LinkedIn today. And this is streaming through LinkedIn too. Shout out to anyone watching on LinkedIn, YouTube, anyone watching me and Clem. But one of the questions I posed was, okay, because I feel like, and I'm tying this back to like my thought on private credit. I think all the private credit people need to just come out, tell us what they have, write off what they need to write off. What do you think would happen if the Fed came out and just said, all right, we can't get to 2. We're putting our cards on the table. The real rate is 3. Or Walsh might come out and say the real rate is 0. what do you think the markets will say then? If they just, because you say this Fed's only, like the Fed doesn't control interest rates or doesn't particularly influence the stock market. What are your thoughts on that if they came out and made something drastic like that?
Well, okay, so this is how it doesn't control the stock market, but it does influence it. And it influences it not through rates, not through long-term rates, but it influences it because people want to believe that it influences it. So there's a belief system out there. There are a lot of people out there who believe that the Federal Reserve is like Oz.
The HBO show?
Well, like no,
or the Wizard of Oz, like behind the curtain? Yeah, which one? You gotta distinguish the one behind the curtain. Yeah, okay.
Because maybe they've grown up with all these like assertions that the Fed is all powerful and we should break up the Fed, or the slogan that people have heard a long time, we should audit the Fed to make sure we know what they're up to. And you've heard these things over time. Conspiracy theories, the Fed has been subject to conspiracy theories because people believe that the Fed has a lot more power than I think it really does have. It creates this imagery of a lot of power. And so if the Fed does something unexpected, right? If the Fed does something unexpected, then the markets will likely react. If only because people will think, well, the Fed knows something that we all don't know. Okay. And so we should act because the Fed is smarter than we are. And I don't buy that.
Yeah, I definitely don't think the Fed's smarter than us. I mean, they got a lot of PhDs over there. I mean, I think they get the information before we have it clearly. They know more than we know. But you like you said, is this like go ahead.
Is this the right information to be looking at?
Is this dirty data? Yeah. So I wanted to talk about the mindset thing. We'll get back to that, but this is a good point. Like,
how do we know? How do we know that the Bureau? I'm not convinced that there isn't some manipulate. Now I'm being the conspiracy theorist. I'm not convinced that there isn't some manipulation of the Bureau of Labor Statistics going on.
Clem,
I'm not convinced.
Clem, are you talk about Bureau of Labor Statistics? Are you young enough to remember when they used to count employment a totally different way? Like they changed the way they count unemployment. So yeah, it's probably a little different in there.
If there's a statistical basis for a change, that's fine. But our president didn't like what he heard one day, and so he fired the head of the BLS.
Yeah, I remember.
And tried to put in some kind of sycophant into the BLS. And I haven't heard what's going on lately, but do we trust what's going on with that data? I don't know.
I tend to tell people when we talk about the data as far as it goes now, especially, we've had shutdowns that kind of distorted the data. We had a month where data didn't come out at all. Like that data's gone forever, right? There was some inflation data just never came out.
They weren't able to collect it. I mean, what they'll probably do is do some kind of extrapolation or interpolation or whatever, right? But
manipulation.
Yeah, it all rhymes, right? Extrapolation, interpretation, manipulation. So I don't know. I mean, I don't really. I'm not sure we should trust the what's coming out of the BLS. If I were in the Fed, I would be finding independent sources of information other than the BLS.
I think that's what they're trying to do. Maybe I think so. I think that's one of the big things. So Powell was elected by or nominated by Trump, as is Warsh. But I think they're coming in with two totally different approaches, right? What do you think is going to be some of the changes Warsh will make? I think like I said, I think he thinks AI is going to boost productivity and allow him to cut rates. What are your thoughts, Cliff? Powell's Warsh's Fed.
I think he may be right about that. I think we're seeing a lot of I think we're seeing a lot of layoffs in technology. And I think that a good chunk of it has to do with AI. And you're going to need to lower rates in order to stimulate the economy and in order for these folks to be hired. The only thing is that stimulation requires lower long-term yields because I don't think these short rates are going to do much.
So do you think the economy is slowing down? Or are you basing it on these GDP estimates?
The economy is not slowing down now. The economy is doing quite, if you believe
the data,
the stats,
mm-hmm.
the economy is doing fine. And that was reflected in today's statement that the economy is doing fine, except for inflation. Labor is doing fine, according to the report today. But I think what Warsh is talking about is about the future more than about the current status. And we're in an upswing for AI that is going to affect a lot of jobs. And so in order to kind of boost employment, I think that long-term yields are going to have to come down to do that.
Got you. And the reason, so for people listening who may not quite fully grasp why you keep saying long-term yields, because that's what these big companies are investing. They're basing on long-term capital expenditures and tied to a yield.
Fed doesn't control.
Right.
I mean, they could influence it by, QE, right? They could lower it. They could lower long-term yields by buying a lot of bonds, long-term bonds, like they did with QE. But they're not doing QE anymore. If anything, they're doing QT,
quantitative tightening.
Right. And so, that tool that helps to lower long-term bond yields is just not there. That's why I think the Fed is less relevant, because it focuses only on the short term, not on the long term.
Got you. What about, I think one way that the Fed can influence a little bit more is if they start getting too offsides, these bond vigilantes come in. What about that thought? That's what really moves the stock market, whether people realize it or not, like the bond market.
What moves the stock market?
Let me say it to you again. Oh, go ahead. I thought you were questioning. Go ahead.
No, what moves the stock market is earnings growth. That's what moves the stock market.
Well, we've had great earnings for the last how many years?
And it's helped the stock market.
But okay, so even first quarter though, we had great earnings, right? Great earnings out of the banks. The banks went down, right? Great earnings out of software. The IGV crashed. So are we past? Because if you look past the noise, yeah, it should definitely work straight off earnings. We are at all-time highs. I'm sitting here talking like we're crashing or something. We are at all-time high. But,
right,
6 on one hand, half a dozen on the other. 6-fingered man. Yeah, I don't know. I think, like you said, I think it's something inside investor sentiment, inside investors' mindset. When they see things with the Fed, maybe they are giving the Fed too much power.
I definitely think so. It's you got a lot of people who talk about it, and so if they did something unexpected, I think it would move markets.
Right. So
when they just do what they do without any surprise, I don't think it really moves markets that much.
But so it's a sentiment thing. It's kind of what you're talking about with the Fed.
It's a sentiment thing.
Have you ever heard the term psycho-cybernetics?
Psycho-cybernetics? I don't think so.
All right. So
I mean, cybernetics sounds like it has something to do with machines.
Cybernetics is like motion. Psycho is like in your head, your psychology. I read this book in college. So it's like cybernetics. It's from like the 60s.
Now you're worrying me.
No. It's from like this book is from the 60s. It was one of my courses. I took a course and this was the textbook the professor gave us to read. It's actually interesting. It talks about the power of like visualization, how you see things and it happens, manifestation, those type of things. So we're talking about the Fed and sentiment. I think people invest off of psycho-cybernetics more than they even realize into like self-fulfilling prophecies. Tying that to, so they'll say, still with the Fed, if you see the Fed come out and make a statement that would make the markets move, they're going with that same sentiment. They're going to see whatever's happening. They're going to mentally think that we should move and go down because the markets are moving and going down. Or as opposed, logically, they should just stay still or buy more.
I don't quite understand.
Psycho-cybernetics. So what I'm saying is it's like a self-fulfilling prophecy with your sentiment, as far as like with your investments, the ties to the way they are tied together, right? I was saying that. So if a person loses money and they have a bad self-view of themselves, they're going to go sell stuff, right? So if you see the Fed out here speaking, you got to stay with me here. You see the Fed out here speaking, they're going down, they're saying like, these markets going to move one way or they're going to move another. Psychologically, people are going to move. It's the sentiment we saw with the Michigan report, where sentiment was bad, but then the actual movement was good until it wasn't. So basically, it's just saying, like, in your investing, I guess this is more for people listening, investors. Stay positive in investment, but be smart, right? Don't let the Fed or don't let what you hear make you go out and do something crazy.
Exactly. And the last, a good surefire way to lose money is to invest on what happened today and yesterday. Right? Don't let, that's a surefire way of losing money. Like if something happened yesterday or the day before and markets moved in a particular direction, don't think that's going to last. And don't think that people haven't already invested on that. And, you may be the last to participate in that rally or whatnot. So that's the last thing you want to do is do that. No, you want to have a strategy that you can pursue over a longer period of time, right? Now, I'm not necessarily one to say, well, you should have a strategy that should last years long. I don't believe that, right? But I do have a basic core strategy, and then I can kind of layer on macro things as things happen. But I don't invest, day trading or invest on 2 days or whatnot. I do have a lot more cash than normal now because of the higher risk.
Yeah, I was just going to ask you. First of all, I was going to say you don't have zero triple leverage, 0 day options, and then I was going to ask you. I know you and Mr. Steven on your Skeptics Guide podcast. Y'all went through your portfolios a couple episodes ago. How are you positioned right now?
So I have about 50% cash.
50?
I have 0% cash.
Ooh.
Okay. But the stocks I have in the other 50% are doing so well that I have been, I think probably on 3 out of 4 days beating the S&P 500.
Combined total return. Any private credit?
No.
Any Bitcoin for those?
I believe in liquidity, right? Bitcoin, I'm not stupid, okay?
For anyone who has not heard Clem's take on Bitcoin, you need to go back and listen to the podcast. You might not ever buy Bitcoin again if you listen to him talk about Bitcoin. Because
I don't want to get forked. I don't want to get forked.
He did talk about forking. Apparently, that's where it just duplicates his own token. That's a crazy thing to think about, and really scary.
Not many people know about that.
I had never heard of it before you said it. I'm checking our notes. I want to make sure we're covering everything we want to talk about, Clem. While I do that, feel free to expand on something.
Well, like I said, I think people put too much emphasis on the Fed. So that's one thing. I don't think people quite grasp how important the Gulf situation is. I think it's very important. And right now, right now, I don't think we're anywhere near a solution to that situation. So I think we're going to see continued high oil prices, high gasoline prices, high jet fuel prices for months to come.
Question.
Yeah.
Yeah, because that stuff doesn't move quick. Like the prices go up fast, but they go up like a rocket ship and come down very slowly. So what's going to end first? Jerome Powell's term or the war in Iran?
Jerome Powell is 2 years off.
Jerome Powell's term or this war? What's going to end first?
The war is going to end before that, for sure. Right. This is, I think the chance of there being a ground conflict is very small. Right. The chance of the U.S. sending troops in is very small. I mean, I suppose there's a possibility we could send troops to Carg Island.
How are we going to get the uranium, the enriched uranium? They're not going to just bring that to us.
I think it's going to be, I think what they would have to do to get the enriched uranium is just plain crazy. Okay. They'd have to build an airfield up near where because they have to dig it out of where it's buried.
Where they dropped the bomb last year.
Yeah. Presumably, unless they managed to get it out or get out some portion of it.
And we had done that over underground.
Which leads me to so I'm going to throw out a little bit of a scenario here. Okay?
Perfect. Throw it out.
So, the Iranians have been talking about, well, if this blockade continues or if the U.S. attacks some more, we have a weapon that we have not used before. This is what the Iranians have been saying in some of their communications. And not in their Lego communications, by the way, in their real communications.
I don't know which communications are which. I don't even know what Lego communication is.
Right. Well, they've been sending out these Lego propaganda videos. But putting that aside, okay, there have been these real communications. They've been talking about potentially using a weapon that they haven't used before. And so I don't know what that weapon is, but I have two guesses.
Guess.
Right? So one guess, the lesser likely of the two guesses is chemical and biological warfare.
A dirty bomb?
Well, that's going to be my most likely guess.
Oh, okay.
Maybe you read my LinkedIn post on that.
No, I didn't. I didn't know you made a LinkedIn post. I just kind of thought they were the same thing.
No, chemical and biological would be like anthrax or something like that in a smallpox or whatever, loaded up in a bomb, right? And blown up over some area, right? Like maybe over a naval ship, right? The other one, it would be a dirty bomb. It'd basically be the same thing, except it leaves radiation rather than anthrax. So guess what is possible. They might take some of this 60% enriched uranium. Now remember, it's enriched to 60. We know, and they admit that it's enriched to 60%.
What's it got to get to, like 90?
It's got to get to like 90 plus in order to be used in an actual atomic bomb. But 60% enriched puts out a lot of radiation. And so if you stick that stuff in a dirty bomb, that's going to cause a lot of havoc. So, and as far as I know, there's nothing, there are no international treaties. There might be, right? But I don't know that there's anything out there that prevents the international use of dirty bombs. Maybe there is.
But you can't do chemical warfare because I feel like they stopped that with mustard gas and mustard gas after like World War I, right? Like,
well, there is a treaty, but a lot of countries have not signed up for that treaty. Interestingly, Iran has signed up for it. So there you go. Remember that they're not supposed to make this stuff. But I don't think the U.S. is a member. I don't think Russia is a member. I don't think Ukraine is a member. But despite who signs up for what, it's been used in the Middle East before. Syria used it. Iraq has used it on the Kurds. So it's certainly a possibility. So, if Iran has this stuff, that might not be good if the U.S. attacked them.
Yeah, I mean, there's not really anything that can catch that stuff once it falls out of the air.
Right.
Uh,
And yeah.
Yeah.
And, we've already seen with the Iranians that they can be asymmetric with their targets, right? They don't necessarily have to target a naval ship. They can target Abu Dhabi, right? Or a base in Qatar or Kuwait or whatnot.
Places they hit, and they have longer range missiles now, so those things are going out even further. Yeah. It seems like a lot of our intelligence over there is like really outdated or just bad.
Well, I think it's crazy how they didn't expect, or they ignored evidence, maybe is more like it, that Iran would close the Strait of Hormuz.
Yeah.
Because like I said, people have been talking about that for years. I mean, true, I was like, yeah, over time I was thinking, oh, they'll never close it because they would have closed it by now. And maybe that's what they were thinking, that they've had this opportunity over the years to close it, and yet they never did. Well, guess what? Now is the time.
Yeah, they definitely closed in. It's definitely, and it's a small little space, like a few miles wide, not very long. It's just, but they definitely control it, and a lot of oil and capacity comes through there. It's just, it's crazy. It's crazy, the power and the geopolitical. If they were to sell something like that, that would definitely send the markets down. Crazy, ridiculous. I guess, Clem, that's live stuff right there. Knock my mic down. We're talking about the Fed. We're talking about, before we hop off, we just had a lot of Mag 7 earnings come out like today, bounce around a little bit here. And so I don't know if you had a chance to hear any of them, but like Google's, Alphabet, they're up because their Gemini was used more. Meta was down.
That is not good
because of their capex. What do you? And I heard, I like I said, and I hate to go back to David Snyder, but that was the conversation I just had today, and he thinks AI is about to bust as a bubble. And he was basing off of capex, GDP, like the gap between GDP and earnings. He said it hasn't been like this since like the 90s, like right before the dot-com bubble. So inside that, how do you see the Fed impacting earnings? I know you said you said. Go ahead.
That doesn't impact earnings.
I've asked you that 3 times, and you keep saying it. There's no impact. What about what?
How do they?
How do they? Is that what you want to ask me?
No, it doesn't affect earnings.
What about the employment side? Because if they lower rates, people might hire, right? And that's definitely going to affect your earnings. If you're
yields would have to come down. Okay, for yields would have to come down for companies to invest and therefore bring on more people. It's that simple. It has to be long-term yields or medium-term yields. I'll even throw that in there, right? It can't be short-term rates alone, right? Short-term rates alone are not going to do it.
But okay, all right. So not the rates, but like you said, what about the quantitative tightening, quantitative easing, raising the reserve levels?
If you have that, then that's a different story, and you could have more investment.
Right. What do you think Warsh is going to do with that? Compared to Powell?
With QE and QT?
Just with
I don't think he's going to do anything with QE and QT. I think the only time he would come back to QE is if we have a crash, recession, COVID, some crisis.
Well, he's coming into a political situation right now, crisis as he comes in, as they're always tested. I think Powell came in during COVID, right?
I think that lowering rates right now would be good for sentiment in the stock market temporarily, but I don't know that it'll actually do much on the employment front. I mean, think about it. AI, if AI is really moving the needle on employment a lot, how can what the Fed do? How can what the Fed does actually have a greater impact than what we're seeing with AI? It can't, right? AI is a long-term technological trend, and it's far more important than what the Fed does, by lowering, interest rates by a quarter point. I mean, it's just short-term rates by a quarter point.
Well, I mean, yeah, but what if AI, like we said, we were talking earlier, what if it increases productivity and then we make the wrong move with our rate direction?
Okay, so I'm not looking at it from the perspective of the Fed. I'm looking at it from the perspective of investors. Okay. So I don't, I'm not putting myself in the shoes of Kevin Warsh and saying, well, AI is going to make me lower rates. I don't, I'm not interested in what Warsh is thinking, right? I'm interested in what's going to happen in markets, which are driven by AI, right? I'm interested in AI driving markets. I'm not interested in how AI drives the Fed, because I don't think the Fed lowering rates by a quarter basis point is all that relevant,
But if they raise them by a quarter basis point, that'd be pretty relevant, right? Not economically per se.
Sentiment.
Yeah.
Just sentiment.
Yeah, sentiment.
It's just sentiment.
Yeah. So
again, I don't believe that Kevin Warsh is the Wizard of Oz. I just don't believe he is.
Okay.
Or Powell.
I mean, he's been there before, so he has somewhat of a track record. He was very contrarian when what was that, 08?
Yeah.
He was on the board. So I mean, we'll see. Do you think he?
Well, I mean, it's useful to have. I mean, the Federal Reserve is a useful organization. You have to have it, and it has to be independent. No question about it, right? So my points are really more like about how much attention you should pay to it if you're an investor.
What about?
And there are people out there who pay far too much attention to the Fed than they should, and they should be looking at what's really driving markets and the underlying economy. And yes, AI is one of those things. We're on a long-term secular trend when it comes to technology, and it's important to be involved in that. We're on a somewhat cyclical, it's not even a trend, we're on a cycle having to do with oil prices, and that's related to what's going on in the Gulf. And so you have to be mindful of that too. But short-term interest rates, not as important as those things. Just not.
Got you. And people probably think that I just completely disagree with you. I'm not. I'm just bringing you the other side. What about international investors, right? Because there was a big thing with the Japan. You're talking about Japan's rate being zero, and there was a lot of alpha in between that Japan's rate and America's rate. People were trading stuff in dollars and yens. And what about that situation? You think that has any influence on earnings, right? Like the overseas companies' earnings.
What has influence on it? The Fed?
The American federal interest rate. Yeah, the Fed.
So it affects where. So what happens with, again, the difference is not so important, is not as important as the moves, right? And the moves aren't that important unless they're unexpected. So if you've got the Fed and the Bank of Japan sort of unexpectedly moving in different ways, that's going to affect cash flows, because cash flows are going to move in one direction or another, and it's going to affect the yen exchange rate in dollars. same thing if it's the ECB or whatnot. But if everything with central banks goes as expected, if everything is transparent and expected, there shouldn't be any unexpected moves in exchange rates.
Shouldn't be.
Not at all. Shouldn't be. That you can still have movement. I'm not saying they're frozen. There could still be movement, but that has a lot to do with, the underlying economics and not with necessarily with what, the central banks are doing. It's only when the central banks move in unexpected ways that you're going to start seeing some exchange rates move around a lot.
Got you. I mean, I'm sure you've noticed that for a while there, China was unloading a lot of American debt, right? Those things play into at certain interest rates, the debt that we're paying back.
So China's in an interesting situation, being a non-market economy, or semi-non-market or semi-market, quasi-market,
Emerging market. There you go.
Well, they have a semi-closed capital account, which means you can't just take money out. Above a certain level, you're restricted in terms of the money you can take out of the country.
It's gated, like private credit.
You can call it gated. Yeah, it's gated, right? If you're paying like for tuition or something, you can take that level of money out. But if you're trying to take out $25 million, that's a different story, right? And so in order to maintain a certain exchange rate, People's Bank of China maintains large currency reserves, right? And historically, a lot of it has been in US dollars. And in recent years, they have been lowering their US dollar holdings, which have been in the form of treasury bills and bonds, and instead buying gold. And so a lot of the price increase we saw in gold last year was because of Chinese purchases of gold.
A lot of central banks were buying gold, right?
Yeah, you're right. A lot of them were. And China, especially because what was going on was, they see a day. I'm skeptical about this, but I think they see a day when maybe there'll be an alternative to the US dollar that is somehow, quasi linked to gold, but a system that's run out of Beijing. So I think, and part of this, I mean, it's kind of, this is worth a whole nother podcast.
Keep talking.
To talk about whether the dollar is going to be overthrown.
Is it?
No, it's a little too but it's a little too complicated for this. I mean, we should allocate a whole podcast to that.
Okay, we'll get James to come on with us. He can talk about the debt as a part two. It'll be good. But I mean, go ahead. Talk a little bit more about just a little bit more. You have to get deep into it.
About that?
Maybe, just about so you said China's different. People hear all the time, or they have heard all the time. I know something I used to hear is like, China owns America. China owns America. And like you were saying, they own a lot of our
treasure. I used to say that about Japan too.
Why would people say that? Why do people think that? For the Main Street people listening who may not understand that, it's not quite as simple.
Why do people say that, or why it's not true?
Both.
Well, I mean, it's not true because there's a lot of America to own, and there's not enough wealth in China, and before that, Japan, in order to make that happen. Right now, it is true. I remember sitting in some offices in Los Angeles, and high up on some big tall buildings, and people would look out the building and look out the window and say, that tower, that tower, that tower, that tower, that tower, all owned by the Chinese. I remember them telling me that, right? But nevertheless, the the Chinese do not own a lot of America. So I think that's kind of, that's overblown, right? And they do own a lot of US dollar debt, but so do the Japanese, and so do the Saudis, and so does the UK, right? So there are a lot of foreign holders. And besides, you know who the biggest holder of US debt is?
US debt?
Of US Treasury debt. Who's the biggest holder?
Well, you say it's not China, and I feel like it's going to be something off the wall, Russia.
The US.
Oh yeah, we all know our biggest debt.
You and me and everybody else.
Yeah. True.
We all are the biggest holders of US Treasury debt. And as long as the US Treasury bond, 10-year Treasury bond, is the benchmark for all other debt, all other dollar-denominated debt, I don't think the US dollar can be overthrown, right? I just don't, right? As long as, because there's again, this is, great. It's true. It's a fiat currency, to use that Bitcoiny expression, right? But it's one that people have a lot of faith and trust in. You could say the same thing about gold, right? I mean, gold is just a rock, right? And yet people have a lot of faith in it. I mean, you can't say, okay, well, there's only so much gold in the world, two Olympic-sized swimming pools worth, and blah, 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 and blah, blah, blah. But still, it's just a rock, right? And Bitcoin is just like stuff you make up on a computer, right? So it's all about faith and sentiment.
Yep, and that's what people don't realize. Like, it's definitely about faith and sentiment that people can pay it back.
Value of something.
Yeah, that's what makes it. What will you pay me for this? And then eventually, if you're paying me too much for that, people stop paying you for that.
Right.
Applying demand.
But I think companies generating real earnings, real cash flows, those are, and if you're diversified, right? Because some of them will go down, right? I think is the best way to do it. It's the best way to grow your money is to invest in equities, invest in the stock market. And we won't get too much into equities here, but specifically, but because we're kind of doing macro today.
Yeah, we're keeping a high level macro. We're not getting down, but yeah, definitely the best way to, well, in my opinion, like you said, be diversified, have a long-term outlook, and your stuff should go up and to the right, And his diversification, as he mentioned, like, I don't know if Clem explained it or elaborate a little bit more on it, but that's including international, and something that's not particularly correlated with stocks. You want that inside your portfolio. I like having that inside my diversification. And then the certain stocks that you also own, like you can't just own a bunch of tech. That's not diversified. So,
well, okay.
Go ahead.
So, my question let me turn it as a question to you. If you had, well, maybe not. If you had half your portfolio in cash, why not have the other half in tech?
I mean,
let me broaden the question a little bit. Instead of having an all sector diversification, or all sector, all country diversification, or however you want to do it, why not like barbell or tribell or whatever your portfolio, and have
growth and value? Or you mean like?
I'm not talking about that. So you're bifurcating or trifurcating the market, right? You're thinking that you should own a little bit of everything, and I'm not saying that. What I'm saying is you should pick the things that you think are gonna do better, and not do the others just for sake of diversification, right? Don't do anything just for sake of diversification. Diversify it across things that all of which you think are going to do well.
Yeah, definitely. Yeah, you can't just go pick 30 stocks.
Have that safety blanket, right, of cash.
Right. I would say, because you did pose as a question, if I had 50% cash and then you say 50%, I'm guessing tech, like high beta stuff. Yeah, that's going to bring your beta is not going to be high. Well, it might be high. I don't know. I have to look at it, depending on the stock. But why not just go with?
Very high.
It could be, but I mean, it could go down a lot, right? If those stocks get hit really hard, even the cash, or is that 50% cash enough to just hold it? I know you said you're beating the market certain days with this. What about
three quarters of days?
Nice.
I beat the market.
What about if
500 with this strategy of like roughly half cash and half stocks, most of which are tech stocks. Got a few banks and some other things, but it's mostly tech.
Okay, so you got a little bit different. I was gonna say, why not just if you're going like the low beta of cash, why not have like the high beta of quantum computing? You know what I'm saying? Like if that's but you're still picking quality companies.
Yeah, well, I've got three criteria that I primarily use, right? Low short interest, low peg, forward peg, right? And my third one, which I've been using a lot more lately, Sharpe rate, 1 year total return Sharpe ratio. And what that gives you, the Sharpe ratio, gives you, like, if you got a line that's going like diagonally and isn't squiggling a lot, right? If it's going diagonally and not squiggling, that's a high Sharpe ratio. And I like that kind of stock. If it's not squiggling too much,
works well with your cash, right. Up to the right.
That has a high Sharpe ratio. So I like a high Sharpe ratio with a low peg. You know, low peg means that it's valued cheaply relative to growth prospects.
Price to earning growth. Yeah.
Peg, right? Price to earning growth. PE as the numerator, G as the denominator, right? and then short interest, because short interest tells you that people are betting against that stock, and I don't want to be long a stock that a lot of people are short.
I'm glad you brought up short interest, actually, and those are actually some great ways to think about, because like you said, if that Sharpe ratio is going up to right, that stock's moving the way you want it to move. Your price is growing into their earnings are going into your growth, like into the price. So you're actually going from growth into more of a value or balanced. You're getting earnings from that stock. And then, as you mentioned, what was the first thing you said, which was the last thing?
You can have on peg, you can have low pegs for traditional growth stocks. You can have low peg for traditional value stocks, for defensive, for cyclical. You can have low pegs. I mean, the peg ratio is designed for all industries, essentially. And so you can, some industries are going to have low PE, others are going to have high, but the ones that have high PE generally have high earnings, right? And low PE generally have low earnings growth. So this is a way, the peg ratio is a way of balancing those out. So I love to see a peg ratio below 1.
Yeah, not fully valued.
Right? If it's below 1.5, it's fine too. But you get above that, it gets a little, it gets scarier, right?
Right.
That's
yeah.
the peg.
Yeah, I was gonna say, but
short.
Go ahead.
Short interest. I like to see below 2, right? And preferably below 1.5 even, right? Sharpe ratio. I really love to see above 2. And really, I'd like to see above 1.7 or 1.8. 2 is good, and I've seen even better too recently. So, like 2.5, 3. But if you think about it, like, let's say you're trying to create a ratio of ratios.
A ratio of ratios.
Yeah.
All right.
I mean, take Sharpe and divide it by peg, and that's a pretty good ratio if you think about it. So you got something that's been rapidly rising, and yet it's still cheap relative to growth prospects.
Relative to the market.
If you take Sharp as the numerator and Peg as the denominator.
So you don't have people going out here and typing this stuff into their AI and destroying their portfolios.
So if you have Sharp over Peg, then what you really want to see is really want to see a number that's above 1.
Got that, Main Street?
Because a two Sharp can offset a 2 Peg.
They just balance out.
It can balance out. You see what I'm saying? So if it's above 1, you could have like a 3 balance off a 2, and then you have a ratio of the 2, which is 1.5. I like to have it above 1.
Combined.
At that ratio, if it's below 1, then not. So oftentimes I'll look at that together, and those two things together.
Nice. And what made you decide to add the Sharp ratio back into your criteria? You said you've been looking at more.
Well, one of the things when I was just using Peg and short interest, and occasionally I look at beta too, but beta is really an overall portfolio thing, right? Beta is an overall portfolio thing. But when I was looking at Peg and Sharp, I didn't have like a momentum element in there, right? And I felt like I really needed to have some kind of momentum element, even while having a valuation and a short interest element, because low Peg doesn't necessarily guarantee momentum, and neither does low short interest. Those are defensive oriented measures and not momentum. So I like to see, but I'm not like purely momentum, right? I don't want to see momentum at levels of like 7 Peg ratio, right? I don't want to see that.
You don't want the parabolic momentum?
Yeah, not if it's at 7, right? Not if it's at 7 Peg, I don't, right?
Not for investing. If you were trading,
right? So like, you know how Palantir was doing like super well for a long time,
23 and 24.
But its Peg got like way out of whack, and so even though the Sharp ratio was really good, its Peg was really it had a Peg of like 5 or 6, which is insane.
Yeah, that stock definitely came back down. We've seen a lot of that. We've seen a re-rating of this whole market. That's a great explanation, by the way, for everyone. And then with the short interest for the people who don't understand, like people who are betting against this stock to go down, if it actually goes up, you see them covering those shorts. So buying back
then
those
the stock can
positions.
go up,
Right.
Cover.
Right.
But I'm not in that game. Okay, that's a game people play, and I'm not in that game, right? I like to I want to avoid stocks that have high short ratios.
Right. No, I was just explaining people for someone that,
because I'm a long investor. I think life is too short to try to play games with shorts with
that's
short selling.
That's quite the limerick that you just put out there for us. Life is too short for short selling. It's like I didn't have time to write you a short story, so I wrote you a long one. Like Samuel Clem. That's the story of me. Wow, Clem. We've been on here for a while, so I think maybe Main Street will let you take a break from us. Is there anything else you want to leave with Main Street tonight? Anyone else?
I'm fine. It's getting late.
Yeah, we appreciate you all hopping on with us. What are y'all all doing with this podcast? Where can they find you, Clem? If anyone needs to find you or they want to hear, what have y'all been talking about lately over there?
Well, with Steve Davenport, we do Skeptics Guide to Investing. We do that. We do a couple of those episodes every 2 weeks. So I would encourage you to look at that. If you're on LinkedIn, I'm there, Clement Miller. You can find me there as well. And, I welcome anybody who wants to link to me, right? Become one of my connections and follow me. I sometimes do short little posts there about, whether they're, about investing or about geopolitics or even about regular politics, right? U.S. politics. I will, and there's as we've talked about, there's interrelationships among all three. And I often write about the intersection of those three.
Yep. And when he's not, teaching people over at Georgetown, I think you said the semester is over with over there right now.
Traveling.
Traveling. That's great stuff, Clem. So Skeptics Guide, everyone be sure to check out that podcast. You can find me on there if you go way back. I'm on there too from like last year. The Main Street Meets Wall Street podcast, Clem's been on there. There's a couple episodes on there where he talks about Bitcoin. Like I said, people will never want to invest in Bitcoin again after they listen to Clem talk about it. And yeah, just like so excited to and grateful for you for hopping on here to do this live one.
Okay. Thanks, Marcus.
Thanks, Clem. Peace out, Main Street.
Talk to you soon.
We'll talk to you soon.
Bye.
Bye. Woo. Yeah, this is running. We're over 2.5 hours into the war report, and there's been so much that's just happening that we have to look back and just take a second to recap everything. Like I said, this is a live, living document type event of what was happening then and where we're at now. The old playbook, like I said, is definitely broken, and there's a new structure being built right in front of us in real time. If you want to keep up with the actionable intelligence that we talk about in between these massive war reports, you need to go over to my YouTube channel, Marcus Sturtevant Sr., or you can go check out my LinkedIn, the Wall Street South Journal newsletter over there, or my LinkedIn profile, Marcus Sturtevant Sr. Also, you can check out Mr. Stephen Davenport or Mr. Clem Miller and their podcast as well, Skeptics Guide to Investing. If you're not interested in noise, if you just want results, that's where you go. That's what we're doing. That's what we're focused on. No rhetoric, no political points per se, like no slanted political points. Sometimes you can't ignore the outside, as it's one of the key points of the more economic, the more philosophy that I'm bringing out, the investing philosophy that works. So we're going to finish up this next part. We're going to jump in for a little while here. This is actually going to talk about, this is more with some user or some of your questions. People reached out to me that had questions. So we talk about, I always want to leave people on a positive note, even though we're sitting here talking about war happening and the economy and Americans and globally, people are feeling the pressure and the affordability is really becoming a thing for people all around the world. So here we're just sitting back and we're going to take a second and answer some of the questions. Some of them include tips for your 401k. Those are some of the questions that were asked. A lot of where do I just start questions. So we dive into that. And then also what to do with these record levels and earnings. What should I do when the S&P hits 7,500 or the Dow Jones hits 50K, or international markets, the Kospi, or, something like that is just going, wow, what do we do? How do we invest? So sit back, enjoy. I know it's been a long one. I appreciate you. It's a little bit more to come, but this is the kind of work we have to do, Main Street. Main Street meets Wall Street. Thanks. Here comes the next part. Check it out. Oh, and if you haven't hit subscribe or like, go ahead and take a second and do that right now. Share this with someone you love. Share this with someone who needs to hear it. Here we go with the final segment for this war report. We're saying 94% collapse in tanker transits. This is the Hormuz. Geopolitical frictions become a structural tax on every ledger on Main Street. When you pay more at the pump, you aren't just paying for oil, where your assets end up and who gets control of it. And this is what people don't realize either. Your money is going to go somewhere. Maybe it's going to go to someone you don't want. Maybe it ends up going to the state. Maybe it goes to the people you actually wanted to go to. Maybe it goes to debtors. That's not the people you want to go to. What's up, Main Street? Welcome to the Global Square. Maybe 9, 10, 11 p.m., a.m., depending on where you're listening to. I'm down here in Charlotte. The Wall Street is south. Whether you're winding down your day or waking up in Tokyo or so, the scoreboard never turns off. Before we get into the math, I want to take a moment to acknowledge the friction we're all feeling. We look at the headlines and see growth, but we look at our receipts and see inflation. We hear about new records, yet we feel a growing sense of instability. This isn't a coincidence. It's the gap between the building blocks of finance and the mechanical reality of the world we live in. Second, we're going to take a look at it. The bottleneck, Strait of Hormuz. Give me a second, we'll pull it up. But this isn't theory, it's a bottleneck. We're saying 94% collapse in tanker transits. This is the Hormuz paradox, where geopolitical frictions become a structural tax on every ledger on Main Street. When you pay more at the pump, you aren't just paying for oil, you're paying for the friction of a world in transition. But tonight, we're moving beyond the building blocks. We're moving past the dating phase of investing. And to the 1,300 professionals who subscribe to the Wall Street South Journal, you aren't here for a tip. You're here for a system. Also, to the people listening to the Main Street Meets Wall Street podcast, tonight we're performing an autopsy on the advice that was made in the headlines, from the stuff I quoted with Business Insider all the way to the things I reviewed with the Wall Street Journal. Show you how to execute when the stakes are high. When the stakes are this high. Let's start with the dual reality of a winner and a milestone. Levels. Let's take a look at our screen here. And we see right here, this is the Strait of Hormuz, and this is actual live traffic. But what you notice is there's not much traffic. Like I said, 94% of this is actually closed off right now. So while you see these things, while you see these tankers sitting here, this is the little part that's holding everything up. Right around here, we've had some tankers come through closer on this side, but over here, the Iranian side, we're not seeing much movement, or we're not seeing much movement at all. And this is putting pressure on oil, like I said in the opening, and oil just presses down everyone. How are you feeling, Main Street? Are you feeling the pressure at the pump? I know gas was around $4.50 a gallon nationally. I did a deep dive into that stuff on a recent video I just released this weekend. If anyone wants to take a look, just go back and check it out on my YouTube channel. And also did a bonus podcast edition. Today, like I said, we're just looking. Look at the Strait of Hormuz. Look at where we're at. Look at how we sit right now. Nothing's moving through. And these things aren't like, this isn't just a pipeline that you can turn on and off with just exceptional speed. It takes time. There's been damage to the infrastructure over there. There's been damage to relations over there. We have President Trump, who is going to China tomorrow. He's flying over to talk to President Xi. President Xi, hopefully I'm sure they'll talk about the Iranian war. But I think one of the things that the president had mentioned, President Trump, is that he didn't want ongoing conflict. So we see today where Iran sent back a response to our 14-point peace proposal. And the president's response was that it was unacceptable. So there's not any movement there, but it does seem like both sides want to keep the ceasefire, quote unquote ceasefire. There have been shots fired. Ceasefire, they want the ceasefire to hold. We know that, like I said, this is a major economic cost to everyone on both sides and globally. So that's another reason why this meeting with President Xi could be so important. When you go over to China and you have Trump over there, and we'll see some of the concessions maybe they're making. I think I heard one of the speeches that one of the things that may be a talking point is President Xi wants Trump it's the way that we frame Taiwan's independence. We don't particularly support it or verbalize, or we don't deny it. I think Xi wants to push Trump closer to denying it. But that's just the geopolitical things. And I bring this up because as we look at the Strait of Hormuz here, me and Mr. Stephen Davenport last month sat back and we were talking about the possibility of a closure of Strait of Taiwan. And that would actually not have as much of an impact on oil as it would into the actual AI trade and chips, because a lot of chips come from Taiwan and Taiwan semi. So when you're looking at chips and you're looking at going into places over there, if there was, and say China's looking at this as a playbook for possible U.S. conflicts or how U.S. would respond, but that's at this point that's just conjecture. We haven't seen anything new that points to China trying to take control of Taiwan, anything more than we've seen before. So if you want to know why your gas prices are sitting, $4.50 a gallon, depending on where you're at, it's because this stuff right here is not moving. And that's a very tiny place right there, just a couple miles wide and not very long, like 20, 21 miles wide long. So you sit there, you look at Strait of Hormuz, you see all the red stuff not moving, oil tankers not moving. So just hold on. I mentioned in the last video as well that you have oil futures that are pointing out for higher for longer. Oil this morning and earlier today was trading, right about $100, above $100, depending if it was Brent or West Texas Intermediary WTI. So that's the oil. Today we'll be talking about some of the items that have actually come up from the media. So questions, last video I was talking about questions that I've gotten from listeners and viewers. And once again, I thank you. I appreciate everyone for listening and viewing solo on this video as well. Thanks for listening and viewing. But we're talking about Intel, right? Let's say, not just Intel, let's say we're past the building blocks. People want to know what they should do, where they should go. And you've established your emergency fund. Your emergency fund is fully funded. You've gotten your debt under control or hopefully completely eliminated. But you don't have to have your debt completely eliminated before you start investing. But let's say it's in the process. You've looked at your retirement accounts, as we mentioned before. You got those optimized. Perhaps you're ready to start making some trades yourself, right? Let's say you ventured into something like Intel. So I'm going to share my screen here again. And let's say we went to Intel. Intel stock just hit a record high again, right? Intel's been a crazy, crazy move inside of Intel here lately. I was speaking with Samuel Brink. Shout out to Sam, Business Insider. And one of the things that we were talking about on the morning of Intel's release, that's when it actually accelerated a little bit more, was how crazy the move was, parabolic the move was. I'm sure right here, just show you the screen here. This is the article where we were talking about Intel here. So just scroll down, right? So, and this article was back in 2 weeks ago. It's set up there 2 weeks ago. And it was on Friday. Samuel reached out, gave him a call, sent him some information. But Intel stock soared. So say you had invested in the stock, and Intel was like $20 a year ago before the U.S. government got involved in. So let's say you invested in this stock or any stock kind of similar to it, because we've had crazy runs in the stock market here. Parabolic runs, just historical bull market going on right now. So let's say you invest inside of Intel and you're still in there, right? And you've seen this stock go from $20 to now, I think today it was like over $132 a share, right? So you just see Intel stocks continue to grow. You're looking at this revenue. And once again, this is not investment advice. This is not for anyone to just go out and say, I'm going to go buy Intel or I'm going to go buy whatever kind of stock because I saw it on this video. This is a literal example we're going to walk to and just talk through some things. Intel is a great example for what could happen if you have a stock that goes up a lot. Because that's what we're seeing right now. We're seeing stocks that are going parabolic. And we've seen it for the last few years. So here, Marcus Sturm, Senior SME Managing Principal at the ABC Squared. Like I said, wasn't surprised by Intel's smash earnings. Intel was set up for success. It appears that, they are the American first chip maker right now. We've seen huge investments into their company over the last few years, even beginning with the CHIPS Act back under President Biden administration. They've had plenty of hiccups. Oh my goodness, they've had so many hiccups. And now we're seeing new leadership come to fruition, right? So if you had an investment thesis, say you thought that Intel was going to go up, or let's say that you thought that Google last year was going to go up. There's stocks like that this year that you may invest in, but they can explode and you could have these type of oversized moves. IBM, there are just a lot of stocks that had these type of moves in the last year. NVIDIA is going crazy again. It's back to, but Google's pressing NVIDIA, for the largest company in the world. But like I said, you look here and it's just talking about what the CEO said, actually, next wave AI, closer intelligence to the end user, and they use foundational models, inference for agentic AI. So when they say agentic AI, that's like an AI agent that can do things for you. This AI is doing more reasoning and not just coming to conclusions, but it's helping you find solutions. So people want to see the return on investment side AI. And this shift, as you said, is significantly increasing the need for Intel CPU and wafers and advanced packaging offers. So Intel has slid right into a perfect spot at this point to take advantage of this movement where the government has, and I think it's mentioned in this article, maybe it's not, but the government made an investment in Intel last year. We've seen other companies make investments in Intel. What pushed Intel higher to as recently as Friday was an announcement with Apple. They're going to do more work with Apple, which was also a call in an article from last year. I'm not going to pull that up because that was last year, but some potential partners for Intel, Apple or NVIDIA, things that just made sense. But at the time, Intel was in a position where it was really a dumpster fire inside that company. People didn't really want to take it. People didn't want to invest inside that company or buy out that company. But the U.S. government invested in it. NVIDIA also invested inside Intel, and Benzinga's made billions of dollars from the Intel investment since NVIDIA's investment inside of them. So that's another thing with NVIDIA. They invest inside of a lot of these companies. So it comes back to them. Some say it's circular, but when you see returns like this, it's just kind of the nature of what it is. Once again, let's say that you have invested inside of Intel, right? And now here you are, you sit with this Intel stock. It's ran. Maybe you've even moved. Maybe you were just, you've moved to a high net worth individual. Times have changed and you just increased your net worth. Things change when that happens, right? Once you get to these points, people start worrying about different things and different perspectives. Another thing was a Wall Street Journal article that I was featured in where we talked about high net worth individuals. How do they manage their wealth? So let's say you happen to make a lot of money in Intel. And this doesn't even have to be, shout out to Lauren. Nowosky. But this doesn't even have to be whether or not you just became a high net worth individual. If you're gaining, and here's some things for high net worth individuals, $1 million. But these are things, right? You start looking at preserving your wealth and legacy, and sometimes more complex strategies. But taxes are huge. Estate planning, people want to know where their money's going, right? They want to know, they want control, they want protection, because once you start increasing your net worth, people somehow find magical ways to see you, right? So people, high net worth individuals, people who are coming to windfalls of money. And I went into that a little bit in the last article or last video that I was on, and where we were talking about the Broke series from ESPN's 30 for 30. In that series, we were speaking where it was looking back, and that came out in 2009. So it was 17 years, and it coincided with this bull market. When you have that where you have that where they match up together, 17-year bull market and the 17 years after broke, they have my portfolio in there. It preached diversity pretty much, but you can go back and check out that video if you like. Another thing, so like I said here, like I told the Wall Street Journal, both Wall Street and Main Street seem to be coming together to take more look at what they own and what they're actually investing in. That was the thing that we've noticed converge. We see people coming together just to see, what do I actually own, especially with this private credit that we're hearing lately and all the worries in private credit. We've seen so many worries inside private credit and the illiquidity of private credit. I actually have a few videos on private credit on the channel as well, if you want to check it out. Private credit, private equity. But even tying back to that 2009 ESPN 30 for 30 Broke series, you have the private credit, which was suggested inside there, because private credit serves a purpose. Private credit serves the purpose of, in theory, it should be a diversifying element inside of your portfolio. It should also help with sustained returns, as they're usually the higher risk for higher returns. One thing that we did notice is that inside of that portfolio, the private credit performed not as well as the stock market. But like I said, the 17-year bull run in the stock market has been historical, but it did provide steady income. Other things inside their portfolio were real estate and also alternatives. So we've seen gold and things like that have great returns here lately. But like I said, people have been looking at where they're invested. That's been a big move that we've seen. We've seen people go back and look into where they're invested. And also, what a lot of people don't realize is that you may be a Henry, right? So you may be a high earner, but not rich yet. And you're in the accumulation phase. You don't know what to do. So this may be the stage you're in, maybe with some stock. Maybe you work at Intel. You're working on these IPOs. They're about to come out. We just saw where one of those companies allowed their employees to sell a lot of their stocks pre-IPO. So some of those folks maybe, a lot of tech companies and startup companies have people who they gain a lot of money from company stocks, or a lot of people don't realize that, like, if you have RSUs that come into your compensation plan, that those actually count. Those taxable income to you as well. So it's just a lot of different things that can increase your income, and there are different things that you can move about with it. Let's see what else we were talking about. So it just goes in some of the different ways. We were talking with the Wall Street Journal here, tax loss harvesting. Never really a fan of playing on, losing money or in taxes, but that does happen. And that's definitely a strategy that can work. So trust, one big thing about trust is trust really give you control. People are really concerned about control, where things are going, where they're going to go. The trust will help you with that. Real estate, like I said, so even back then, real estate was mentioned, but now real estate's always been something that helps with your portfolio, as you see, diversify inside your portfolio. And then charitable giving. And that's another thing, the Trump baby accounts that just came out. So, and people have 529s. There are all kinds of accounts that you can make donations into. One thing with the Trump accounts that just came out, and I'm only speaking of them again now because they're about to go live in a couple months, and they just spoke on the possible inclusion of individual stocks where people can give them away inside of something like a donor advisor fund. So if you have stocks in there, and then they could give them away, and the person giving them away will receive a tax benefit. The person who gets them probably will catch them on a step-up basis, so their cost basis won't be as much, even though it'll be a lot by the time they're 18. But hopefully it grows. But those accounts were originally set up to track U.S. index funds, so the inclusion of individual stocks, and that part, the Trump baby accounts, were signed into law, so that's codified. So that will require a little bit of legalese and movement to establish that, maybe an executive order or something. But if they are allowed to put individual stocks, charitable giving, and donations. And then once again, so one of the biggest concerns with estates planning, taxes, where your assets end up and who gets control of it. And this is what people don't realize either. Your money is going to go somewhere. Maybe it's going to go to someone you don't want. Maybe it ends up going to the state. Maybe it goes to the people you actually wanted to go to. Maybe it goes to debtors. That's not the people you want to go to. All that's when you set up your accounts, make sure you have all this stuff planned out in advance, especially if you're coming into new wealth, you're having life events. Maybe you just had a baby, or maybe you just changed jobs, or maybe you just lost a job. There's a lot of different situations where you need to reevaluate your personal financial situation. So like I said, and if you've gone into high net worth individual, or if you've stepped up to a higher tax basis, this is just something that you want to look at and establish. So, and then once again, strategic estate planning. So financial advisor, like myself, financial advisor. Then you also want to have an estate lawyer for that, attorney for that. So you get a greater number inside there. If you have a business, that might help you if you want to make sure that you have your business make sure you have your business transfer plan for once you pass away. Then if you want to transfer wealth across multiple generations, high taxation, financial and other property information out in the public eye, because that's a big thing. If stuff goes through probate, or if you have it just like in general will, people can see like what you own, who you owe debt to, et cetera, et cetera. But if you have it in trust, that kind of keeps stuff private. So people do actually want trust sometimes just for the private part of it. And then contributing wealth to a charity or property. People want to contribute to contribute their wealth to a particular fund or a particular cause, then that's one thing you can do with trust as well. Big thing to think about trust also is that it can be revocable or irrevocable. So irrevocable means you can't change it once you set it up. It goes into effect on some type of event. So let's say it goes into effect when a person passes away. When that person passes away, whatever's inside that trust happens. So if you set up an irrevocable trust and your life situation changes, like say you're married and you're no longer married to that person, it's going to be, few things are impossible, but it'll be really hard to change it, right? Whereas if you have it set up as a revocable trust, you can go in there and make changes to it. The person who's in charge of the trust. So, and then another thing, just think about what you trust. So you have your trustor, your trustee, and your grantor inside your trust. There's different things to think about. Who's getting it, who's giving it, and who's in charge of making sure it goes where it's supposed to go. So like I said, you can have your family trust, goes with strategic gifting. And a big thing that people, let's say here for a second, people initially were setting up trust because of this reason right here, the lifetime exemption limit, right? It was like $1.5 million, $3 million, like less than a decade ago, but now it's up like 15 million and 30 million for filing, married filing jointly. So that number's increased a lot. So if that was your reason, maybe you don't need trust. But if you're at that level of income, then you probably do need some type of trust. If you have something, if you need to protect those type of savings or wealth that you've accumulated through your life. And then business succession plan, like I was saying. So different standards, just different life. There was a time earlier where the high net worth individuals were collecting more jewelry and art and cars and just trying to diverse outside the stock market. But we've seen here lately that the stock market has come back really strong. We see this K-shaped economy where the top percentage, and when I say top percentage, I just mean like income earning wise. Not all people are equal, in my opinion. Please let's not go down that road. I digress. But money doesn't make you a better person. Usually makes people worse, actually. But that's a whole nother story. So, and then, do high net worth individuals need different financial advisors? Sometimes, yeah. I mean, probably not robo-advisor. I wouldn't advise a robo-advisor unless you major income in investing. But yeah, you probably need someone who's going to spend a little bit more time paying attention to what you do, to your investments, and also to help you with the mindset that when you may want to sell or you may want to buy, when you should be doing vice versa. You should be buying, you should be selling. And so it just depends. But as your assets increase, it can decrease your returns. So once again, remember, so we got this intel. Maybe we jumped into a high net worth level. Like I said, we're looking at articles that I've already talked about, articles already been included in my actual quotes, because people sometimes want to know, like, what do I think? What they say, maybe you talking platitudes, I think is what a guy told me. And I was just like, if you ever want to see what I think about a subject, it's on the internet probably, especially if it's like a financial subject. It's out there. I've been quoting on a lot of things. So now we'll look at what happens, right, as your financial priorities grow. And this is an article by Chris Adams. Shout out to Chris Adams, edited by Jenna Cavler Whedon. Sorry if I said your name wrong, Jenna. go banking rate. So inside this article, we just talk about, and this is something, the same thing that we were talking about earlier. And there are other experts quoting inside. I hate even saying that, call myself an expert. There are other people quoted inside of this article. So I won't speak on what they said, but one thing is you definitely go from, it says I can't say definitely, but this is there. You go from defense to offense, right? Lower incomes, your priorities are stability. But as income grows, your priority must flip. And this isn't me. This is another advisor speaking. Once again, I'm big on tax, so I'm talking about taxes. Just make sure that the added taxes, they become more concerns. You increase your earning, you see more. And there are a couple of different things you need to know, right? Does this push you into a new tax bracket? If you're trying to get into a Roth, can you still make your Roth conversion? Income push you into different avenues to save, or maybe there's a different strategy that you need to take. And then even estate planning. So once again, it goes back, and this was Brandon Gregg right here. G's Greg, total in his name. And he's said the more income you have, the higher the legacy you may end up building as assets grow. Plan accordingly to do estate plans to protect your assets and legacy for now and in the future. So it's just, the same things as you grow. So now you've had this Intel stock that's grown, and this was March. That Wall Street Journal article was January. So as we see these things continue to grow, and like I said, we've seen the Intel stock. Maybe you had Intel, now you've grown. A lot of Americans have been worried a lot about in this protection phase. We see a lot of people who've grown. Another thing that helped with the income was the one big beautiful Bill Act. So we'll take a second. It's supposed to be larger tax returns for people. I was actually quoted in Economic Times where we were speaking about this. Trump's big beautiful bill. What could it mean for your tax refund? We're through tax season, but let's say you had a great return with your stock picks. Because remember, we're past the basic building blocks. You had great return with your stock picks. Your emergency fund is on. It's just running. It's great. It's set up. It's established, and these investments are growing, right? Some of the things people were looking at, the child tax credit, you got to excuse these ads that are popping up. Once again, there are other people quoted here, tax bracket updates right here. Quoted, most Americans are expected to see some level of their taxes being cut, which means that you will get a tax refund or a larger tax refund, but not everyone will receive a tax refund, even if their taxes are lower. And I think that's something that we saw a lot of that actually played out. People were the tax return. So also tax breaks, so they can be regressive, meaning people with lower tax brackets may not benefit as much. And, the bill adds structure. I was talking with Kevin Thompson, who's an enrolled agent, EA, dug real deep into the bill as well. That episode, part 1, was out this week. So if you want to hear more about that, but he goes deep into it. But like I said, the bill mostly it adds structure because there were a lot of things inside the bill as far as with the taxes, whether or not they were going to be extended. And, depending on what side of the aisle you're on, you have people saying it's going to be the largest tax hike in American history, or it's going to be the largest tax cut in American history. So depending on your view, it was either going to be the largest tax increase or the largest tax. So either the largest tax hike or largest tax cut in history. Just depends on your point of view, I guess your political point of view. The numbers don't lie, though. Another thing that we noticed is that a lot of Americans were not seeing the amount of returns that they were expecting from their 401ks, from their tax refunds this year. That was a big thing, especially based on maybe where we saw and where people were expected. So you've grown your income. Maybe you've got the basics and the building blocks down. Now maybe you've moved on to the point where you are looking to lock in the gains. Maybe you've moved to the high net worth situation where we are protecting your gains. Have the tax cuts, tax breaks, whatever it may be. Now we're sitting here with the stock market at all-time highs, right? S&P just closed above 74 for the first time ever. Back in February, the Dow had just hit over 50K. 6 things to do with your money right after it hit 50K. That was a question that was asked by the media, like I said. So we're going back and just looking at different questions and things that we've talked about already. One is stay steady. That all this isn't my advice. This is this is Taylor Kavor. I won't name everyone, but just know that I'll just mention it when it is mine. Another is to start investing, right? So stay steady. So keep investing. Don't make emotional decisions. And if you haven't already started investing, it's suggested here by Miss Melanie Mousson that you start investing. I said, you may want to consider locking in some gains at those levels. So at those levels, like do not blink at the 50K because the market bounces around. The market's been bouncing around, but the market really bounces when it hits levels like that. Sometimes you see like 30, 40, 50,000. Once it hit it, it came back down as resistance. It'll eventually get back through that 50,000, but it'll bounce up. So you have to lock in the gains. if you have gains in the market, maybe look to lock them in. And I don't mean take all your money out of the market. I mean lock them in perhaps by rebalancing. You can sell some of those winners and keep the profits, or move on and reinvest in some other positions. That's some of the ways, because this market's presented a lot of opportunities since we've had the start of the war, where people can find other opportunities to invest. It doesn't just have to be AI or the Mag 7 or per se, even though we've seen a lot of returns from 5 companies. Then you say protect your assets, right? Once again, protection. As your wealth grows and as your life grows, you want to continue to protect those assets. That's something big that people look for. And then diversifying your assets, which just ties back to what we mentioned earlier. Even at 50K level, we've seen a lot of concentration inside the returns here, but there's concentration risk as well. If one of these companies misses earnings or pulls back capital expenditure, something to that effect, we can see a swift move back down to the other side. And then consider your overall playbook, of course. So just think about where you're at and where you're at in life, where you're at with your budget, your investments. Where do you see yourself going? Where do you see yourself at the end? You got to begin with the end in mind. So, and once again, like I said, don't blink. Do not blink. The 50K level is one that the market's bouncing around. Same thing when it was at 7. I don't know if people remember, we went back down and we hung around in the high 6s for a while. We even got down to the low 6s before we ran back through 7,000 here recently. We'll see if that holds, but that's just another thing for investors to look at. So with the 50K, we've seen you grow, we've seen your investments grow, and now you've reached this 50K level. Another thing that investors have been concerned about lately is having enough money to retire, in different ways to do it once you are actually retired. And once you've reached your level of retirement, how can you go about maintaining your level of your standard of living that you've already established, exceeding it, meeting the goals that you worked so hard to reach? Like, how can we do this as people in general? Because we don't work hard to not be able to enjoy the fruits of our labor. That's not why we work. I think I'll add to the end of this video, we'll add the building blocks. I keep mentioning that people should already be past the building blocks. Not should be, but maybe if you're already past the building blocks and you're watching this. But if you're not past the building blocks, at the end of this, we'll have the building blocks that you should check out. It's about 20 minutes. You can just check out and go see. And that's where we talk about emergency funds, the purpose of emergency funds, importance of emergency funds. Also, you got to have balance, and you got to have budgets. You got to have a mindset shift. You got to figure out a way to eliminate debt before you even get to this stuff that we're talking about with these investments. Before you even worry about the Dow Jones hitting 50K, make sure those retirement accounts are set up the proper way, pre-tax versus after tax. You're contributing up to the match. So just things like that. These are different things that we need to establish. And like I said, I'll put that at the end of this video as a long continuation of this video, just so people, in case you want a refresher on the building blocks, if you want to go back and take a look just to see where we're at with the building blocks. All right. So once again, here we are. We've accumulated this. We've made this move with Intel or whatever stock it was that you did that grew this windfall of cash. And once again, it could be a growth in wealth that you just didn't expect, and now you're not prepared to do anything with it. So here is another article from last year, some strategies to maximize your 401k balance. It's actually another article, like I said, that I'm doing look backs for articles that I was actually quoted in. This one right here was in U.S. News and Money. Well, 10 strategies to maximize your 401k balance. And once again, this is mine. We're all about actionable steps. So I want to give you some actionable things that you can take a look at. People always ask me, like, what can we actually do? These are 10 things that you can look at doing. Not all my suggestions, and everyone is at a different stage, different place in retirement or coming to retirement, but here are some things that you can look at. And we'll just start, some of the big key takeaways. Know your vesting schedule before you leave your job. That moved a little quick. Uninvested funds may be forfeited. Max out your contributions. Check out, see what the Roth looks like for tax-free income and estate planning. Watch the expense ratio of funds your own in the 401k. I think that was a point I made, with the fees, and diversify investments by factors including asset class, sector, and tax treatment. So let's just take a look at some of these ways here. And you see right here, 10 ways to maximize your 401k. Save more than your employee's automatic savings rate. So a lot of 401k plans, when you go in and set them up, they'll start you at a level, but they'll automatically increase it, maybe 1% every year. But this is saying, right, so let's just go ahead and start at higher than that level. And in general, like I said, and I put this in the last video, if you want to find a baseline 10 to 15% total, this is what you can save. That's a good level that you can start at, begin. And a thing that you notice is once you start saving, and it's going to be like working out. So you'll feel the pain at first, but once you get through that initial pain, you'll see the growth, and you'll want to do more. You'll want to save more. You'll want to invest more. It's just cause and effect. Get that 401k match, stay until you're fully vested. So what that means is sometimes when you work at a place, you have to work for like a year before maybe the 401k match kicks in. That's not vested, but that's to get the match. Or maybe you have to work a year to get whatever you put into your 401k. And sometimes those things will come in to be fully vested. Maybe it'll take 5 years. So you'll get 20% of it the first year, 20 more percent of it the second year, which would be 40%, 20% more the third year, which would be 60%, 20% more the fourth year, 80%. And then by the fifth year, it'll be 100% fully vested. And that means whenever, even if you leave that place, the money that you've put in the vested amount is yours to take. If you're not vested or fully vested, you lose some of those benefits. Maximize your tax break. So that's how much you're going to put in pre-tax versus after tax. And then as far as when you're retiring, make sure that you have it set up so you're not paying Uncle Sam a huge amount of money in taxes as soon as you retire. Diversify with the Roth 401k. If you put it into a Roth, ideally, in theory, not even in theory, and ideally, if you put it in a Roth, you leave it in there until after age 59 and a half, and you've left it in there for the expected amount of time, over 5 years generally, you can take the earnings out, growth-free or tax-free. With your contribution amount, whatever you contribute in there, you can always take that out. But you will pay a penalty. You may pay well, if you're already in retirement age, you won't pay a penalty for early withdrawal, but you will pay taxes. But that Roth, that's one of the good things about Roth is you can potentially set up where the money you put in, but you'll pay taxes when you put the money in converting it to Roth, but that money could potentially grow tax-free. It will grow tax-free. Don't cash out early. Put that 401k money or whatever kind of retirement account you have, put that stuff away and forget you have it. Just let it grow. Don't take out money if you don't have to. Sometimes you have to take out money. Sometimes there are good reasons that don't cash it out though. Cashing out means taking it all the way out. But sometimes there are good reasons to take out money. Sometimes life hits you with something hard, extremely hard. Sometimes you are buying a house and you can use your 401k as part of a down payment, but that's as a loan that you can pay back. You want to pay back, take the loan from yourself. You hear people all the time talking about taking loans from themselves or being their own bank, but the 401k is kind of one of those things that you can do and use that for your down payment as a home. A rollover without fees. So yeah, some of these places when you do a rollover, if you have an old 401k and you go into a new account, a new provider, they may charge you a fee to do it. Minimize fees. So like I said, and I'll scroll down and show you, but that's where I was talking about these 401k plans. People think my 401k, I don't have any fees inside there, but if you look at the actual funds, there's a fee. Diversify your assets, and then remember that your required minimum distribution is going to come one day. Another thing with Roth, if you put it inside Roth, it helps with the required minimum distributions. You control it more. Like I was saying in the beginning, you got 3% generally with most 401k plans, but sometimes they're different. And if you can do more than that, especially to start setting yourself up, obviously financial advisors, find one, especially from the estate planning perspective, get your 401k match. Stay into your vested, so leaving early. And I'm just not going to reiterate everything I said. Maximize your tax breaks, but I do want to point out the part where I was quoted. Then you have tax breaks, so like the government's way of telling us all what is important for society. That's not me. That's a management coach over at TIA in Charlotte. Diversify within Roth. Okay, was a suggestion to don't cash out early. And then here I do remember, so minimize fees. Find investment options with low costs. Stocks do not have fees. But ETFs, mutual funds, and the custodians who hold your funds do. Read the fine print. And then diversify your assets. I said a lot of Americans are worried about running out of money. That's one of the things that a lot of people seem to be struggling with. I don't know if they'll have enough in retirement, but you take these moves and they'll help with some of the volatility. So those are some actionable steps that you can take right there, 10 actionable steps. And of course, there are plenty more that you could take. Let's scroll back up to the top. Just want to read that list of 10 again. So once again, 10 ways to maximize your 401k account. Save more than your employer's automatic savings rate. Get a 401k match. Stay into your vested. Maximize your tax break. Diversify with a Roth. Okay. Don't cash out early. Roll over without fees. Minimize fees. Diversify your assets. And remember required minimum distributions. So, and these are things that you can take a look at this stuff today and see where you're at, where you fall, where you are in this whole spectrum. So actionable steps right there. Just remember different things that you can do. Another thing that we've been talking about, like I said, people worry about retiring, not having enough to retire. People have been worried about the debt, big concerns around the debt here lately, whether we can service this debt. The debt recently reached 39 trillion, but that's increasing about every 150 days, add another trillion or so. Then with the debt is the servicing of the debt. That's about $160 trillion. People aren't really taking into account how much that cost is going to trickle down to Main Street. So when it comes to debt and how much we're paying for the debt, that can have an effect. I want to look at this Economic Times article. What were we talking about? The one big, beautiful bill? Yeah, so like I said, this session, we're talking about if you got this income, just trying to answer questions and user questions that I'm getting from journalists. So I'm responding to those questions as well, just saying if you were to come into a influx of income, different things, different moves, different strategies to do. And we're basing it off of, and once again, these are hypotheticals, but I was quoted featured in an article of Intel. So say you were investing in Intel, which just finished right under $130 a day in closing and trading, and you invest in Intel at $20 or something like that, because that was realistic where it was, or even if you got it at the beginning of last month when it was higher than $20, but it still had a ridiculous move to the upside. So we've talked about if you've got that money and you start to move up into a high net worth or higher net worth, because if you invest enough in Intel or even a little bit, you may have changed the tax bracket. Talked about tax implications a little bit as far as that goes, how high net worth individuals want to protect what they have and worry about taxes. But this stuff always also plays down into us on Main Street. It's not just for the quote unquote wealthy or rich people. So once again, we're all about actionable steps. This is an article where we're talking about the ways that retirees should adjust their investments amid the Iran war. We look here and we see this was just a few weeks ago, back in April. This was written by Chris Adams. Big shout out to Chris. Chris does some good stuff writing. So then it's, very sensitive, volatile area that has something to do with the war, i.e. oil or something like that right now, or something that could be disrupted. You may look at ways to lower your risk. Once again, these aren't all things that I've as long as with lowering the risk in your portfolio, maybe you should look to move into some income producing investments. That may be a good decision. Even in retirement, you still need stuff that produces income. You want maybe a low cost ETF or maybe even an index. One of the good ways to have some skin in the games if you're so worried about everything inside the market right now. So you don't have single stock exposure. You can maybe smooth it out some with an ETF or a fund or mutual fund that takes the total market. So it goes up and it goes down. You'll have to deal with that volatility of a single stock or a single sector, unless you're investing in a single sector ETF or a single sector index fund. But just a general overall fund that captures most of the market can help with that, especially if you're retired. Don't rush into quick decisions. This is another advisor's advice. So it's important for retirees not to make any hasty decisions when it comes to their investments. And that goes for not just retirees. That goes for anyone investing. These are hard-earned money. This is your hard-earned money. Take a second before you spend it, right? Think before you spend it. We're not saying don't spend money. Of course, you work to spend it. You work and you use money as the tool that's meant to be used for. So for someone who's already retired and drawing on their savings, the concern is a little different than for the younger investors. Exactly. And that's Taylor. So then another option we see, you consider locking in gains or consider keeping extra cash outside of your investments. So why would you want to keep extra cash outside of your investments? There are a few reasons why you want to consider keeping cash outside of your investments. As they point out here, having some cash outside of investments, especially for a retiree or someone close to retirement, provides a little bit of breather room. One of the big things, as I've mentioned a lot of times today, is that people who are close to retire or are retired are worried about running out of money or not having enough. So having cash, even though you may have a fixed source of income coming in, a little extra cash or outside cash can provide the breathing room that some people are looking for and just help them with their SWAN, sleep well at night plan. That's what we want to help you create, a sleep well at night plan over here at the ABC Squared. But we want people to understand this, even in the wartime that we have going on, because we just saw it from the end of March until now. There were opportunities to buy in. There are probably still opportunities to buy as the market goes higher, but the market will come back down again. But it'll come back up again. That's just kind of the nature of the market. That's why markets work better when you focus on time inside the markets, time in the market versus timing the market or trying to time the market. And then once again, lock in some gains. Like no one's ever went broke taking profits unless they just spin it all. That's a whole nother part of it. But if you weather storms and you need cash, you can lock in some of the gains from this recent rally, right? Not all, but some trim. Not all. I'm not saying get out of the market. I'm never going to really tell anyone to get out of the market. Let's have a deeper conversation if you think you need to just get completely out of the market. But as I mentioned earlier, you can rotate into other sectors. There'll be opportunities to buy some stuff that you thought was maybe too expensive before. But trimming some of your winners and guaranteeing profit is rarely a bad move. That's just one thing I've realized. It's rarely a bad move. So here we are, we're sitting here just to reset where we're at Main Street. So we've increased our cash somehow because we've made it past the building blocks and the basics. We've talked about some of the tax problems that you may see, what happens as you move up in income, how people want to protect their money as they move up inside income levels, some of the things that attack people's incomes and some of the concerns. Oh, also 10 steps that people can use to increase or maximize their 401k, whether that's retirement or right now. And then also that we took a look at 4 ways that the retirees can look at 4 ways that retirees can adjust their retirement accounts amid the Iran war. So we have a war going on right now. And those are just some of the steps that they can take. It's been a full session, but there's still a little bit more we want to talk about today. I just want to thank everyone for listening so far. Everyone over in Japan or Vietnam or South Korea or Argentina, especially all my folks over here in America, the United States, Europe, the United Kingdom. We have people all over the globe who are actually sit and listen and watch this stuff. So we appreciate it. Hopefully it's making you a better investor, better at whatever it is you're doing, helping with financial literacy. That's a big part. So if you're finding value in this, hit subscribe, hit like, share this with someone. That's going to help grow this channel, help spread the message. Because, in my daytime job, I actually have a financial planning firm, the ABC Squared, but this is different. This is to help spread the message, to help let the world know. We have crazy times going on. We see the stock market going up. Oil prices are going up. Like I said in my last video, that those things probably shouldn't coincide right now based on what we have going on. Geopolitical tensions. I think today the president said that the ceasefire is on life support. The ceasefire or the negotiation talks are on life support. So there's still a lot going on. I just want you to stay informed. Hopefully we can help you stay informed. Hopefully I can help you with your budget. And check out video. I got some Monarch Money tool that we can help you with that you can check out if you want to try it. There's a link that I can provide you with. Free link. It'll be in the description. Full disclosure, if you do use that link, or if you use any link that I provide, you see we're using some Riverside stuff here that we record on. I also have a link there. Riverside link is for 1 free month. Try it out if you want to. And then the Monarch Money link is for 50% off the first year or 7-day free trial. If you use either of those links, I may be compensated for those links. So just putting it out there, just so you know, full disclosure. But this is money mindset, Main Street meets Wall Street. It's all tied in. Big shout out to all the people who are subscribed to the Wall Street South Journal. I do really appreciate the 1,300 listeners and readers who've checked out even the last newsletter that came out where we're talking about the Broke series. That's me taking a few minutes to give a shout out and thank y'all and really appreciate everyone who's who watches, who listens, who participates in the discussion. We covered technical rotation and the technical defense. We laid out 10 steps to optimize your 401k and 4 pillars of protection for navigating this conflict with the Iran war. But as we close the ledger tonight, I want to leave you with the most important part of this broadcast. Everything we discussed, the Intel resurrection, maybe from the Business Insider article, the retirement warnings in Newsweek, and the high net worth standards in the Wall Street Journal. It all relies on one thing. It relies on you. You take these steps, but you're not open to operate with, you're still stuck in the Main Street mindset identity. You're fearful, reactive, and addicted to the pursuit of the next big thing, FOMO. You will eventually override your own best system yourself. So just remember to stay the course. You can outperform your own self-image. Yes, you have to see yourself as the strategic partner to your wealth, not a victim of the global friction we see at the Strait of Hormuz. We started at the Strait of Hormuz. We went through the walkthrough of being gaining a windfall, perhaps from Intel. Talked about the taxes. We talked about the implications. We talked about the worries and fears of people close to retirement, steps to take to improve your 401k, and some steps that you could possibly take to help yourself right now in the Iran conflict. Once again, this stuff's not investment advice, and each person needs their own personalized advice. But $39 trillion debt clock is still ticking. Those tankers are still anchored. But tonight you have a little more knowledge. So you don't just watch the video. You can take a look at your 401k when you have a chance this week. If you think about adding crypto or private equity, take a look at the loan video that I have on my channel. Set that roster. If you're a retiree, take a step to make sure that maybe some of those 4 pillars work for you, or maybe they don't. but make sure that you're not set up in a zero scenario where you can lose everything. Make sure you're covered. And then join the community. If you want this level of dissection, we do a lot of stuff pretty often, put stuff out. You can subscribe to the Wall Street South Journal on LinkedIn. 1,500 plus professionals who've decided that the Main Street and Wall Street finally need to meet, and they're going to meet on our terms. We're building the table, right? You can give this 5-star review. You can subscribe to YouTube. There's so many things you can do, but the first thing you do is just get that momentum going, one step in front of the other. And if you're listening to this and you're like, where are those building blocks? We'll leave the building blocks at the end of this as a bonus. I'm Marcus Durbin, Sr. Keep your hand in the mouth, your heart in the process. Main Street, heart meets Wall Street sparks. I'll see you. Thanks for tuning in. And there you have it. We spent over 3.5 hours documenting this reality. And now you can look and see how this more economy and the diplomatic shifts from the Abraham Accord to the raw operational bottlenecks of our global infrastructure. From Straits of Hormuz, Straits of Taiwan, Kevin Warsh's confirmation, all the way through his finally being sworn in. That's actually in the More Economy Report. But if you stayed through this entire report, you're no longer a casual observer of the markets. You got a different kind of blueprint. You have a different understanding that in 2026, the ticker may be merely noise. But if you can look inside of a framework, perhaps the More framework, the flow of massive capital, the reality of this sovereignty floor, right, that we have from these governments, and the synchronization of earnings. It's only the truth in the matter. And there are other factors. All it does is end when the stream goes off, right? This thing keeps moving. This ledger keeps moving. Like I said before, if you want to keep listening, if you want more stuff from me or anyone, like I said, Mr. Clem, Mr. Steven, they have the podcast, Skeptics Guides to Investing. Main Street Meets Wall Street podcast. It's my podcast. Some great guests on there. We have Mr. David Snyder on there, one of the most recent ones. He's predicting an AI bubble burst, and he's got some great facts for his theory. We also have a lot of great guests coming up on there. So listen to the latest episodes. We go deeper into these specific breakdowns that we didn't get to cover in this marathon. Like I said, make sure you subscribe to the Wall Street South Journal newsletter. Check me out on LinkedIn. You can see a lot of stuff on there. It's much more real time. Notice the world is shifting. This new infrastructure is being laid. Don't just watch it happen. You got to allocate accordingly. Right? I'm Marcus Durbin, Sr. This has been this edition of the War Report. It's a long one. Thank you for tuning in. Hit the subscribe. Share this with someone you love, someone who could benefit from this. Main Street Heart meets Wall Street Smarts. Thanks for tuning in again. Hey, good afternoon. Welcome to today's live market update. I'm Marcus Durbin, Sr., and we're navigating one of the most complex geopolitical landscapes in years. Conflict in Iran continuing to restrict the Strait of Hormuz. Oil has breached well over $100 mark, sending shockwaves throughout the global supply chain. Today with Mr. Stephen Davenport, we're going to break down what some of these things, maybe some stagflationary threats mean to your portfolio. And I don't know if you were here last month when we met, but Mr. Stephen said he saw 10% downside in the market. So I don't know if he meant for that to happen in a month, but we're definitely on the way to that. So we're seeing cracks inside of the S&P, the Dow, liquidity and private equity and private credit, just to name a few. But so happy to have you back here with me again, Mr. Stephen. Let's just jump right in. How have you been?
Again, I'm Steve Davenport with Circa Capital, and I'm happy here to be with Marcus. And I enjoy going through what's happening in the markets and what's happening in the world. I think we have become somebody asked me, is this like the 70s? Should we go back to what happened when the Strait was last shut? And I look at the world and I say it's a completely different world, because I think of where China was in 73. Their economy was small relative to the global economy. When I look at where energy was in the US, we were importing, I think, 30 to 40% of our oil requirements. So we were dependent on the Middle East. And now I look at with shale and everything else that's happened in the US, we've got vast natural gas and oil resources that are being developed. And I think we're in a position where we're probably one of the better positioned countries in the world. And I think with this AI boom, it's causing us to look even harder at our energy and say, okay, we probably need to keep nuclear. We probably need to do more on solar and hydro. And I feel, although this wind recently with Trump shutting down some of the wind farms has been a negative, I think what it brings to light is it's another source. And when we figure out how we want to organize this and have the problem with the U.S. market, Marcus, is that we are very much a capitalistic economy. We move and react to whatever the demand is at the current time. A lot of countries have energy policies that go out 10, 20, 30 years, and they have plans. Germany had a plan to get out of all of its nuclear and to, use more nat gas, but also try to use more solar and other things. And guess what? The Ukraine came along and that plan went out the window. So this time in our lives is probably another time where we're going to have to ask some hard questions about energy and what our future looks like and where do we want it to be. I believe that we're moving more and more towards nat gas as a replacement for coal and oil. And I think that will take 15, 20 years. But I also believe that there could be some developments in the solar space and in the battery storage space that could change that. And I think what's going on with AI is pushing the limits of that because they don't want to be on a grid where they depend on some central. And so you see these different AI server farms, and they're going to be completely autonomous. They're going to have their own source of nuclear or solar and they're going to try to operate independently of the grid so that they don't depend and have, their AI technology down during critical periods because of a hurricane or a hailstorm. It's really a very different time than 73, where we were just getting in line to fill up our cars and we would burn as much gas as we would put in the engine, filling up the cars. And it was crazy. We had gas guzzlers. I mean, think of all the things that had changed since the 70s. But then look at the Middle East and say, has it changed? Have we gotten clarity as to how we operate and how things are going to work in the Middle East? I would kind of say that we know more, but I don't think we're more advanced in our relationships in the Middle East. And this violence is kind of bringing that point home. You would think that Iran would say, no mas, I don't want any more of this. But I think they realize that they can control the country with the guard and they can keep their religious leadership, even if it's like the snake. When you knock off the head, 3 more grow back. I think it's Phaedra, right? Was a Greek god who had the ability to grow back more and more heads. I don't believe that we're really used to dealing with Middle Eastern governments. And I don't think we've made necessarily an optimal partner with Israel here. I mean, how do you feel about this war and Israel kind of pushing us into it without really a plan or an idea of what's right or wrong in terms of what we should do?
I feel like the war that we're in right now, I mean, if you recall last time we spoke, it was literally the day before. Like later that night, they launched Operation Fury. We were talking about the war and the duration as to how it might impact markets. And first of all, obviously the loss of life is great and tragic. That's a tragic thing. All the people whose lives are disrupted and lost, that's a terrible thing. As far as from the market perspective, I feel like the war has had a lot of mixed messaging coming out as to what the objectives have been from the beginning, as to the time frame. First it was going to be just a few weeks, but we're kind of right at that 4-week window right now. So we'll see if that reaches 4 weeks. We're kind of at that point. It seems to have a lot, obviously, to do with oil. I don't know if people really realize that like oil makes the world go round. We cut off the Venezuelan oil, which is a lot of oil to, I don't want to say our enemies, but not necessarily our allies. That was a source of them getting oil over in the other parts of the world. Then when we go into conflict in the Gulf over there, you have another point that's choked off with oil, but it's kind of impacting some of our allies this time. But as you mentioned, America is pretty much oil independent right now. We supply a lot of oil. We went into this situation, as you mentioned before, in totally different place as we were in the 70s. I do think that we have learned to talk with the Middle East a little bit better since the 70s. I mean, we negotiated, I guess you call it negotiations with Iraq until that didn't work, but that was more of their own doing. I think at the beginning when they were trying to take over Kuwait, once again, oil, right? You go back to Iran and you look at the Contra stuff. I guess that was South America, but it all ties back to, you know, like the 80s. We were in the Middle East then, Afghanistan, you know, Taliban back then. So we're intertwined with all this stuff. We've negotiated. I just don't know if we've negotiated well with these regimes. And even as recently as last year, we saw a lot of announced investments from Middle Eastern countries. I don't know how much they actually input into America, into data centers and AI and things of that nature. So I don't know. I will say that maybe we haven't improved our communications with the Middle East, but we have had more communications with the Middle East. So the messaging, as far as the war goes, that seems to be one of the big things because it's so dynamic, so topsy-turvy, and that makes it hard with investing right now. So it's pretty much if oil goes up, stocks are going down for right now. That's the simple part of it.
Yeah, I mean, I think that we've learned that oil and fuel, like we talked about before we started, that, you know, the impact on some of the products of fertilizer and other parts of the world economies. They provide 40% of the fertilizer to Africa and Asia. And you think about India and some of these countries and what that means to their food production. And you think about, no, the US had 60% of its strategic reserves filled. It had been up to 80, but Biden released it at various times, so it's down to 60. And Trump's strategy, instead of saying, I'm going to fill up the reserve, was, hey, I'm going to disrupt Iran's control of oil, and therefore we'll have a better price for oil for everyone, and then we'll fill it up to the top at a lower price. Well, that's probably going to see it go down and again before it goes back up. And when you look at it, 170 million barrels is a lot of oil. It's still, in the U.S. economy is so big now, and there's going to be more demand from AI. I'm not sure how the strategic reserves should be managed, but I look at a country like India that doesn't have any strategic reserves. So you look at that and you say, they really are waiting for those ships to get through the strait in order to relieve an immediate need. And I look at how we all think about all of these countries sitting around the table at the G40 and think about all of them have countries that have people who are dealing with all kinds of issues. But the US really is a leader in this space and has to be considered, you know, for how it impacts and makes decisions. This decision to go into, you know, Iran was, in my mind, too short-sighted and not really clear with an objective. And I think that then you can declare victory easier if you can move your objective around. But I look at this as really a danger to Israel and not a danger to the US. They didn't have the rocket capability to get any of this nuclear and to us and impacting us. They had the distance to get it to Israel. And when we look at it and listen to Tulsi Gabbard, she says there was no enrichment going on. So it really, this story has to be sorted out in order for us to figure out what type of a problem we have and how long do we think this will last. I think the original goal was 4 to 6 weeks. I think that Trump would love to, you know, you take the 10 days from today that he's extended the deadline, that would put it almost exactly at 6 weeks. And I think that that would get it resolved before Trump meets with Xi in China. So I'd still say that's the base case. But the other things like adding 10,000 more troops, and maybe their assignment is to, you know, take out any of the weapons that are on the side of Iran, you know, in the strait, and in doing that, open up the strait for everyone. That could work, or it could be one of those missions that it doesn't look like that it's easy to land there. It doesn't look like it's going to be very easy to go through the hills and the mountains to find some of these locations of these weapons. And I always wonder, you know, Iran has been very good about building these tunnels for their nuclear. And I just wonder if you're very good at tunneling, well, that would be a real good way to move your weapons along that area along the strait. So I think there's more we don't know about this than we do. I think it's a little bit wishful now to say it will be done in 2 weeks, but that's what the market is saying in the base case. And so if the US bombs the energy facilities of Iran, and that causes Iran to really have almost, you know, and they're also talking about desalinization. If you desalinate, take out those resources for energy transfer and desalinization, you make Iran uninhabitable for the summertime. In the summer, they're going to see heats of 130. So part of the reason why we're doing this now, I think I would argue, is because we're afraid of operating on the ground there in the summertime. I don't think it's possible. Nobody's done that before. And when we look at the whole process, it really is very much of uncharted territory. So therefore, I look at this and say, we're probably going to have oil prices higher for longer. And I think that makes the possibility of a recession higher. And I think with the other things going on, with AI being overpriced, with private credit potentially erupting into more failures, these things, I think, combine and create a very bad brew for us to swallow over the next 2 or 3 months. So I'm a little bit more than skeptical. I'd say I've dropped into the cynical bucket.
Goodness, down to cynical. That's from a normal skeptic down to a cynical level. That's saying something. I just want to note that I'm pretty sure that Iran shot a missile that went like 2,600 miles the other day. So like they can't hit America, but they do definitely have more capabilities than I think we realize. It appears that the intelligence we have, some of the intelligence is really outdated. Like if you take that school bombing, for instance, that was data from like 2016, and it was supposed to be a weapons facility. I don't know, but it seems like to take troops into Iran would be a major escalation, right? As you mentioned, and it would definitely drop oil prices higher and extend this conflict much longer. But we do have close to 10,000 troops on the water right now headed that way, or at least that's what we say. Our administration does move kind of, under the shadows, I guess. They don't really put their moves out. Maybe that's tactical, or maybe they just don't know what they're doing with it. But either way it goes, if this pushes oil prices up, because you mentioned in your notes, I know I've seen inflation expectations going up to 4% real soon. You put 5, maybe 6% inflation. You want to walk into that? How do you get to those numbers?
I'm saying I think that we're going to see some of the problems with fertilizer and some of the other things go through to our food. I also think that our immigration policy has caused some labor inflation that I don't think is going to get any better. I think we're still haven't resolved the immigration question. And I also think that this shutdown is going to, ultimately be inflationary, because I think it's going to be harder for us to operate and travel. And those things are going to make it more difficult and more expensive. So I'm not sure that we can get through this without a recession. I'm not sure it wouldn't be, I'm a big believer in, it is cleansing for the economy to have a recession and have some things fail so that we can then rebuild well. When we do these things and we don't have a recession and everybody just gets funded for a little longer and the business continues to operate, but they operate with damaged balance sheets, that doesn't really help in the long run. We believe it's helping to prevent some of these recessions, but I would argue that they're a healthy part of the process. And what they do is they cleanse the people who can't survive, and they help the companies that do survive. And I think that right now, with private credit the way it is, I think these people wouldn't be in the credit space looking for funding unless they had some problems. And I think that the fact that they might be double collateralized or doing things that are less good for the company and the economy because they want to try to survive, I think this is where we need more information. And I don't think we have any clarity, which is why I've always hesitated about trying to compare private credit score and private credit investments to regular corporate investments, where you have a lot more clarity and you understand the counterparties a lot better. I don't think this is a single storm. I think this is a storm that's going to hit us from a few different ways. Look at the wealth effect. 10% down on our equities, it's already a pretty significant event. And the war itself has cost us, I've seen different estimates, but 100 billion seems like about right now. And if you're bringing in 10,000 more troops, the cost isn't going up per day. The cost isn't going down per day, it's going up. I don't know, how do you feel about the R word? Are you starting to talk about it with your clients? How do your clients feel if there was a recession? Do you think we're prepared?
Honestly, when it comes to recession, I mean, So people like realize they're living through recessions, right? But they don't realize they're living through recessions when they're happening, right? Like people feel it when they go to the gas pump or when they go to buy things. Like your money's just not buying as much anymore. People around you see people are losing jobs. You see unemployment signs. You know what I mean? Less hiring, less activity going around. And you feel inflation, like I said. So you feel the recession. You feel the GDP slowing down. You feel unemployment going up. You just see it. Maybe you don't recognize it. I feel like maybe we might already be in the beginning of a light one. I think we've seen I think we've seen recessions in certain sectors already. Like we've had like rolling recessions that have been happening for a while. Like this is a really long economic cycle that we've been in. It's been a huge part for growth, right? Like 3 years just growth. Even if you look at the stock market, wherever you look at, inflation rose and it came back down, but now it's sticky. So when it comes to like, I think we're in a different type of market where as before 3% was the target, which still is. If you listen to the Fed, 3% is the target for inflation. But I think this economy is set to operate at least at 4%. But as you mentioned, I think that we're going to go, especially in the short term, I worry about the March inflation numbers with the shock that we had to gas right at the beginning of the war. You know, we haven't seen that data come through yet. So that number could be really high. And I just think the sentiment, which can lead to, right, because consumer sentiment can lead to the effects of maybe a recession or something in that. So recession isn't my base case. I'm still bullish on the U.S. economy, the global economy. I still think the second half of 2026 will be a pretty good time for returns. But right now, I think it's going to be volatile, and we could still see more pressure down.
Yeah, I think that Trump had this view that having a new Fed chairman was going to lead to lower rates, and lower rates were going to put him in a great position going into the midterm elections. And I would say that whole script has been rewritten. I think that you've seen the estimates for Fed cuts have gone from 3 to 1, and that 1 doesn't happen until almost December. When you look at it, that I think you could see no cuts or a raise. I think that a raise now would clamp down on inflation, but it would also clamp down on the economy. And I think it would change the script of what we have. And I look at the last meeting, it was 11 to 1. It wasn't like it was 7-3 and we're going to get a new Fed chairman and Powell is going to go away and we're going to get a majority soon. 11 to 1, you add a new Fed chairman, but Powell stays on because of this whole investigation. You could see the majority finding something that the head of the chair wouldn't agree with. And I think what it's done is Trump has no understanding of unintended consequences. When he went after Cook, he thought, I'm going to intimidate her, she's going to resign, and I'm going to replace her with somebody who's good for me. Instead, she was the first African-American member of the Federal Reserve Board. She had a lot of pride. She had a lot of work that went into her career. She says no. And now Trump's going to, appeal that to the Supreme Court. We're going to hear about that in June. But I don't see anything coming from the Supreme Court that's going to say he has the right to fire. So therefore, I think that his calculations were just not I think people were going to react differently. The lawsuit against Powell, well, that'll force him to leave and he'll resign and we'll get the guy, our new Fed chairman in there sooner. Unfortunately, they didn't really look at it and see that he has another 2-year term left. So he could just stay on the committee for 2 more years and vote and believe and lead the others on the committee in a way that's going to be completely opposite. So the Fed, in my mind, was setting up for a rebound in the second half of this year, Marcus. But I feel like what's happening at the Fed makes that a lot harder. If inflation is higher and if they potentially have raised rates, that lower rate environment, housing is struggling. Housing at 6 and 6.5 isn't an enthusiastic part of the economy. At 5.5 or at 5, 1.5 lower, I think it would be. And so if we don't get that rearrangement of rates, I'm not sure your second half bounce is going to happen.
Well, like you mentioned, first of all, I think Lisa Cook is the first female African-American governor. I think there have been Roger Ferguson was on the board. And yeah, like you said, you have 12 members who are voting, maybe 19 total governors in the Federal Reserve. So it's going to be hard for Washington to come in and automatically get rate cuts, which is probably, I imagine, his goal. But he does plan on reducing the balance sheet when he comes in there, which can fuel more with this economy. They think we can just grow out of this. That's the plan. But also, like you mentioned, maybe a rate hike, because that's actually gained in the odds and polls, the poly markets, all those type of things, that we'll have a rate hike maybe before we have a rate cut. And the reason being, like you mentioned, the Fed just came out and made a rate hike 25% just to tell the market, hey, we are paying attention to, inflation and a very weakening job market. I mean, what were the last numbers, like negative 92,000 that came out? So we're seeing these numbers revised down really weak, even the GDP. So this type of stuff is definitely worrisome. But when you have, like I said, Fed Chair Warsh coming in there, I think the chair definitely has a lot of influence. Last meeting Powell was at, he said he's not going anywhere until there's resolution. So like you mentioned, he could possibly be on there for 2 more years. We would think that the administration or the DOJ would drop this before that. And Tom Tillis, whose term expires in January, when you'll be sworn in, or December, he said he's not going to push anything through on that board. So it's just very interesting dynamic with the Fed. Just thinking about
I think it's interesting that Tom Tillis is from North Carolina, and the whole country and the Federal Reserve Board, it all depends on how Tom, sticks up for the Fed. And I think it's amazing how in our economy and our whole market system has this one person who's saying, I don't want to let him go. I'm going to hold this up until they drop this frivolous case. And it's like, I don't know. I'm a big believer of Jimmy Stewart and It's a Wonderful Life. And every one person has a chance to make things right. Jimmy Stewart also did a movie where he did an overnight thing when he was a congressman, and he kept talking. I find these times in American history where people just decide to say, I'm going to stand up and I'm going to be counted. And I don't think this is right, so I'm not going to do it. And I as a skeptic, I kind of like those things, because I think what they do is they encourage people to really think about what's important and why we're doing this. And if we're going to operate in a way that doesn't make sense, well, then, say something. Because I believe that's what, leaders are supposed to do. They're supposed to lead, right?
Right. Have decency, right? It's been a while since someone said that in Congress. I mean, you think back to Joe Manchin, he definitely had control of the whole entire government.
Yeah.
His years. Mitch McConnell, when Obama got elected, they asked him what was his goal, and he said to not let any of these objectives to get passed through. So certain men have definitely had power over these things. Newt Gingrich was very powerful, but he worked with Clinton. Clinton found a way to work with him.
I'm just saying, as a North Carolinian now, I kind of like this Tom Tillis story because he's from here. I mean, it's not a guy in South Dakota who's saying this. It's a guy here in North Carolina. And North Carolina is, in my mind, kind of a toss-up state. I don't think it's clear who's going to win in the midterms. And I just look at somebody like that and say, I realize he's not running and he's free to have his opinions, but there's a lot of people who aren't running, and they want to go quietly into the night. And I think that Tillis's move is a little bit of courageous.
Yeah. It's definitely a change in position from Senator Tillis. I will give him that. I had a friend who literally would write his office every day, emails, call in. He was doing his civic duty as far as that goes. I texted him and said, I hope you send him some emails, since he stood up for whatever he believes in, representing the people of North Carolina. I think Tillis was endorsed by Trump the first time he was elected. So
I think that they were part of, I think things are changing. I mean, I think Cooper has a very good chance there. So I think that this is going to be a very interesting fall, irregardless of what happens with Iran. I am very saddened by what happened with that school children, and 168 young children killed by a tomahawk. I mean, we own Lockheed Martin and we own Raytheon, and I think it does raise questions about how do you feel about companies that are providing these weapons that ultimately can be used or misused and lead to some situations that are very negative, right?
Yeah, and I think that's kind of what Anthropic was, part of their beef with the government was how these weapons are used. But I think, it's the fog of war and it's the pros and cons. Someone's going to build these weapons, right? I saw where a company is developing where they can build like 10 of these. They're 3D printing these tomahawks, or they're 3D printing like ballistic missiles or some type of missile. So it's decreasing the cost a lot, because this war is costing a lot of money. We were sending up very expensive drones to take down very cheap missiles compared to the drone. Vice versa. So they're like having very expensive missiles being shot down by very cheap drones. Only missiles I heard that Iran, we said that we had blown out most of their missile capacity, but reports are coming out now that maybe it's like only 33% that we've destroyed. But they said there is a lot more that's like in the tunnels. You're speaking about the tunnels, so like they'll have to go dig this stuff out. So that's the discrepancies inside all that. I think maybe we've dug into the war enough. We spent like half hour on the war. Before the war came, there was still a whole lot of things going on, right? We had the SaaS apocalypse, we had private credit, we talked about the Fed. Let's talk about private credit.
Sure. I mean, I personally think that the private credit is a reaction to the bigger banks not wanting to have these things that were what I would call lower quality or lower rated items on their balance sheet. And because those banks did that, they had to seek other funding. And so what they did is a lot of the people in the private equity space said, why don't we look at some of these things and put them in our private credit type of wrappers? And I think there were a lot of people who created them. And I think that when we saw with First Brands was a case of somebody who was corrupt and, collateralizing something 2 or 3 times. And I think that when we look at what's happened in our economy, we need more transparency. And the problem is then if you get more transparency, you need to have higher quality. So I don't believe that these are going to just go quietly. The thing that I found interesting this week was Lloyd Blankfein from Goldman Sachs said he sees a lot of problems on the horizon and he sees it blowing up. And for a guy like Lloyd Blankfein, I mean, Diamond has made comments about the cockroaches, and Diamond is a pretty harsh critic. He's always going to say and do whatever he thinks. But Lloyd Blankfein is more of a smooth sailing guy. He has been around and he has moved between various issues in his career at Goldman, including the great financial crisis. And I look at him and say, there's a guy from the sidelines that has no reason to necessarily weigh in, but he did. And I look at it like a Tom Tillis case where he believes something, he wants people to know how he feels, and I think he's calling out. And I guess I'd say when these people are calling out, when Steve Davenport or Clem Miller or Marcus Sturtevant say something, it's important. But when these people who are leaders of their companies and have been leaders for decades, they say something with all of their information that they have from all of their divisions all over the world, I listen, because I believe that, the best way to get ahead is to, step on the shoulders of those who've gone before you. And I look at these advice that they're giving me and say, I hope clients are taking some assets off the table before we are down another 10. I think I said 10%. I now see this correction probably going to 20. I don't think we're going to see enough of a rebound given the inflationary factors and the Fed not lowering. That's the kind of thing that I think has changed in the 4 weeks since we last did it. And I look at that and I look at, the 10,000 more troops, and I look at some of the other things with some of our allies. And I also think it's strange that, Trump would delay a meeting with Xi. And I think pushing that out tells you the extension of this effort is going to be longer than we originally thought. So given those two things, I think the overall correction in the S&P will be closer to 20. And I would just say to people, now is not a bad time to have a little more dry powder. I don't know. Are you overweight, underweight, or regular neutral weight now, Marcus?
I was trying to look and see where the markets were right now. I'm pretty neutral weight when it comes to equities. I made moves with my clients before this. I haven't made any drastic moves. I don't ever really make drastic moves. I haven't really made any moves inside my clients' portfolios in the last few weeks since this has gotten started, especially once I've seen the tempo, especially once I've seen how quickly it moves with oil or how quickly it moves with posts. I've always known this as far as, maybe not always know, but I figured this out a while ago, that these things tend to move. They can move quick. You can't be completely out of the market right now because...
No, I'm not saying to be completely, but...
Right. The worst day in the market could be followed by the best day in the market. That could happen or within the next couple of days. But I do think that as you see inflation increases and generally when income generating products reach around 5%, people will go risk off because, if you can get or reduce their exposure to equity, if you can get 5% from something that's quote unquote safe without the worry and risk of your stock market for a while, people are going to reduce that. So I guess position more that way. Even inside the private credit, we're looking for different type of private credit. Maybe not the stuff that's out there now per se, because they still need to come in my opinion. They should just take the flush, go ahead and say, these are our books, write down everything that's bad. You know what I mean? Go ahead and write down, get that out the way. Your stock's going to crash for a little while. But private credit in general, we saw people asking for their money that was gated here recently. Since the last time we spoke, that was one of the big things. This money's been gated. But that's how funds are set up. It's set up to be gated so people can't take out all the money at one time. But we've also seen high net worth individuals cash going into private credit. Maybe not into those stocks, but into individual funds. So it's like, watch what I do, not what I say. Same type of thing.
I think people who are saying, I'm surprised I'm gated, it's a game, right? Because everybody knows that's what the difference is between a regular investment and a private investment, is that on the way out, there will be a process and you will be lined up like the other investors, and that's what happens. And so to sit there and say, I'm shocked, you know what I mean? Like, it's kind of like the guy running the casino in Casablanca, right? I'm shocked there's corruption going on here, there's gambling going on here. It's gambling when you're in private credit. If you don't realize there were gates and that those gates could cause you to not get out as quickly as you wanted, then you weren't playing the game with all your marbles, right? I mean, that's part of what you get. And so for people to do this and act surprised, I think is kind of ridiculous. But yes, I've heard people say, now may be the time to go in. I think we need more clarity before we put more assets in this. But I agree that the whole space of private credit is being painted with one brush and it's all negative. And whenever you see that, it's just like when everybody was into AI and everybody was on that side of the boat. Everybody was pro AI and it's like, how do I make money in a period like that? You have to, in some ways, stay in the middle or go on the other side of it, because it's not easy when the momentum of the mob is taking you one way and you don't necessarily feel the same way. And I think AI got ahead of itself and now it's pulling back. I think private credit probably got extended to people that it shouldn't have. And now we're seeing people get out of it who are what I would call weak hands. You know, there was that expression with the meme stocks about having diamond hands, right? You have hard hands that you can hold anything no matter how hot it gets. I think we know that when we see this, we need to hold and take things in perspective. If you have 40% in private credit today, you probably have too much. If you have 3 to 5, and you know that those 2 or 3 investments are good, they were good, they've been repriced good, they're showing good cash flows, then you have a different problem. And I think that everybody needs to always ask that question. And I do this with my clients on concentrated stocks. I say, okay, you have $10 million in Microsoft. If I gave you $10 million in cash today, how much Microsoft would you buy? And the answer isn't 10. And people look at it and say, you know, you're right. I got some of these shares when they were $40, $70, and we're not asking you to sell those shares. We're saying some of the recent shares, it might make sense to pull back some and take some profits, because you never go, as my father used to say, you never go bankrupt taking profits.
Yeah.
And so I just say to people as an advisor right now that it's a good idea to look at your portfolios, see how you feel. What's your job situation? Are they talking about layoffs at work? Let's make a holistic decision. It's not based on the price of oil in Iran. It's not based on whether the Fed interest rates are 5.75 or 5.25. It's based on you and your family and your needs and where you are financially. And that's where you try to make good decisions for the plan. You don't want to vary from the plan too much, but you also don't want to get run over if a negative event happens and, we have an unexpected medical expense. You need to put some money aside and think about it and act prudently for your plan. There's the people on CNBC, they're not going to be there when you have a loss and you need to go ask somebody what to do. You've got to figure it out. And having a good advisor is a big part of that. And that's what I think makes it easier for people, because they're busy on their jobs. They're busy working. They're busy raising kids. They're busy coaching the kids' soccer team. It's not easy being in this, economy or this different points in your life. Take your investments as seriously as you do some of your other decisions. Some people say they spend more time buying a car than they do buying a stock. The average person spends 10 to 15 hours, and the average person buying a stock spends about an hour. I mean, I can tell you if it's a good investment and it lasts for 10 years, 20 years, you know, you might have wished you spent a little bit more time on that than the car, which is a depreciating asset.
Yeah. Perspective is everything. And as you mentioned with the private credit, people, or just any investment in general, you made some really good points that people have to understand what they are invested in. Like that falls back on the advisor as well as the client if they don't understand these things are gated, how they work, and the fact that these investments work best in the long term, right? Private credit, you work better when you give it time to work in the full funds. Like you should read that prospectus, you know, if it gives you a good reason to go to sleep on a Sunday afternoon, maybe wake up and finish reading next week, but you need to understand what you're in and why you're in it. And yeah, private credit, you probably should have 40% of that. You probably should have 40% of gold. You know, you probably should have some type of diversification inside your portfolio though. It just shows. I saw recently where they were saying the 60-40 portfolio is tremendously underperformed here lately, right? So it's just like you need, right now there's almost nowhere to hide, but there are places to hide. You just have to know and diversify your portfolio. So
I hate to tell you this, Marcus, but my put options have done pretty well in the last 3 or 4 weeks.
Exactly. Do you want to talk about like what you did since we've spoken and you with the options, like how Main Street could, you know, how Main Street could have played that?
Sure. I have a client who has a lot of technology in his portfolio. And so what I said was the two vehicles that I'm going to hedge with are S&P 500 with the SPY ETF, and that's just the whole market. And so I believe that the whole market was not priced right. The AI was too high, and that the market wasn't reacting in ways that made sense. So everything that was happening was a positive. There was no way, you know, even when they started buying each other's, you know, products. And that reminded me of 2000 when that started with, you know, all the servers and everybody was trying to have cross deals with different people. And it was just like you were building the market up on yourself. And that's not the way that you want real growth, meaning growth that comes from independent people picking and selecting your. So AI was high. And I thought that this situation with Iran could get worse. So I bought some protection that expires in June, September, and January. And the reason I did that was I felt some of these things could get resolved quickly. Some of these things might not. And then I thought about the election and September options. And I said, if we have a change of government towards Democrats, is that going to be a negative to the markets? I think typically it is. And it could be. And it could be that just the back and forth, the conflict would create an environment that's not good for investors. And then I looked at the January and said, let's say the election goes good, but what if some of these things persist for a longer period of time? What if our energy, you know, the energy question around AI has not been answered in my mind. I don't think we have a plan. I don't think we have a real good solution. Some of these small nuclear could be it, but it's not here yet. And therefore, I don't think it's extrapolatable and transferable across all the states. So I look at things like that and I try to say, I don't have an exact silver bullet because all I have is a tool. And I apply that tool with the SPY in June, September, and January, about 10% lower or 15% lower. And then I looked at XLK, which is the technology sector, which I think was at the heart of the overpriced market that we had a month ago. So AI was at the heart of it. And I looked at the technology sector and the implied vol versus SMH, which is a semiconductor index. And I thought that it covered more of, because companies like Google, companies like Amazon are still at reasonable prices relative to some of the other names that are at higher prices. Apple is at a reasonable price. So when I look at the whole sector, I don't want to say it's just semis that have gotten out of. I think the whole sector had, you know, a reaction that was too much. And therefore, I decided that we should hedge part of that as well. So I think that what I'm trying to do is say, hey, I agree with you. We're not going to sell the whole stocks and go to cash. That was never a choice. What my choice is, do I want to hedge, you know, 20% of my equity? Do I want to hedge 40% of my equity? I usually don't hedge more than half because I want half of it to continue to operate and succeed. And so if I do hedge half and that hedge helps me on those downsides, you know, I think when I checked yesterday, they were up about 75%. That type of performance on the amount you put out there is not saying this to guarantee performance, and past performance is no indicator of future. But I'm just saying that options can be a piece that you can use to try to help your portfolio stay invested. Don't pay taxes if you have a really big low-cost basis, and then use some of those as maybe ways to sell call options to pay for the puts. So generalized puts with specific call options written on names that are really overpriced is how I look at it for clients, and how I think is, there's sell, there's hold and hedge, and there's hold and don't hedge, and put new cash to work in fixed income instead of in, there's several ways to kind of different shades of gray, I guess, if I want to make one other analogy.
You're getting buried up over there. And what people should realize is that even when you mention your puts, that these puts they're longer dated options, right? Like you're not talking about, like, if you would have had that put on for Monday, you would have lost a lot just because that tweet or X post and how much the market moved. That's a whole nother story, what happened with that.
Right.
The market.
I'm not speculating. I'm trying to hedge my investments.
Right.
And so I think that's different than speculating.
Exactly. And it's different when people, because I don't want people to think that maybe what you're talking about is like shorting the market, like where you're taking stuff out on margin, because that's when you really get hit. If you go out and buy some of these stocks on margin, then your margin gets called in. Like that can be infinite losses if you try to short. Like literally, they can go in.
And I think there are, let's just say I see one trade out there that's going to unfurl, which is a lot of people borrow on margin to buy private credit. And they say, look, my private credit's paying me 9 or 10%. I'm borrowing at 6 or 7. I get a 2 or 3% spread there, and I get to participate in all the upside. Wonderful. You know what I mean? But when it goes the other way,
yeah,
and all of a sudden you're losing 10, they're writing down the investments 10 or 20%. That eats up a lot of that 3% spread, right? It's going to take you a lot of years on a 20% decline. You're going to wait 7 years to make that up with that spread. I think that's where things. And what if rates go up and suddenly you're borrowed at 7, but now they're telling you, well, it's actually 8.5. Well, then all of a sudden your sure thing that was a money machine has changed. And that's where I think some people cautiously add private credit and private equity. Some people don't do it so cautiously and say, hey, this is something I have access to and I can do this, and I'm going to make whatever I have to decisions to make it happen. And look, I think we all want to get ahead. We all want higher returns. The question is, what risks are we willing to take for them?
Yeah, your risk tolerance. A lot of people don't realize that they're so off sides with their risk tolerance in general. They think that they are, like you said, they just see the returns from this margin that they have, and they don't realize when it goes down a lot. They may have started to realize it now with this recent market movement. This could be extended. I mean, we've seen a little bit longer downturn than most people who've been invested, because a lot of the investments now are like post-COVID investors, or a larger percentage of investors. Investors have grown percentage of like retail investors since COVID. So they may not have seen all of these moves and understand that some of this stuff may go for a longer time, right? So it's just
right.
It can be scary to people, but like you mentioned, there are definitely always ways to make money inside stocks. If you feel like it's going down, you buy puts. If you think it's going up, you can buy calls. And then, like you said, these are positions you already own, so they're cover calls. So you're not even having to like go out and buy those positions to cover if that something was to happen drastic inside there.
Right. And I mean, Marcus, I look at Circuit Capital and I look at what you do with ABC Squared, and I know this seems gratuitous, but I think what we're doing is helping people through a difficult time. And I think the fact that we'll talk about what's behind our ideas and we'll share opinions on ideas, shows that we're not telling everyone that we have all the answers. I think we have a lot of questions, and I think those questions are good ones, and ultimately a good discussion and covering some of the issues. We might be avoiding the mistakes. And in my mind, that's why you hire professionals, because you think that they have some knowledge and some abilities through their experiences to be helpful.
Yeah, we should provide a different mindset and approach to our clients. When things go, like, we should help them not sell low. Like that's what we should be there for, as part of the reason. I know we're coming up on the hour here shortly. I know you and Clem's a great dude. I know y'all do the Skeptics podcast. What have y'all been talking about lately on Skeptics podcast? Let the folks know.
We had some interesting guests. We had a woman on, Kathy Karlick, who has started a nonprofit for women, or a platform for women, where she talks about Suddenly You, which is this concept that what happens when my husband dies or something goes on with my job and I have to suddenly make the decisions and understand what the ramifications are. And her point was, get to know things before it's suddenly you. Get to know where the money is and how things would work, and selling your house, and what are your debts and what are the things you need to worry about. Because suddenly can be you. And we know that there's going to be a huge transfer of assets over the next 20 years, trillions of dollars, because wives live longer than their husbands. I know it might not be the case in your family, because you live a beautiful life, Marcus, but a lot of men work very, very hard and may have all this stress, and therefore they, it causes them to have shorter lives. You have less stress than all of us because you're so happy all the time. It doesn't cause any stress in your life, so your wife might, have a different life. And so I think what we're trying to do on Skeptics Guide is to keep giving people information that'll help them understand the investment industry. And Clem and I are going to share our own portfolios in the next 2 podcasts. And so talk about why we're invested the way we are and what we think the strengths and weaknesses are. And I think what it'll do for people is show them that everybody has different ways they can manage their wealth and their money. There is no silver bullet, as I talked to before. I think there's different approaches for different people. And if you want to own a portfolio that pays 4% dividend yields on average, that's a pretty good way to have equity exposure and have cash flow coming to you when you're retired. Some people say it's cheaper to just own the index. Yeah, it could be cheaper, but if you have to sell sporadically at times and make another decision about how to come up with income, that's not necessarily easy. I think what we're trying to do is show people how different approaches and different ideas can all be right. I think there's more right than there is wrong in this industry. I'd just like to, I don't want to talk about private credit because it's really not a problem for 85% of the economy. 85% of investors don't own private credit. So we could talk about it and how it affects that top 15%. We can say, let's continue to add value to all 100 and talk about things that are generic and that are meaningful to everyone. And part of that is, fear of this. And I want to tell people, if you're bothered by the news and the media, turn it off. I'm not going to be able to explain every nuance of every news article. But what I can do is tell you, if you take a longer term view and you look at yourself as pretty well balanced, that will get you through it. And so I don't mean to be, dismissive and saying don't follow the media, but I do mean to say, if it's causing you harm, if it's causing you heartache, listen to less of it. See if the heartache goes down. Go for a walk. It's beautiful. It's spring in North Carolina. There's a lot of things to celebrate. And so I guess I go back to do what's right for you.
That's good stuff. And yeah, like you and Clem are doing really good things on the Skeptics podcast. Y'all are really you have a good lineup. Y'all have had some really good guests on there. Speaking of guests that were on podcasts, we've had Adam Parker on the Main Street Meets Wall Street podcast. So for anyone listening, he was on your podcast as well, the Skeptics Guy. Anyone listening, he said if you go check out his research with Trivariate and you say Marcus, put Marcus in the code, you'll get the first month free. So that's for anyone nice. You want to go in. Yeah.
I also saw George on there. George Hop-Fure was on as well.
George, yes, Mr. George was great. He was on last part 2. That one's coming out next week. He had a great question. He said that he asked. He had a lot of great things that he said, but he had a great question he asked. He said when people come in there, he'll ask them, if you have, just talking about time in the market, if you have $100 and it goes down to $50, how much have you lost, right? And then how much do you have to gain to get back to $100? So that's that question. That's that can throw some people off. But that's one of the things, I guess, if you can't answer that one, he's not going to hire you. So, the moral of it is it's hard to get the money back, right? It's more work.
Right.
So yeah, we're doing big things over there with that as well. And then just like having folks like you on, Mr. Steven, to come in, we can sit down and just talk and hash out the world. And from our view, since we started talking, the Dow's down like 700 points now. Not since we started talking, but it's down at like session lows. I mean, until we can meet again, what do you see happening in between now and I guess next month with this market? And give me if the
I see ultimately we're going to have a more more violence and more activity, but I think it's starting to move towards what I'll call an end game, where I think that Pakistan and other countries want to contribute to a solution here. I think there's talks going on. I don't think the talks are necessarily over. I would love to know who the talks are with. I'd love to know what the status is of Khomeini's son. In order to make good decisions, you need good information, Marcus. And that's where I feel like we're not necessarily being informed completely on all these issues. So I'm a little bit worried. I wish there was a little more clarity as to how an endgame would work. I think that it's ironic that Barack Obama's plan had 15 points with Iran. Trump's plan has 15 points with Iran. 10 or 12 of them the same points. He tore up the agreement because he said they weren't following the agreement. So to say that we're going to go to, and put an agreement in place that's very similar to one that was already in place and torn up, I have to ask, what's different? Are we expecting, we're doing the same thing and expecting a different result? That's insanity. I think that they're hoping that this damage to their economy is going to make them so weak that they will have to follow this plan. I also think what you do is you're kind of radicalizing the population that is in the religious group. And the more people that are killed, the more children killed, the more there's going to be people who are going to react in ways that isn't productive. I hope this stays concentrated in this area. There's been rumors of Iran threatening to bring a dirty bomb into the US. I don't want to see that. I don't want to see any of these things expand. I would rather see it contracting and stopping and going to a more reasonable level. I think what we're going to see is there will probably be Iranian Guard will stay in those hills on the side of the strait, and they might not follow like Trump was glad that those 8 tankers went through, 10 went through, because it says there's leaders that are controlling the military, and if they tell them to stop, they will stop. But if you see a desalinization plant, if you see their energy infrastructure blown up, some of those rules are going to change. And that's where I don't want us to get to that point. I'd like us to get to a point of, hey, let's figure out a way to make this work so that the world economy can get back on track. But I would say that we have another 10% down in the markets. And I think that you should be prepared for that and say, okay, at some point when there is a ceasefire and it looks like it's a permanent ceasefire, I would say that some of that money you put into safety, you need to put it back in. So I would say, think about that as we get closer to a ceasefire. Do you want to just put the money back in because your downside has been capped? I think that's the next decision you have to make. If you've already taken some chips off the table, great, hold on to them, maybe expand them, and then get ready to come back in, because long-term, the market is the solution for you to deliver inflation-adjusted value add.
Boom. 10% more down. Stocks in the long run, stocks for the long run, as Dr. Jeremy Siegel said, like they have historically beaten inflation. More consternation, hopefully clarity inside of the end game in the war, where we're at inside this war. And then we can just get back to the normal stuff. Is AI taking over the world? Will Kevin Walsh ever be elected? Is private credit a bubble? Is inflation a problem? Are people losing their jobs? And are we in a recession? So
yeah, I think the Fed and other things are much better to talk about than Iran. Nothing personal.
I agree. Well, I think that might cover it for the month. Is there anything else you want to talk about today, Mr. Stephen?
No, thank you. I appreciate your time listening to me.
Yeah. And for anyone who enjoyed it, check out Mr. Stephen's, they have the podcast, Skeptics Guide to Investing. Where else can they find you if they're looking for you, Mr. Stephen?
Circa Capital on LinkedIn. You can find me, and you can find my company, Circa Capital. My partner and I are helping individuals with their portfolios and trying to help their retirements, and trying to do it in a thoughtful and balanced way. So if you're interested, please check us out.
Awesome. Well, thanks again, Mr. Stephen. We'll call it a time. Main Street Heart meets Wall Street Smarts. Thanks, y'all.
Be safe.
That wraps up an incredible hour with Stephen Davenport. It's not often that we get that level of institutional perspective on the macro landscape, especially considering the volatility we were seeing in March during that live session. We break down some of the bond market and the shifting yield curves. It gives us a big picture of where the smart money was moving. We spent a good amount of time talking about the Strait of Hormuz. But as always, we're here for we know the big picture only matters if you know how it affects your picture. We need to take those institutional signals and translate them into actionable policy. The kind that impacts your wallet, your business, and your long-term plan. That's why for the second half of this, we're going to pivot into normal people, quote unquote. If Stephen gave us the what from 30, me and Chris here are going to dive into the how from the ground up. We're diving back into the framework we established from our March 7th policy for normal people release. And we're going to look at how the escalation in the Middle East and the Fed's recent stance on sticky inflation changed the math for everyday investors since our last sit down.
Welcome back to Policy for Normal People. This is your host. In this special segment of the monthly market update, we talk about the financial markets, how policy intersects with that, and Marcus's special focus on helping Main Street meet Wall Street by understanding the markets better for the average, normal, everyday person's life and financial decision making. Marcus, welcome. Good to see you again.
Hey, Christy, how are you? Thanks for having me on again.
Yeah, absolutely. Always a pleasure. We're going to dive right in. Our topic today is wealth and war. As you know, folks, the United States has initiated war with Iran in collaboration with the Israeli government. That's all I'm going to say about that politically, which is to say I'm not going to be political, as we do not do that on this show. But what we do want to talk about is how the war is affecting financial markets and what that may mean for you. Without further ado, Marcus always gives his general market overview, and then we kind of dive right into that main topic and talk about a little policy intersection. What's going on in the markets lately?
Yeah, markets have been volatile. That's one way of putting it. Okay. Since the last time we sat down and spoke, we've seen our first down month across several markets in February. Stock markets, when I'm referring to stock markets, the S&P, the Dow Jones, they were down last month, as was the NASDAQ. Small caps were down, which have been leading the market. We were seeing a flight to European indexes. They've been outperforming here lately. That's kind of changed here in the last few days. But the last few days have been really tricky for markets. And as they try to digest what's going on, we've had the Supreme Court decision, which is a big part. We probably should talk about that a little bit as far as how it impacts tariffs.
Sure.
Since the last time we spoke, we've had Fed data come out. We've had inflation come out a little bit higher than expected. Jobs come out today a little bit stronger than expected. So with the war going on, people aren't exactly sure where the Fed's next move can be. And then we also are sitting here with, obviously, with the war oil prices. So I guess we can start with the oil prices, right? We just jump right in there.
Yeah, absolutely. In fact, I saw this morning, I just by coincidence happened to be talking to one of my financial advisors up here in my neck of the woods here in Virginia through Edward Jones. And she happened to mention that oil prices had spiked about 10% since last week. So seeing a lot of fluctuation there. Are you seeing, is that confirmed with what you're seeing too?
Yeah. So Main Street oil prices I pay attention to gas prices.
We all do. We need it.
So an example, Sunday, I put some gas in me and my wife's car, $2.41 a gallon down here right outside Charlotte, Wall Street South. And today I went by the gas station where we start recording. It was $3.01 at the same place. So 3 days, you see the prices going up, right? Initially, with conflicts like this, I mean, we can look back historically, like the last 40 years, and you'll see that initially you'll have a spike in oil prices. But if you go out 8 weeks or so, oil prices that usually come back into the same range they were in. Stock prices do the same. Like initially they'll go down, but if you look out 8 weeks, like 95% of the time, 90% of the time, stock markets are up like 4%. So the initial shock, the duration of the war. So if this is a short war as it's been projected, then it may not have that much of an impact on the markets and oil prices at home, a long-term impact. But if this turns into a prolonged war, we've all been, you and I were here for the first and second Gulf War. If this turns into, say, the third Gulf War, something that's just an extended period of time, then that could see impacts on the markets and impacts on oil prices overall.
Right. And I think if I understand correctly, we do here in the United States still have a surplus, an oil surplus in our holdings. So wondering, how that's all going to intersect with what's happening as well. I know that the government wants to has expressed a lot of interest and has taken action, in fact, to open up drilling for more oil in various parts of the country. Again, we're not going to get into the politics of the good, bad, and the ugly of that on here, but will be interesting to see what decisions are made in terms of the reserves that we currently have. I know I talked to some Canadian friends this morning, and just we were talking about other things, but this came up. They have similar concerns in terms of how this will affect their reserves and what they do in terms of imports and things like that. So it's certainly not uniquely a U.S. problem. It's an issue for all countries that are importing their oil reserves. And so it'll be interesting to see what happens with that, Marcus. And yes, you're right. You and I lived through both Gulf Wars. We saw what happened there. It was 3:09 at the pump this morning when I filled up here in Alexandria, Virginia. And folks, that's just literally a stone's throw from Washington, D.C., a few miles. So we're traditionally always a little higher here, but compared to where you are, for instance, Marcus. But nonetheless, it was a jump from about 269 last week here is what I remember it being. So yeah, lots of stuff to watch out for there. I did hear, though, that the market as a whole was down about 1% to 2% from its all-time high, but the all-time high being that, I guess, makes that still pretty stabilized. Do you agree?
Well, the market's kind of seeing through this right now. Like I said, the market, when missiles fire, stocks go higher, fortunately. Like, it's sad. Obviously, we should take a second and think about the troops and the people who are actually protecting us so we can do these things and spread this message. The ultimate soldiers, ultimate warriors out there. But
and
more
lives have already been lost.
Right.
Yeah.
So their families. But ultimately, into the impact, I want to step back a little bit with the oil and kind of just explain why the oil, because there are already oil in the ships right now, right? Sitting in that Strait of Hormuz, and you can't get through it. That's the problem with the oil right now. So you can't get the oil through. They have oil, they have productions. Iran hasn't hit any of the production facilities yet for the oil. They're not really messing with those. They're hitting other strategic positions, but they haven't really started to hit the oil production facilities yet. So the oil is there. It's just whether or not we can get the oil through. If we were to move the oil from our reserves to put them into other parts of the world, I don't think the American people would like that very well. The American people haven't really figured out how we're going to stomach this war, right? That's a really big part of war. Some people who lived through conflicts like Vietnam realize that eventually, regardless of where you're at, if the public and American sentiment can't deal with the impact of war, you're going to lose that war. You're going to lose troops. You're going to lose whatever you have going on. That can be detrimental, and that's when you start to see oil prices go up. If we were to start sending our reserves, which are abundant now, out to other countries, that would send out a message. One of the messages that we sent too, because oil prices were up, but they came back down like yesterday when the president came out and said they would ensure that the U.S. would insure these oil tankers in the Strait that go through, because Iran had threatened to blow some of them up. It effectively closed the port, but you can't really close it, or the Strait, but you can't really close it other than, blowing things up. One of the things is that the insurance that the president is guaranteeing for these tankers in there is supposed to be only for American companies. But a lot of this oil that is in there is going to China. So how do the American people handle that, right? We're providing insurance for Chinese oil as well. So I just wanted to talk about that for a second.
Yeah, that's a lot. That's a lot to take in because our negotiations regarding tariffs with China, as well as other countries, is also playing itself out and continuing to be a part of this bigger conversation as well. So, yeah, I mean, it's worth considering all of that. Well, we've talked a good bit already about the main topic, which of course is the markets and the war. What else is going on in other places relative to the market that you'd like to highlight today?
Another thing we've seen since last time we met is the market crashed. It had, like I said, the market was down. We had sell-offs, the SaaS sell-off.
Tell us a little bit more about that. I'm not as up on that.
Gotcha. Yeah. So the software as a service, SaaS. So we've had different upgrades come out from Claude and ChatGPT. All these different AI companies have come out with things that will eliminate jobs. So we saw Block last week lay off 4,000 people out of their 10,000 workforce. You don't have to be a math genius to know it's 40%, right? So 40% of the workforce is being replaced by AI inside of that. So what we saw a few weeks ago, we may have talked about a little bit in our last
We did a
podcast
little, yeah. And I'm
was
curious
how
about how much it's related to replacement of jobs temporarily because of capital investment up front as they expand, build centers and that kind of thing versus what's maybe going to be projected for long term, or is it too early to know that?
well, with all AI, some people will be disruptive. Some people will be totally taken out, destroyed in this situation, right? One example, Larry Ellison at Oracle gave the other day as to a way a company, he said like his, obviously he's going to speak highly of his own company, is that they have, so AI scrubs the internet and brings you all this information in. So that's where people in the seat per model, like companies like ServiceNow or Salesforce, where it used to be that you would buy a CD or something and put it on there for your sales team, your customer relationships. And then when the information became more updated, you would have to get another CD. But it's like one CD that you spread through the whole entire team. Then them all moved to a per seat model where people were being paid by the actual seats that you had because all the information was in the cloud. And whenever anything was updated, it would be updated for everyone. So say you're paying $10 per seat for 1,000 seats. What the disruption was is that a lot of this work could be done by AI bots now. So SaaS didn't need as many seats, right? But these bots are scrubbing public information. So Larry Ellison with Oracle was stating that the bots can't get the private information. That's where Oracle has, like they have this private information, Oracle, Palantir, companies like this. This is where AI can't really disrupt companies like that yet. So there will be companies that will be disrupted and completely eliminated in this process. Just like there were companies with the .com and trains and industrial revolution. It's just, there's always going to be things displaced and moved out.
Yeah, for sure. Yeah, and this is a conversation that will continue because it's kind of hard to predict. We always have a tendency as human beings to the panic happens first, and there's a bit of excitement, which is understandable. But then a lot of times you kind of have to wait it out too to really see. I've heard lots of conversations about white collar jobs. The irony that many of the tech jobs are the innovators of AI have actually put themselves out of jobs, in many cases. And to what extent that is going to be a significant impact on the workforce overall, it's happening in some places, like you were saying, but to what extent it's going to be, even worse or really affect a significant part of the workforce to the extent that because these are consumers too, and so everything is connected in that way. If you have a large portion, a large segment of the workforce at any one time in particular that is laid off looking for work, then you've also got that amount of consumers that are going to decline in the economy as well, or the way in which they consume products and services is going to dramatically change, even if that's temporary. But it's an interesting, if not a little bit scary, kind of thing to think about. But AI is here to stay, and I know that I use generative AI, as do you, Marcus, in many of our everyday activities, far beyond just a Google search, creating, in my case, graphic design and lots of different concepts and content and things like that. So I think what's going to have to happen is that policy is going to have to catch up. The law is going to have to catch up. I know there's a lot of concerns about cybersecurity and things like that. And that's kind of can segue us into something else I wanted to talk about, which is the ongoing internal war between Anthropic and the AI services that it provides to the Pentagon. A lot of people are probably aware that from the news reports that there's a fuss going on between the Pentagon and Anthropic, and I think Anthropic's leadership, Dario Amodei, their CEO, put out a statement across social media just a few days ago, a very long statement about the rationalization and their reasoning for why they were pushing back against the government on concerns about surveilling our private information. So, talking about, to what extent it would give access and what would be done with that. So I think there are guardrails in place right now through Anthropic to prevent that from happening, for preventing a breach. But it's an interesting conversation that's happening. Any thoughts on that and how that might be affecting the rest of the tech sector in particular in the markets?
Yeah. So first of all, here's a question to ask, right? So compared to the horse and buggy era, right? Do we have a lot less horses than we used to have? We have a lot less buggies. When cars came out and airplanes came out, Do we have a lot less cars or airplanes? I'm just saying, like, with technology, these things are going to innovate and people are going to find ways to use them, right? Whether it be for leisure, whether it be for work, whether it be for something. This stuff's going to work itself out. As far as Anthropic, I mean, we have to be vigilant. I don't want to be dismissive of that. We have to be vigilant as people and as citizens. As far as Anthropic and OpenAI, that got a little messy there. It first stemmed from the situation in Venezuela. That was where Anthropic was questioning the use of their technology, and they were questioning whether or not the Department of Defense could have just free reign, and on the Department of Defense just have free reign other technology. Venezuela also ties back into this whole thing as well, because you cut off a major supply of oil with Venezuela, which also goes over to China and Russia. So cut those off. We're cutting off oil all around the world. So that's a big thing to watch in this whole macro picture. But U.S., right? Yeah. But inside of Anthropic, so Anthropic, but if you remember back with OpenAI, when they started, they were nonprofit. They switched to for-profit. They just seem to be a little bit more adjacent to the White House and to their moves. But Anthropic did not want to allow the surveillance of citizens in America. They didn't want to use their weapons for certain things. They didn't want the monitoring things. Friday was the deadline. OpenAI stepped right into that role, said, we'll do it. And then Sam Altman is trying to walk back the statements like, oh, well, we still want these protections, because his staff was upset. They were upset about these things, It's
a bit of a mutiny inside.
So he was trying to walk some of this stuff back, saying, we do care about, we have the same concerns basically that Anthropic had. But he recently just came out, like in the last 24 hours, and said, ultimately, at the end of the day, the Department of War has the final say over how our technology is used. Then he also pointed out that if he didn't step into the place, that XAI would probably step in there as well, which he didn't.
Somebody would. But, I think this will end up in the courts ultimately at some point, because don't you? Because it isn't just the Pentagon or the Department of War has the final say. We're talking about something that gets into privacy laws and all too. So, at what point it's going to run afoul of the laws is going to be some interesting questions come out of that, I would think. I don't know how. I think it's having trouble catching up.
Well, how many times in our lifetime have we seen reports of the government spying on citizens?
I was just going to say, one of the things that I thought of instantly with this going on, like you, I don't want to dismiss it. It's a serious thing, and I care about it. But to what extent have we already ceded a lot of that privacy and a lot of, and I don't mean just voluntarily where we decide ourselves individually to go on to social media and share whatever it is we want to share, but even them extracting. We had these conversations, similar conversations and concerns with the government and cell phone use. There was talk going on about that, government wanting access at different times, especially during 9/11. There was a lot of concern over to what extent the government could look at cell phone data to get information from people, see what they're texting about, what they're sending message about, and so forth. So it's not new. The idea that it's just happening because of AI's entrance onto the stage would be incorrect. And I swear, Google listens to us. I no more say something here at home, to my husband, and then, we get an ad that's related to something we might be talking about. I'm a little more worried about that in a way.
Well, literally, I think it was Apple that was getting sued because Siri was listening to people. So yeah, if you're going to put something out, if you put something out in the ether, you better assume that somewhere something is listening to it, which ties into all these smart systems that we have in our house, all the electronics, all that stuff side back together. You want to tell someone something, just tell them face to face, I guess. A better way to keep it.
Yeah, that good old fashioned conversation, that hasn't gone out of style, or I hope it doesn't, for sure. So we talked about oil, we've talked about Anthropic, war related effects on the market. I'd like to take a little bit of time that we have left here today, Marcus, to focus more on you and how you work with your clients with teaching financial literacy and coaching. And in particular, I think you've adopted a new tool called Monarch. And I'd like to hear more about how you use that to work with your clients.
Oh yeah, Monarch Money. Monarch Money is a personal budgeting finance app that helps people. You can go in there. It has AI in it as well. It's really good for people who are trying to share their information with, like, say, your spouse, people who just start budgeting together, people who've been doing it on paper and pad, want to air all this stuff into their computer. You want to have real-time access to your budgeting, to your finances. I know my clients share their accounts with me or share it where I can go in there and see, and we can talk about things if we need to. One thing I will say about Monarch is I don't want to say this age difference, but it's better if you start out uploading all your stuff the first time on a desktop situation and then go into the app, because it could just be confusing on a phone to look at all that stuff for the first time. But Monarch's a great tool. It helps with personal budgeting. Like I said, I use it with clients. Yeah, and if anyone on here wants to use Monarch, there's a link that you can use. But I will maybe compensate if you use the link for me. Yeah, so Monarch is a great tool. I don't want to jump too far away from the Supreme Court decision, though.
Yeah, no, we do want to. We should cover that. That's another important development. I think even since the last time we talked, perhaps.
Right. So we had the Supreme, and I think some Supreme Court decisions came out today. I haven't seen the results of those. They may be speaking about Lisa Cook, and also Tom Tillis is locking up these passages or nomination process. He said he's going to lock up all the committees he's on now until he gets confirmation or gets answers with Chairman Powell's investigation and maybe even Lisa Cook's. But anywho, back to the tariffs of SCOTUS. So SCOTUS came out with the decision, and as of all things law, like you said, you're up there in DC and you know policy and you know how these things work. It's really what it said, like the decision and the reflection. First of all, the Supreme Court did not give any means for paying these tariffs back, right? Immediately, once the president spoke later on that day, he said this would be in litigation 4 to 5 years. That was his expectation.
And then he had a workaround. He's going through a different act, correct?
Right. Justice Kavanaugh pretty much laid out in his dissent the way that you can go about it. But they had already been planning on this. If this decision came back this way, I mean, that day the markets didn't go crazy down or up because of the decision. That didn't have anything particularly to do with the markets that day. What people were worried about, it was already expected. It was already priced in, per se, that the Supreme Court would go against it. But then he's come back and he said there will be 15% tariffs across the board for everyone, baseline minimum. I heard Secretary Bessent speaking this morning. They were asking when those will go into effect. He said those should be in effect by the end of the week. So we'll have global tariffs at 15%. Those things play into the markets, right? Tariffs and tariff uncertainty. I don't know if y'all are all old enough to remember last February through April when we had the tariff shock, but those type of things play off. So he didn't have any remedy from the Supreme Court. So even if this tariff revenue is to be refunded, like you said, how are we going to refund it? I don't know. I was thinking different ways. Maybe they'll try some type of, I don't think these dollars that are in there are ever going back. So maybe it'll be like
I was going to say, do you think it'll ever actually happen at all?
Yeah, I don't know if they're going to give it back to the American people. Like, I don't know, because who paid the tariff? Because part of it was that the foreign governments were paying the tariffs. But then we had reports coming out, like we said last time, that said the Americans were paying like 90% of the tariffs. So how does this all go back? It's just going to be sticky. I don't think this is anything that is resolved during Trump's current administration.
Well, I'm sure that there was a little bit of strategy around knowing that. Even if it causes a fight, it's going to take a long time to resolve the fight. And that wouldn't happen until long after he'd already made a decision, acted on it, and is out of office. So,
and speaking on the point of view, when President Trump was speaking yesterday about the Iran war, he said we won the tariff case. Point of view, right? He thinks they won, but they did enumerate a lot more powers to him. Well, not enumerate, but they verbally gave him more powers in his mind and his administration's mind that they can take and use to implement more of these tariffs. I think it's Section 301 that they're talking about.
Yeah. Well, I think we're in a different era with this president. Again, not getting political here, but just simply observing, even myself as a citizen, that, we've not had a president in my lifetime, I know, that has been as aggressive with the, not just, intentions or desires to change a policy or do something different, but just going ahead and doing it and then letting the cards fall, kind of, and so I think it's caught Congress and at least some and policymakers in general, sort of off guard, just in terms of dealing with the executive branch in the manner in which it's now the environment now is. So it's fascinating to just kind of watch all of that and see how that's all, how the cards are falling, and for good, bad, or otherwise. But I do think that we're in a time that is a bit unfamiliar in terms of what the president has decided he's going to do, regardless of what tradition or the norms used to be, and then just seeing how all that works itself out.
Well, as we mentioned before on previous episodes, that the executive branch continues, and this did not start with Donald Trump, continues to increase their power. And the Congress just seems to continue to let them do it. So that's who has to come in and kind of balance down the president's power or the Supreme Court. So, right, the checks and balances in our government have to come in. But the executive branch historically continues to get more and more power. They're voting today on the war power resolutions, which even if it passed, Donald Trump's not going to sign it. So
no, right. So there you go. Yeah. But, in terms of what we talk about here and the effects that these things have on markets, is it fair to say, we can kind of wrap up with this, but I want to give you an opportunity to talk about anything remaining that you'd like to share with the public today. But is it fair to say that the markets are taking a cautious sort of behavior right now? I mean, you don't see any massive fluctuation or reactionism that I can see. I mean, it seems like there's a little bit of ebb and flow, but we don't see a massive drop or spike or anything like that going on, or am I missing something there? Are they just kind of waiting to see?
All right, so let's talk about what happened with the right since the attacks. Oil prices initially spiked, crypto flushed, crypto came back. The dollar firmed up a lot. The dollar started to firm up. I don't know if people noticed this. The dollar firmed up, gold prices went down. We had this precious metal move.
Gold high for a while.
Right. It's still very high, but it's come down. So I'm like, gold's still historically high, but it's come down to all-time highs. Gold and silver have started to trade like kind of meme-ish now with like meme stocks with these moves up and down. We've seen the 10-year, it dipped below, I like the 10-year treasury note. It dipped below 4%, but now it's back above 4%. So generally, if you were thinking people were running to safety, you would see the opposite, right? You would see these yields get lower because people are selling bonds, right? You're going higher because people are buying as a sign of maybe more confidence. And then as the dollar is going up, increasing their strength, you see gold go down. It's just so there are things moving, but the stock market itself, like from Monday to today and a few days, it's just been a couple of days. But if you didn't see anything, you just looked at your account Monday and you looked at today, it wouldn't really be very different at all.
Yeah. And then, of course, we can't forget the housing market, which we often talk about on here, too.
Yeah.
Mortgage rates have dipped below 5 or at 5% in a lot of parts of the country, even in places like where I am, where, they're very high comparatively to the rest of the country. But in some parts, when you get out of the metropolitan area and into the suburbs, the rates are coming down.
Yeah, mortgage rates. So another thing that we saw last week, like I said, so with the 10-year, that's why I look at 10 years usually somewhat tied with mortgage rates. We saw the average down to like 6.09%. It was the lowest since 2022, maybe. We also saw a lot of people looking to file refinance applications. Last week was a strong week for the housing market as far as like activity goes. But what people realize or don't realize is that if you do refinance, you have to get about 75 basis points, 0.75 for it even makes sense to refinance. So is that spread large enough? I don't know. I think the mortgage rates are going to stay right around where they are now. Speaking in mortgage rates and supplies and tying it all back to jobs, because we have to have jobs in this consumer-driven economy. Secretary Besson was speaking about jobs, how they work. Say you're building a data center, right? You're building a data center, you need 3,000 people to build it. Then eventually just 3,000 people, once they build a data center, this data center is going to create, this example was 3,000 jobs or 4,000 jobs. Assuming some of those people go inside that data center into that job as well. So as long as it can create more jobs with the housing, you're like, what does this have to do with housing? It's the same type of thing, right? These people are building houses, earn income, then they can buy houses, right? Which is an economic boom for the whole cycle when people start buying houses again. But interest rates definitely have things to do with that. The tariffs have to do with that. It's all intertwined. We haven't even spoken about Kevin Warsh or Chairman Powell since they didn't have a meeting.
Right. Yeah. So is there anything as we wrap this up, is there any last thoughts you want to share on that?
No, it'll be interesting to see if the Fed can lower rates as people expect. I think they have to stay steady for right now, stay put until they see something decisively or definitively. They will have the benefit of a little bit of time before they're meeting with the war and everything that's happening. But they have to stay diligent and look for the direction. As I mentioned with Chairman Tillis or with Senator Tillis, he's not letting anything move through the committees right now. So that stuff's locked up. So yeah, we'll just see what Powell does, how data dependent they are, because the data is kind of mixed up. And people don't realize that we're still in a partial government shutdown. So that kind of stuff plays into it all too. Like
Sure.
TSA funding being targeted when we're in a a war across seas. Like we need some security at home, increase homeland security. All that stuff's kind of tied into it. But and the Trump baby accounts, those are active now. People can go sign up for those.
And you have a great video on your YouTube channel. Do check this out. I blocked some time the other day specifically to just watch this. My kids are grown, but I'm going to be a grandma at some point. Not yet. No word of that yet, but I look forward to those days. He does a great job. Marcus does a fantastic job of walking you through step by step, showing you online the IRS site where the Trump baby accounts, where you sign up, what the eligibility criteria is, how you get your child signed up. So do check that out. And he's very prolific as well on LinkedIn. I know you, Marcus, I think you had a special segment and then maybe that very one on LinkedIn as well. So if you're someone who spends a lot of time on LinkedIn, as I do, and Marcus does, you can also find him there as well. Marcus, great conversation as always. I know Marcus, folks, check him out on LinkedIn. He has a YouTube channel, as do I. Policy for Normal People is a free opportunity for you to promote your business. I offer that as a community service for business and nonprofit leaders to come on and talk about your mission and how your industry intersects with policymaking in this nation. And that's it for this time. Marcus, have a great week. I will see you in April.
Thanks, Christy. You have a great one as well. Check out the Main Street Meets Wall Street podcast and the Wall Street South Journal.
Absolutely. Will do. All right. Thanks. Bye-bye now.
We've covered a massive amount of ground in this special series. From the 2-hour institutional deep dive in part 1 to me and Christy's policy breakdown just now at the end of this one, you should have a much clearer picture of how this wartime economy is functioning. But remember, this is a living, breathing series. Because the world doesn't stop moving, we don't stop analyzing. Keep your eyes peeled. Next month's war report will be dropping soon. We'll be breaking down the latest escalation and how the shifting geopolitical lines are impacting your purchasing power. And remember, another good thing of the war report is that you have live sessions. So if you ever want to catch us in one, hop in, leave your comments. We'll respond to you. If you're on the go, make sure you subscribe to the Main Street Meets Wall Street podcast. I go even deeper into these topics during my commutes, where you can go even deeper into these topics during your commutes, reviews, workouts. And if you haven't seen it yet, go back and watch the 2-hour session in part 1 to get the full context of what we discussed today. Hit that like button and subscribe to stay in the loop as this series evolves. In the comments, let me know, what policy shifts have you most concerned in the current environment? Once again, thanks for joining in this special sub-series of the Main Street Meets Wall Street podcast and Marcus Sturvitt Sr.'s YouTube channel, The War Report. Part 1 was the calm before the storm. Thanks for listening to Part 2, Main Street Heart meets Wall Street Smarts. Most people think that the first casualty of war is truth. They're wrong. The first casualty of war is clarity. When the first shots were fired in Iran, the world's attention turned to maps and troop movement. While the world was watching the headlines, the master ledger was already shifting beneath our feet. Before we go a step further into the fog, I need you to do one thing. Hit the subscribe button and turn on your notifications. We are entering a period of profound uncertainty, and this podcast is your home for the data that the news cycle misses. If you value this level of transparency, hit that like button now. It's how we ensure the Main Street perspective reaches the people who need it most. Welcome to the official launch of the Main Street Briefing Economic Fog, a new reoccurring series here on the Main Street Meets Wall Street podcast. This isn't just a one-off update. This is a comprehensive compilation that will serve as a definitive economic record of this conflict. Be a part of it. We began this journey today, and we will continue to release these briefings monthly for the entire duration of the war. We are looking at the invisible gears of private credit, the systematic collapse of trade models, and the reality of your portfolio in a fractured world. Our community at the Wall Street South Journal on LinkedIn has already cleared 1,300 subscribers in less than 2 months because people are hungry for this depth. Today, we aren't giving you a summary. We're going into a multi-hour deep dive into the mechanics of the outbreak. To get you caught up, we're dropping our most critical briefings all within just 1 week. Today, we're focusing on February, where we talk about, and it's a rare 3-part time capsule that documents the world as it changed. The first one was recorded 1 week before the conflict, when the risks were still theoretical. The second one was recorded just 24 hours before the first shots were fired. The final calm ledger. And we aren't stopping there. We're also conducting one of these briefings with a kitchen table segment from Policy for the Normal People, focusing on the domestic tools that you need right now. Settle in, grab a notebook, tell a friend, and let's get into this briefing. Oh, another note, these sessions were all live.
What's up, LinkedIn, Riverside, YouTube, everyone streaming. Friday, markets just closed. About to sit down with Mr. Stephen Davenport, CFA. We're going to have a conversation just recapping the markets and what everyone's seen. This is live, so if anyone wants to chime in, ask some questions, knock yourself out. It's a little more laid back today. But yeah, I think we should probably just, let me begin by saying, how you doing today, Mr. Stephen?
It's kind of rainy here in North Carolina, but it's a hell of a lot better than the snow up north. And I'm just trying to figure out if spring is coming or if we're going to have one more batch of cold. What do you think? Do you follow Punxsutawney Phil, or who do you look to for telling you whether it's going to be a nice spring or whether we got 6 more weeks of winter?
I'm in North Carolina, so I know that we can have spring in one day and winter all in the same day. You just never know. There will be some colder days. So yeah, this weather is crazy, Mr. Stephen. It's crazy. You know what else is crazy? These markets, right?
Yeah, I can't believe after that State of the Union, I don't know, there's a lot to unpack there, Marcus, but these markets are seeing things coming in all directions. And I honestly have never seen this kind of things that it worries about, things that it doesn't worry about. Man, it's becoming very difficult. I see more and more people who are getting on the gold bandwagon, and I see more people just not sure about where are rates going. I mean, we could talk about different things, but I just think there's a whole lot of uncertainty.
Right. And we'll get to the rates for sure. I mean, because after this morning's PPI came in and shocked the markets. Well, I don't know if that's what shocked the markets. The markets these markets have been so unsteady. There's been a conflagration of things. So let's start with maybe private credit.
Okay. I think that over the summer, we had a few instances where some of those auto companies had assets double pledged. But this week we have a British company that went under, and they found out that their assets were double pledged. So I think the total losses is somewhere around $1 billion, and Apollo is a part of it, Jeffrey's a part of it, and a little bit of Wells and some others. So when I look at private credit and I see a comment by Jamie Dimon about cockroaches, when you see one, you see many. That kind of makes me a little bit concerned. I don't like to see cockroaches in my house, but I especially don't like to see them in my investment portfolio, especially now that you get closer to retirement. Something like that could upset some of your names and some of your positions at a time when you really need them. And so I just look at what's happening and I say, if Jamie Dimon thinks there's cockroaches that haven't been found yet, who am I? I mean, he's got more people and more insights with the lending book, with the savings book, with the, just all the deal making globally. I don't know if I'd say he's the most informed, but he's a pretty informed investor. And so when I look around, I try to figure out who are the informed investors, and then I listen a little more closely to what they have to say. Who do you listen to really trust when you want to know what's going on in the market, Marcus?
So my approach to who I listen,
besides me, I mean,
well, yeah.
I know I'm probably first on your list, but after me, who else?
Besides what you send me and Adam Park, after y'all send me all your fancy research. No, I like to obviously look things up myself, but as far as there's not one particular person. I know Jamie Dimon, he's very bearish. I like to listen to everyone that I can, but people who have insights. I like to hear Brian Moynihan from Bank of America. He has a really good insight into the consumer. So into Main, they really see behind the scenes with consumers, like how consumers are spending. They'll have a lot of reports that come out. So you'll get a consumer sentiment report, say from University of Michigan, where sentiment is really low. And then Bank of America is actually like credit card data and consumer spending is higher. So it shows the divergence. So I just find that fascinating what people say versus what they're doing. So, and Jamie Dimon, like I said, he's pretty much bearish all the time. It seems like he's always worried about stuff. But when you manage that much money and that type of bank, it's one of the largest in the world. So that you would be nervous all the time. So yeah, I don't particularly listen to one person.
I like to think of it as healthy skepticism, Marcus.
Yeah, he's very skeptic. But yeah, I mean, and like you said, he sees a lot of things other people didn't see. He made that cockroach statement. That was last fall or winter.
No, he made it recently in the last week or so.
He made a cockroach statement like last year too about cockroaches.
Yes, he did.
And then
this is not his first cockroach.
Right.
No, this is not his first cockroach, and it's not going to be his last.
Right. And just like cockroaches, you're starting to see things come out. Like you mentioned the bank over there in England. I think it was like $2 billion or something that they lost in fund.
Right.
So that's just, and so another thing, and we're still in this private credit, like think about, and these are the cockroaches that we're seeing, the things that are coming out right now. But think about imagine if we did not have the regulations that we had after 2008. Like this will be hitting the mainstream banks. Do you think this is just a ripple effect that eventually will hit the large money financial centers?
I think that, there's a lot of people that have said that the banks have become cleaner because they didn't engage in a lot of these private company, and they said there was basically the shadow banking that was going on where a lot of these things were being spread out to high net worth investors. I think that when you look at it, private credit right now is over $2 trillion. And during 2008, it was about 1/5 the size, or about 400 billion. So private credit's gone up in the last 12, 15 years because I think that banks have tried to isolate themselves from and keep themselves in spaces where they think they have a better chance. I think that for individuals in this space, you really have to know who is doing the evaluation and what is the space you're in. I've got a private credit investment and it's apartment rentals. And I believe that, the research that we've done and the properties that we're in are good properties. So I don't think it's a problem. But I can see that some of these companies that are double counting assets and leveraging against, 2 or 3 times against the same asset, that's a problem. Just like we saw in 2008, there were banks and people, that were using the same assets and having lending agreements between multiple parties. It's not a unique concept, but the whole idea was the Fed was going to take a more holistic view. And therefore, these things are outside the purview of the Fed. So therefore, they don't have that type of protection because we don't know who some of these shadow lenders are. We're not going to see who they might be collateralized with, multiple times. So it's another part of the market, Marcus, that I think has to put you have to put a profit size on something like that. Should you be in private credit? Maybe. Should you be 20% in private credit, 30% in private credit? I don't think so because liquidity matters, right? When you want to put things in safer assets, you want to be able to get it. And once you go into these, it can take you 5 years to get back out of it. So that's not really what I would call liquidity that you can use if you're looking to respond to an opportunity or do something with your assets. I think it's really important that we think about liquidity first. If the markets were to go down 30%, what would you buy? Wouldn't there be some things that pop up on your screen and say, hey, this looks pretty good now? And then the question is, how do you finance it? Do you finance it from cash? Well, if you keep too big a cash position, you're going to probably have a problem because you're not earning anything on that cash. I think that this issue of liquidity is what's showing up in private credit. And I think the same thing, is starting to happen with some of these startups in the AI space, in the quantum space. Do they have the liquidity to last through a period of downturn and slowdowns to come out the other side complete or even better enhanced by what they do. I think that's why we all keep a certain amount of safety so that those safe assets can fund our risky assets in times of trouble. And I think it's a part of everyone's, Buffett used to say, you don't know who's wearing a bathing suit until the tide goes out. Well, the tide's starting to go out, and we're starting to see some people that might not have, the right Speedo on.
Got you. Yeah. And so great explanation. Going back to the private credit and how the rise of private credit, just the levels that you mentioned. And like you said, 12, 15 years. So like right after 2012, right around the housing crash, these regulations were implemented and people found ways to go. They had to go to private credit, some of them, because they were getting larger returns. Some portfolio managers said, if I'm trying to beat the market, the only way I can do this is if I have a portion of private credit inside of my portfolio. But as you mentioned, also, you have the liquidity problem, or illiquidity problem, I should say, where everything's locked up in there and you can't get your money out. Or just like, what we see last week was that Blue Owl. So in Blue Owl situation, where you have a company that's locking up their funds, but they also pay some of the fund holders. What were your thoughts on that, Blue Owl?
I mean, I think that Blue Owl, we're seeing, Ares and Blackstone. Some of these parties we've always heard from people, look, if you want to invest in private equity, but you don't want to take all the risk, own the companies that run the private equity. And that's been a strategy for people. And I guess I would say, just as those companies can have good investments and bad investments, you have to really know those companies well to see whether they're in spaces that you feel comfortable with. And like most things, Marcus, you're going to have to endure a little downside. And I think that, look, we've had 3 years of almost 20% returns, right? So what does that tell you? If the average return of the market is 8 to 10, and you have, triple that times 3, I think we're saying the markets have given a great deal in the last 3 years. Would today be, or this year be natural for it to slow down? I think it would. Would the private credit demand slow down be normal? Absolutely. These things come and go, and we've got to be able to deal with it in a way that's not going to change our lifestyle or change our ultimate wealth outlook.
Okay. So inside of private credit, you have private credit is supposed to be a diversifier inside your portfolio, right? So when the market goes down, it should, in theory, go up, right? It should work when the other part of your portfolio doesn't work. But the problem is one of the issues, I guess, inside private credit is some of these S&P companies that we mentioned are tied up inside this private credit. They're going to find financing inside this private credit. They're going to find things to get better returns because they have portfolios that they have to, or returns they have to reach as well. And they have such large budgets and balance sheets inside that. A good way to think about the lockup, I don't know if for folks who've seen The Big Short, there's a part where he just calls his investors. He might send an email and just tell them like, you can't get your money out for like X amount of years. Talking about like I just picture like that's what I picture in Blue Owl when they came out last week or just or week before. Like, are they just sending out emails just like?
Yeah, I think that you have to expect the unexpected when you're in these spaces. The other thing that's a little misleading, and this might be too technical, Marcus, so tell me to stop if I am.
No, go deeper.
But these things are priced by a pricing source, not the market, right? So they go and they hire a firm, and the firm comes every quarter and gives them a mark and says, okay, now these investments are worth $10 million. And you look at that mark and you say, is that really what these are worth today? Or is that a positive number because they're being paid to deliver a number to this firm on how much these assets are worth? And so when you price an item every quarter, it's not the same as the market that trades every day. And so the numbers that you get for these private equity always look better. The reason they look better is because they don't have much instability in between the pricing at the end of September and the end of December. They are able to smooth out those returns and make them less volatile. And by smoothing them out, you take that 17% return that might be the same as the stock market, but it's got a volatility that's half of that. So what do you say? You say, well, this is delivering more returns per unit of volatility. But in reality, it's just not being priced the same. And so how you price things and how you account for the values determines a lot. And I think that when we look at these things, we have to take an educated view and say, I understand that these are different, but is the difference in the methodology significant? And I think it is. And so that's why we have to be extra careful when we think about them, because they're not the same as that company that's reporting publicly every quarter and every day when the market opens, their share. And that's what Blue Owl will be saying, right? I mean, that one day when they announced this, they're down 6.5%. A lot of value in a company disappears quickly, right? I mean, we could talk about private credit, but what about NVIDIA this week? They report blowout earnings. They kill it in revenue. They kill it in forecast. But people start to question, how long can these earnings and these margins be this good? How long can private equity deliver extra return? I think that that's a healthy question to ask. And as you saw this week, even the best earnings of NVIDIA weren't enough for this market. So that tells you the market's becoming less receptive to the same stories that we've heard before. And if the story changes, if everybody goes to a different side of the boat, you don't want to be left all alone on the wrong side of the boat, right?
Right. And coming into the year, everyone was on one side of the boat, uber bullish. Just like last year, coming in, people were kind of bearish, and the opposite happened both times. Got off kind of rocking the start last year, 2025. Then we got into the tariff and economic detox. We saw some turmoil and then took off again later on around April. Going back to when you were mentioning those marks and the rating agencies, that's what you're referring to, right? Rating agencies when you're talking about the marks?
Or the people that do the pricing for the different marks on the different securities. They're consultants. There are different people that will estimate the value of some of these non-public private assets.
Right. So one of the things, Stan, I guess just thinking with the Big Short, because that was private credit that he was using, those structured notes. Like people couldn't just buy those. There's a part where they go to the rating agencies. Do you recall what I'm talking about? They go to different ones and they're like, truth is, if I don't give them this rating, they can just walk right across the street. And for those who haven't heard all the, I did a podcast with James Callahan, who worked in debt and credit ratings. And man, it's fascinating. But we talked about this stuff, like how to go deeper in there. That's an earlier episode in a podcast. But how do you think those things are stopped now? Like what would stop someone from going in there now and just saying, let me give you this good rating because, they're getting audited.
Right. I think that, look, the Big Short is a good example of how that market for mortgage securities was different. I think this time it's going to be different. It's not going to be mortgage securities.
No.
It's going to probably be some of these private credit securities. It's going to be some of these SPACs. It's going to be some of these entities that have been created, with leverage. I don't think that when you add leverage, people understand it helps on the upside, but it hurts just as much on the downside. I mean, I think what happened this week that was more interesting is what happened with AI. AI just seems to, there was a research piece out by a group called Citrini Research. And Citrini Research wrote a letter to themselves in 2028 and said, what's happened since 2025? And the letter outlined what's going on and what they see in the marketplace and how the idea of efficiencies coming from software and software being developed by AI ended up causing a very long cycle downturn where they basically said less software people, more margins in the company, but less software people means that more people are on unemployment, more people are out of work, the overall economy slows down. And they just laid out a pretty, gruesome look on the research piece came out Sunday, and the market started absorbing it Monday and Tuesday, and it just started to go ugly. And then today I see when you look at companies like Block that are doing taxes, they announced they're going to lay off half of their workforce because AI has replaced some of the need for those people. 4,000 people. So when you go into tax season and they're taking half of their workforce away, that tells you they're making a pretty strong bet that AI is going to deliver, and they're going to deliver in ways that are going to allow this company to be much more profitable. Will it happen? Will there be difficulties? Will people start to trust AI with their taxes? It's all too early to tell, Marcus, but that company's making a pretty strong statement when we say, is it possible that jobs could be replaced that easily by software, and that software will continue to be developed by AI, not by people? And so basically you have a software that's creating more and more efficiencies, and it's really frightened a lot of the people in the ServiceNow and some of the names that are involved in software development. So is AI going to eat up software? I don't think it can, but one of the things that was leading it this week is this company came out with a version that can update COBOL. So COBOL still exists in a lot of firms. It's an old programming language that I took when I was a computer major in the 80s. And basically, they're saying we can update any COBOL code to current code just using Claude. So that's how many software developers are out there trying to maintain code in these old softwares that would be replaced. It's a frightening to think that all of that COBOL code gets updated. And then all of a sudden it gets maintained and managed going forward through Claude or through some of these other AI agents. So what's happening with the news is starting to lay out a future, and we're not certain about that future. We don't have, the idea of an economic payment that the government would give for people who aren't working. They've talked about, how do you feel about all these taxi drivers and people that are going to be replaced when Uber has driverless taxis? It's going to be a huge number of individuals who are going to lose jobs, and there's just not going to be that many easy jobs to get going forward. So I look at what's happening with the COBOL code, I look at what's happening with the driverless vehicles, and I think that we haven't thought about all the things we need to put around AI so that it doesn't cause the markets to stop and crater and just create an environment where nobody believes anybody's going to have the revenues to keep the economy going. We're a 70% consumption economy. What level of unemployment would cause us to suddenly have I can just tell you, 50% of the workforce is blocked. That's a frightening number, especially in your first year of using it. Wouldn't you take, even if you could get rid of 50, wouldn't you keep a buffer just so that you can try to make sure it doesn't get carried away?
Yeah, that was a lot. You said you're going to go down that hole, and you did, and that's great. With Block, we'll try to go back and bring it forward. Block, you have the guy who used to own X, right? Twitter. He's known for having a heavy staff. So at a certain point, when Elon Musk went into Twitter, he took out, or X, sorry, politically incorrect, whatever I'm saying. He took down, reduced, so he said 75% of the workforce in there. I know part of that was bloating by Dorsey, but part of that also was probably Elon Musk cutting a little bit more than he should have in the effort to get down. But so I think Block cut like 40%, which is a crazy number, right? Because if you extrapolate that out and companies start cutting 40% of their workforce, that's the kind of stuff that would throw this country into a recession, right? Like, there's no doubt if people start losing 40% of the workforce, it'll be bad, and it'll be bad soon. Interest rates, prices, people can fight with these prices when we have jobs to earn money. Even if we're losing purchasing power, we can last a little bit longer. But when we lose jobs, that's the thing that tilts it. That's why maybe you're seeing the bond market move today. Notice the bond market finally went below 4%, which is just whoa. One more note on because it hasn't been there in a long time. It's been hovering in this range, just like unemployment. You mentioned unemployment. Unemployment's been hovering, 4.5%, somewhere in that range. But last year, I keep going back to last year, and this might even have been late 2024. Those forces, CRM, Benioff, he was on a station saying that he expected AI to replace all his agents. He was going to use all his agents. So when they say things and then we see these things later, I think people are just at a point where they want to see AI. They want to see the production from AI, right? They're getting fatigued, like you mentioned with NVIDIA, where it's range bound and stuck. But was Block up today?
I didn't look into Block. I just looked at the press release, and I know Dorsey is a big player in this space, and I think he wants. I don't want to keep going all over. OpenAI, valued at $790 billion today. They took in $110 billion
from Amazon.
I thought OpenAI was going to be a larger company, but I guess I'm late on the valuation here. But taking in $110 billion now today in an offering, to me, says they're striking while the market is still pretty hot, right? Would you say that AI has gone back to normal and the market valuations are average again? I don't think so. And I think that them getting a valuation like that almost $1 trillion company that's not public. I mean, that's a, I don't know if you call it a unicorn or you call it a super unicorn, or, you know what I mean? I'm losing track of these companies that are so large and still not public. And I think you have to wonder, hey, why aren't they? Why don't they want to come public in the market? And then you see, companies able to do more and postpone eventually having a day-to-day measure. And I think it's nice for them if you can operate there. I don't feel like, I don't know, how do you feel about AI, open AI? Would you invest in that?
Open AI and Anthropic, those type of companies. I actually think I am. So I have a REIT too that I invest in, like Fundrise. Full disclosure, I got to put that stuff out there, right? And they actually just bought SpaceX or OpenAI or something like that. But all that private credit stuff. My approach to that type of things, like you said, this is pre-market. And will I buy it when it goes public? Probably, but not at the IPO. But eventually, probably not the IPO, because it'll be overinflated. But it'll come down at some price. There'll be because what they're doing is like groundbreaking and revolutionary. I think we said this. So for those who don't know, me and Mr. Steven, we're on an advisory board together for his company, and we were talking about AI. And this was a couple of weeks ago. And now I mentioned, like, there are going to be companies that just aren't going to make it, right? That we see right now, like big companies, big names that we see right now. And I'm not trying to pick one or say one, but there will be companies that we speak of right now that are spending a lot of money in CapEx that just won't make it. They just won't be there anymore. Like, think back to the .com bubble, right? How many companies did you see, Mr. Steven, that back then that aren't here now? That's what people want to try to compare this bubble with and this
Yeah, I mean, the pet one was a big one. There's a lot of companies that were based in that time on eyeballs, and that was how they measured it. How many views do they have on their sites? And they thought, hey, we convert those views at a 1 in 100. Therefore, if we get 1 million views, we could say that we're going to have this much business. It doesn't always work that way. And I think that here we're looking at a different variable, which is how much can I improve my margins? How much can I reduce overhead so that my corporation can compete with other AI-generated corporation and products? And I think that we don't know the speed, we don't know the overall demand, and we don't really know, like, as this Citrini article said, we don't know if all of a sudden this loop stops and we start to say, maybe we shouldn't be taking all the humans out of these corporations, and we should keep them in such a position that they're not just causing the workforce to be decimated. I think we're going to have to deal with the workforce in terms of taxis and what's currently done with truck drivers. Those type of driverless technologies and how we deal with them, I think, are going to be a big indicator as to how AI and ultimately the whole economy deals with a transformation. What are these people going to do? How are they going to be retrained? How do we create a situation where they can be out of work, but the economy isn't cascading downward so that they don't have any opportunities to get back up? And I think that when we look at us as an economy, we all talk about, hey, the market's going up, we're all happy. Remember, only 50% of the population owns stocks. 50% does not. So when we say the market is good, therefore the economy is good, it's good for a part of the population, not the whole population. So I think that when we look at these things, we need to put them in perspective. And I think that the Fed has this dual mandate. And I think there's going to be a little bit of a problem with how do I still see inflation and how do I then also see the need to cut rates? It's a conundrum, and I don't think it's going to be easily solved in the short term. Because look, I don't know how the change in direction for tariffs from Trump is going to move things. I mean, I think if I go to the next topic, Iran, how is Iran going to move markets? Is there going to be an event? Is there going to be an overthrow? Or is the religious government going to be removed by force? Is the U.S. going to be doing it? Or is it going to be a joint effort with multiple countries? I understand Iran has a history and a great culture. And I understand that, there are people who want change. But as I said, Marcus, how much change are we good for? If we have AI redoing the workforce and we have people in capital markets and investments that are going in a direction, can we absorb Middle East conflict just like it would in a time of what I'll call more normal markets. I have a feeling we're reaching a little bit of a breaking point. I just see that a deal is within reach with Iran. Just came across my screen.
Really?
What do you think of that? I mean, will the markets react positively to that?
I mean, where's the reporting, right? I mean, I guess it depends. Oil prices should go down. They've been up. The market should react positively to that, man. If there is really a deal, I mean, there was tensions. That's one last thing off the market's plate right now. The market has so much on the table. The market wants clarity, right? The market doesn't like all these different things going on. So the threat of us going into Iran and doing whatever we were going to do in there, I don't know what the full plans were. That was going to disrupt the markets. As you saw, I mean, we've seen it. The market just had so many things going on. We've had the SaaS sell-off. We've had the private credit issues. We've had the actual data that's come out, like you were mentioning earlier. Where are we at with the rate cuts? Where are we going to be with that? Like Powell's probably going to have to hold steady. We have Warsh coming in. And then, yeah, like you said, breaking across the tape right now is Iran. So I don't know. Maybe I'll look and see what it did after hours.
Yeah, I mean, I think that, Iran is under a lot of pressure. I think that we've got pressure in Cuba with that regime. They're not getting supplied oil from Venezuela anymore. I think that these areas where we don't agree with, or, we don't support some of these governments that we think are doing bad things for the people. And then we can transform some of them, but can we really institute long-term change? I think we can say, is Venezuela better without Maduro? Perhaps, but if his assistant, executive vice president becomes the president and all the same people stay in place, have we really changed Venezuela? I don't know if we have.
Well,
and I think the same things.
I was going to say, I think the world remembers, or the U.S. remembers, when we went into Iraq and eventually got Saddam Hussein, like that country just was in turmoil, that the internal systems weren't there. So that's probably a big part of it too.
Yep. So I guess I would say, Marcus, the same things that I recommend when markets are calm is you always need to have some safety assets that you can take advantage of a downturn if it occurs. And I think that some people look at bonds and say they're not useful. They're not giving me the same returns I need from equities. I want to have the higher growth asset. And my point is that you got to assume that the market has an up period and a down period. And you've got to build a portfolio that can sustain itself in both cases. And that's really what I think. People have had 3 years of positive returns. And so now I think they're looking more closely at where is the next, blind spot? Where is there something that I can't control? And what do I need to do to make sure I'm safe? And I think that it's healthy. I know we make fun of skepticism, and you're a more upbeat guy, and I'm a more skeptical guy. I think there's room for both of us in the markets, because I think that in general, it's good to have dialogue. What I saw recently was worrying a lot of people is there aren't people who are willing to step up and be skeptical about AI. Is that healthy? I don't think it is, because any idea, any change in technology, any new process is going to involve change. And that change just needs to be kind of verified and understood by even guys like me. You know what I mean? If we can convince the economy that it can operate in a new mode, a new challenge, a new way, I think it can be accepted by people. And right now, I guess I don't see the support around some of these AI technologies that creates, an environment where they could streamline a company, and the people who would be streamlined or eliminated could have other opportunities to participate. Do you think that AI is, in a position to make the changes that it talks about, or do you think we'll see with Block in the next 6 months during tax season?
Okay, yeah. So I use AI, right? I use AI for a good bit of things, like I use it for editing videos. I use Riverside. But as far as I think a good use for AI would be if we are going to have hot wars. I know a lot of them are fought from distances. Why don't we have some AI robot soldiers that we can send in there and keep these troops out, like actual combat? One thing, I know we use drones and things like that, but where are we going to get that later? Let me see those type of AI use cases, right? I think that AI, we spoke about before, you have to adjust and adapt to AI, because AI is coming to take over. I say this tongue in cheek and jokingly, like AI scrubbed all the internet. I think we mentioned on the podcast we were on together, how AI has its own like social network now where it's just AI bots. I'm convinced that AI is just like waiting for Arnold Schwarzenegger, to leave here because they've watched Terminator and they know he's like the only one who can stop them because that's what they've derived from it. Like, so, I just don't know with AI, but I do think AI is going to destroy some jobs. It'll disrupt some jobs, and it'll definitely create some jobs. Which one is it going to do more of, right? I want to ask.
Well, that's the thing. I saw a demo today of robots in China. They have a Chinese robotic company that was showing off the robots, and they were doing handstands. They were doing, all of these different things. When you think about a robot, think of kind of minimal movement, and now the technology and the way they've developed them, they're multi-hinge, multi-directional, just forces that can do a lot of things. And I think that we've got 4 to 5 bridges to go over in my world. We need to get over the driverless car. We need to get through, using robotics to replace some of the factories and some of the labor that is hard to do because it requires, environmental damage and other things. So you can't have people doing it. I look at these chip fabs and I wonder how much of the chip fab is going to go towards robotics because, do the people or the robot deliver better technology, better ability to make decisions and do things with chip fab. So I think there's a lot of things to come. And I guess I would say I need to understand better how the process is going to go. And I'll be looking very closely at, at what I'm seeing with the taxes and block.
Yeah, so you're watching block. It's almost like, I don't want to say you were short block, but you definitely have some skepticism around block right now from a skeptic.
No, I liked block. I used block for years myself. And now I have a person who does my taxes. And I used to, I did them until 2 years ago. So I used to be a big H&R Block fan. So I think of it as having a huge advantage. And what they're doing, I think, is going to be interesting. The last thing I had to talk about today regarding this market and what's happening is midterms. I look at what's happening in the Senate and the House and the number of people retiring. And this election in November is really going to be a referendum on Trump. And is it going to be a referendum that says, yes, we're happy? There's a lot of people arguing about affordability. And if affordability doesn't come down, especially in housing, I see there's going to be a problem come November for Trump. Do we really think inflation has been slayed? And if so, we think the Fed is going to lower 2-3 times before October and create a better market for housing? I'm not sure. I think that that's one of the main issues and why he put Warsh in as the new chairman of the Fed was to deliver lower rates. I'm not sure whether some of these things are inflationary. If we go to a new set of tariffs, even at just 10 or 15%, if they're more stable and if they're easier to implement, it's going to cause higher prices. And those higher prices are going to come through as inflation. And I think we can say they're temporary inflation because of tariffs. And once people get used to them, maybe they'll stop. But I really don't know, Marcus. As an issue, I think it comes down to what's going to happen and what will it look like in October and November of this year. I think that the bell's been rung, the State of the Union's been had, and I think that both parties are going to work like hell in the next 6 months to deliver on what their vision is. I don't know if any vision is really able to capture everything that's going on right now with ICE, with AI, with Iran, with, we still have actions and finances, subsidizing Ukraine. It feels like we've got a lot on our plate, and that's not saying anything about Taiwan and China, which I still think are a factor. Should we, if the election were held today, what do you think the referendum would be?
Well, Americans and people in general vote with their wallets, right? Like, we say what you want, but when prices get too high and people can't afford things, inflation is crazy, people vote with their wallets. I'm glad you brought up the midterms, and we'll definitely dig into the State of the Union a little bit as well. But with the midterms, that's also a thing where the markets tend to have choppier years in midterm years. So historically, you'll see a little bit of chop in midterm years. So we can see that right now, but in the second half of the year, once you get a little bit of clarity, usually after elections, you can expect to see a bump or a rise in some of these stocks. Also, with the midterms right now, like I said, we're speaking about people paying with their wallets, and we've noticed this movement out of stocks. I think maybe another thing that we're seeing are people are finally getting to the point with affordability where they're having to sell some of their stocks to pay for things as well, too, right? Because you have this paper wealth, but it's not a gain or a loss until you actually sell it. So people are sitting here, or maybe they've been pledging them against things, pledge back their securities and using them more, but now they're just actually at the point where they have to sell them and they're paying taxes or they're looking for big refunds. It's very interesting. One of the things that jumped out to me inside of the State of the Union was when President Trump mentioned that he was going to create an account to match 401ks for adults, right? $1,000 match. Like, I didn't run the math on that, but that's crazy math. And
well, I think he's only doing it in places that it doesn't exist.
That doesn't have the match, right? That's what he said.
It doesn't have a 401k, and there's no, and so I think that when you isolate that part of it, I think you're talking about somewhere in the order of 60 to 90 million. I don't think you're talking about, I think you're talking about 20 or 30%.
Did you say hundreds of millions? I'm sorry, I didn't hear the number.
I think you're talking about, if the U.S. economy has 360 million people, I think you're talking about a working population of 160 million. I think you're talking about 10, 20, 30%, which would be 15 to 45 million.
Yeah,
so yes.
Well, that's economically feasible.
15 to 45 billion if you take the $1,000.
There you go.
Yeah, if you take the million and say you're going to get $1,000 to each of those people. Look, I think when you're on the stage and you're talking about the future, we all want, I want to look good. You want to look good. We all want to sound good with our future analysis. We don't want to sound like what we're saying is anything but going to be great for the population at while, overall, right? And I think that State of the Unions are kind of that wish list. And so we've heard the wish list, and it could be great for some of those people. I think that the space of people and retirement assets, we haven't done enough for people. We haven't done enough if we've not created national 401ks until 2025, 26. In the 70s and 80s, we knew that this was going to be a problem when people stopped getting pensions. Yet we have all of these people who don't have an access to funds. And I think that retirement is one of the biggest expenses that you need to plan for. So how we do things now, I think it's like we deserve to give these people more attention and we deserve to stabilize Social Security.
Well,
we keep talking about Social Security, but we're not really answering the question about how it's going to become more solvent.
Okay. Hold on, Mr. Stevens. So you said, right, and pensions, it was proven mathematically these pensions weren't working for these companies. That's why they stopped doing them, right? There's still some places where you can get pensions. But so you said like late 70s, early 80s, and I agree, like people need to have some type of retirement set up for them when they retire, like better than just Social Security. But it's funny because the people that set this up are the people who are now at the age to receive these benefits, right? People in the 80s, 20s, 30s, now they're 60s, 70s. So they're in the mix of it. They didn't, this is like a pure American problem. What we do, we just kick it down the road. We kick this budget and debt and everything down the road, and then we try to solve it again. So is this going to be something like that my kids are going to take care of now? It's just, and I'm being rhetorical with that question for anyone, and anyone who's listening, please feel free to put some questions in the chat. Me and Ms. Chi will love to answer it. But yeah, what are your thoughts on that?
Yeah, I'm not going to worry. I'm 62, and when they change the age from 67 to 69 or 70 for people to get full retirement, it will be retroactive to only people who are 50 and below. It won't affect people within 10 to 15 years of retirement. So when you think about that, it's a little bit more comforting. You probably will have a higher retirement age because you're like, 22, 23 years old?
Yeah, time's something.
It's and so I don't think it's funny, but I also think that, like you say, we've been kicking the can and now we need to do something. I think it would be great if we said, hey, any new tax increases go to the deficit. Make some statements with our planning in our future that just start to address things. I don't think you're going to solve things. We're a country of gradualism. We gradually went from doing things wrong in many senses to try to improve things. And overall, the gradualism will be effective in something like Social Security if you do it soon enough. But if we don't do something about the debt sooner, it's likely to cause an upset. And I was waiting after what happened with the Supreme Court rejection last week for somebody to say, what if we had to give back the $170 billion we collected? The government's got to take that out of its account and give it to individuals and companies. And then you say, okay, where are we going to get that $170 billion for the next 10 years in the government's assumptions for the one big beautiful bill? That's 1 point. Where are we going to find that 1.7 trillion? And that's where I think this market with higher debt is more susceptible to a reaction that we don't want to have.
Okay, hold on, Mr. Steven. I have a theory on that with the debt or the tariff refunds. First of all, I don't think any tariff refunds are going to go back out during the Trump administration. He's already said that they're going to take this to litigation, and the Supreme Court really dropped the ball by not ruling on how you put this back, how you refund this money and kicking that back down to an appellate court. But I also think like if there ever is money like refunded, that it'll just be like a debit back on the sheet. But who does it go to, right? Is it going back to the country, or are we going to get Trump checks because everything has? Are we going to get, Are we going to get stimulus back into the economy? I heard someone say everyone should just get 1 day free in America where they can go shop and buy whatever they want for free. But seriously, what do we do to get it back in? But I don't think the administration ever just giving it back. Not to the countries. No.
I could see, when I hear about them giving soldiers a military bonus of $1,000 for every soldier in America. I mean, Republicans want to get reelected. They have a voting block. And if you do things to stabilize that voting block and make them incented to show up, they gave us $1,000 refund check for our service to our country. All police, fire, all workers who are central to the operation of the country, you can do that. We had the refunds and the stimulus checks during COVID, helps the economy get started. Eventually you start to look at these things and say, these are all just vehicles to get people to feel good about their government. And if I could give each of my kids $1,000, would I be more popular or less popular? I mean, if I wrote those checks and gave them out, I think I'd probably be more popular. I mean, it's really simple. We're supposed to be doing things with what we have, not taking money from the future and giving it to people today. It's a one-time thing. It's not. I agree that we should cherish and reward our people in action. I think we should do it all the time, though, not for a one-time action, but let's set up something that makes sure that we have the best forces and the best people. I think one-time $1,000 checks are just, it's just kind of like a ribbon on your, I think it's a nice gesture, but gestures don't make, a country strong for the future. Gestures make people feel good temporarily so that they'll vote a certain way. I don't think that's what we need right now. I think what we need is more of a long-term commitment to the education, to the health, and to the wellness of the overall community.
Yeah. And you speak about stimulus and bonuses, and if I remember correctly, I'm thinking back. I'm old enough to remember, one, I'm old enough to remember when a budget was balanced. I think that was Clinton. Two, I'm old enough to remember, I think Obama, first Bush, Obama, Trump, and Biden all sent some sort of stimulus into the economy, right? Then they all sent us a check at some point. Maybe not.
I think.
But I'm sure, especially with COVID, didn't Trump send one and Biden send one? I don't know. My wife just those things. I don't even look at them.
There was two or three checks, and I think at some point you realize that this is really important for one part. I mean, Marcus, the thing that we didn't really solve with COVID was who would it really affect, and who do we really trying to help? Right? There was people who were less healthy, who were overweight and had other health complications. They were most in danger. But as a country, we didn't decide to try to help them. We said everyone needs to lock down. Did everyone need to lock down? Even the people that were extremely healthy and well, I don't know. I think we don't want to segregate our country into the haves and the have-nots. And in that case, we just said everybody gets a stimulus check, everybody stays in lockdown, everybody needs to get a vaccine. And it's nice to think that, we're going to be so democratic to everyone. But in reality, we had ways that we could have done things more efficiently. And if we did it again, I think that most people would have said some type of, evaluation on different people would have probably allowed an economy to run at 50, 60% instead of shutting down completely.
Yeah. And we all know hindsight's 2020, right? And maybe Chairman Powell actually got it right when he said that some of this inflation was transitory, but he just really mistimed it. And then there are ways of pulling it down because these stimulus checks, that's kind of what we're feeling right now. People don't realize this inflation's all still coming from that money that was pumped into the system. And like I said, that's when you saw stock market starting to go up. Maybe people are starting to pull that money back out. The country was at record levels of savings. Like you said, we turned into a consumption economy, which is another difference in between like our last like revolution, industrial revolution, I guess, which created different types of jobs. We were a different type of economy then, right? So how does AI play into this consumer-driven economy?
Once again, I think it's like what happened with the computer. When the computer came, and the computers became no longer tied to mainframes, but individual computers, there was transformation. It a lot of companies to have computer resources never had them before because they couldn't afford a mainframe. And now we've got in your pocket what would have been a mainframe in the 60s, right? You have technology and power that no one else would have had. I think that the transformation of that technology and power is now moving to the clouds where there will be AI agents who will help us do things. I think it's gone from our phone to the cloud, and now we've got to figure out those things in the cloud. How do they help businesses run better? But I don't know. Are we trying to get to 5 or what? Is there any questions out there or anything you think we should talk about before we wrap up?
I don't know. Does anyone have any questions? I don't see any questions in the chat, but maybe I'm not in the chat.
Right.
Yeah, there's always plenty to talk about, Mr. Steven. Let me see what else we had on here today that we wanted to chop it up about a little bit. I mean, you mentioned NVIDIA and the AI. I mean, let's just talk about so today, what are you seeing when you're talking to your clients? Are they worried about stuff? What are they worried about?
I would say that people are in general just still trying to figure out what's the future. We have a question about, for a very high net worth clients, how much should be private, how much should be public. And I think that there's still a question about gold and silver as assets if inflation does rear its head. I still kind of believe that they are a solution, but they're not a large scale solution for what you're doing. I still think you're better off buying some equities that have lower risk and have good dividends. That'd be my choice versus gold or silver. You can buy gold and silver miners, but it's really very regional. Where these miners exist, are there labor problems? Are there problems with the environment? Are there problems? Gold and silver are, materials just like all the materials we're talking about for some of the AI facilities and servers. We don't know how electricity and how some of these things will impact different communities going forward. So I'd say most clients are feeling in a sense of uncertainty. And I think that sense of uncertainty is making them hesitate as to how they want to invest going forward and how much risk they want to take. I think we've had a great run. And therefore, I think that people are naturally saying, hey, I never thought I would be worth X this quickly. I almost want to, I think people would like to take some off the table. And that's where I look and say, the question about debt is not just one for the government to answer, but it's one about whether individuals, how are we going to pay for it? Because ultimately we do, how we spend our money and how we realize gains ultimately create funds for the government to do something about the debt. And I could see somewhere where you would take, individuals with, earnings over $1 million and take some of those millionaire taxes and apply them to the debt. And in that way, they're making the country more stable and they're helping the future in such a way that it really affects everyone because everyone owns a piece of the debt, right?
Well, I mean, everyone definitely owns a piece of the debt. So would that be the same thing on the other side as like the Trump baby accounts just sticking into the State of the Union? And I'm looking down there was a comment that was a question I was trying to find from the podcast we did. That's what I'm looking for. It was about ops.
Okay.
Can't seem to find it.
Oh yeah, I think I answered that question, but
you already answered it?
Yeah, I think I did put an answer out there. I think, Marcus, that the use of options and the use of these different strategies and what you're trying to do to connect Main Street to Wall Street, I think it's a great thing. And I think what we're trying to do is talk about issues in common sense terms so that people can either feel better or do things better with their own money so that they ultimately can find a better place in financial wellness. And I appreciate what you're trying to do. I think it's really great. I think that, the next one of these we do, I hope we have more listeners and more people, and we can break down some more issues.
Yeah, I think more people coming. I appreciate you taking your time to hop on here with me and just help Main Street, meet Wall Street. Just some of the different terminology and jargon that is thrown out in the world, just where people they may get confused, and when people are scared, they just usually say no, or they don't make any move. They get paralyzed. So yeah, one of the big things that we're trying to do here is definitely spread the mission, spread the words, financial literacy. Like I said, you can find me and Mr. Steven both on LinkedIn. He's with financial literacy programs. He has some very cool tools that people can use online and YouTube. Yeah, well, we have a couple minutes before we get off. Like, tell people where they can find you, Mr. Steven. Tell people what you do. Why it's okay for you to hop on here and just talk about this stuff. Like, who's this guy?
So I was part of a CFA group in Atlanta called the ASFIP Foundation. And the foundation was formed to help financial CFAs improve the financial wellness of the community. And what we did is we developed a series of 12 videos, each 3 or 4 minutes long, that have a central idea: budgeting, paying yourself first, investing. Each idea we tried to break down into 3 or 4 minutes where you had 1 or 2 things to do to try to help you to do that task and put yourself in a better position to start adulting. It's meant to be people in high school and early college and people who are starting their financial lives. I believe that one of the things that's funny is we're all missing one semester in our education. And that semester is, how do I invest and how do I live my life in a way that's financially, successful? And I think when we talk about our health and we talk about our wellness and we talk about our mental health, but we need to talk about our financial health as well. Part of going to ASFIP Foundation, there's an English set of the videos and there's also a Spanish set. During COVID, we weren't able to hold meetings with people. So we took all the money we would have done enhancing the software with a Spanish language and also in Spanish text. So overall, we think that those are assets for people to use, and we hope that people will go online and look at them and use them and share them with families and friends, because all of us need to help each other. This isn't going to happen with one person or one organization. This needs to be a global effort. And that's what we want to do, is to try to make it more talked about, because if we don't talk about the problem, it's really hard to solve it. And that's why I think what you're doing here, talking about the markets and talking about Wall Street, demystifies it and makes it part of everyone's life. And therefore, they feel better about their investing and they feel better about their futures because they understand more. It's about understanding. It's about working together. And I've enjoyed working with you, Marcus, and I look forward to doing more of these.
Yes, sir. It's something, yeah, if the people want it, we can just hop on, we'll hop on and talk. I don't know, once a month. We'll do this on some Fridays. We just hop on to recap the market, what's going on with it. Where can people exactly go to find those videos on YouTube?
It's ASFIP Foundation on YouTube. So ASFIP Foundation has a new website I found out today, and it's just as I said, asfipfoundation.org. And so you can find there more information and links to the videos. You can go into YouTube and type in ASFIP Foundation, and you'll find it there too.
And if they want to find you, where can they find you, Mr. Steven?
I work at Circa Capital, CIRCAP.com, and we're an advisor to families and individuals, and we're trying to help people with better balanced investment advice. So I'd love to talk to you, help you move along and put your assets into things that you can watch grow and give you greater financial stability. So CIRCAP.com is where you find Circa Capital.
Very good, very good. And I guess before we hop off, is there any updates on our end?
No, I don't see anything except that they're optimistic. So I much rather hear about optimistic than antagonized.
Okay.
So I think that's what we're all looking for, is something good to happen. And I look forward to hopefully de-escalation and moving some of those military assets out. And let's get back to talking about trying to make the economy and the technology and the United States better.
And one last question, I guess I need to ask you this before we get off. People are on here and that we're talking about the markets and updates. The Dow is down 600-700 points. Are you buying the dip? Have you been buying into these dips?
I have assets that I put aside that I want to start buying. I don't think we're there yet. I think I would expect another 10% drawdown.
10%?
And then I would start. I think another 10% is where we're going to get to that will be a place for us to put assets back to work. I kind of believe that one of these events that's going on in terms of credit are going to be a precipitating event that are going to cause a further escalation of uncertainty in the markets. And I think that uncertainty needs to be resolved. And we think we need to, do something about the visibility and the exposure to private credit among major banks. And then I think we will see a stabilization in the banks, and a stabilization in the banks will lead to a more stable and a better environment for the market.
That's the skeptics thesis right there. There you go. I can dig it. I can dig it 10%. And that's noting that the Dow was down for the first time in 10 months, 9 or 10 months. The stock S&P had its worst month since maybe April of last year. There's still a little bit more to go down, according to Mr.
We had 3 years of greater returns, Marcus. It doesn't, I think it's healthy. I think disagreement about markets is healthy. I think that being skeptical about the future and trying to figure it out so that everybody understands it is healthy. I know it's difficult to have this uncertainty, but ultimately I think it leads us to a better place. I would much rather do this than say, I think the market's going up, and you say, I think the market's going up. We all just talk about an unrealistic expectation that leads us to inform people in ways that they're going to be biased. I don't want to be biased, positive, negative. I want to be biased in the present as things are. And I hope that what we've done today is have a good balanced discussion. I think it was. What do you think we could have done better today?
Got a few more people to tune in, but who knows? I mean, I think we've given a lot of value today. A good synopsis of where we are right now. I mean, we literally had some breaking stuff happening just with Iran. I think if people want to get more technical, they should go to the podcast because we have some good stuff on there where it gets technical and deep dive breakdowns on the podcast, Main Street Meets Wall Street, or they can read our newsletter somewhere, the Wall Street South Journal on LinkedIn. Check us out there. This was really good for anyone who's just getting off, seeing the madness in the markets today or this week or this month, and just wants to know what's going on. I hope we help people with that today.
Yeah, I mean, Monday or Tuesday, we're going to have Catherine Carlick, who was a colleague of mine at M&T, and she's going to be on the podcast. She's talking about a website and a charity that's devoted to helping women understand more about money. So listen to the podcast Tuesday. Catherine's Kathy has done everything in this industry, and she's going to be a great guest to talk about how to help women. And I think it's, improving women's investing IQ, just makes us all stronger as a society. So let's keep getting stronger.
Yeah, and women clearly outlive men. So that's where that's the first part of great wealth transfer is from husband to wife, and then it goes down to the kids. So yeah.
Let's not make that transfer too soon, Marcus. You and I have at least a couple of more Fridays.
Thanks for hopping on, Mr. Steven. We're going to let these folks run. I'm going to let you run. Unless there's anything else you want to tell Main Street, anything else you want to say?
No, I think that, check out our podcast, Skeptics Guide to Investing. On Tuesday, we got a great guest, but we've got 135 episodes out there to try to help you improve your investing IQ.
Right. And what did you just put out this week?
Thank you, everybody.
What did you just put out this week, your last episodes? I'm sorry.
The last episode we did was, I think it was talking about gold. And I think we talked about what's happening and what we believe. We also talked about tariffs and whether we believe the new tariffs will come and succeed or whether they'll be somewhat limited. We're hopeful that maybe this tariff thing will go away. And I think there's some people saying this might be an opportunity for Trump to step back from the tariffs. And in that way, this disruption and all the other things would go away. And that would make the markets more stable and more, more positive. So I think the tariff discussion is on there. And I think some gold and silver are discussion. But I think, like I said, next week we have Kathy Carlick talking about women in investing. So just keep, we want to make things better for people. Tell us what you want us to talk about. Tell us what you want to hear, and we'll try to deliver as well we can to make your lives better.
That's great stuff. This week we released part 1 on the debt with James Callahan. James is fascinating. And then with Adam Parker today, part 1 where we talk about research and how he does his research and just markets, tariffs, some of the stuff with disclosures. That stuff's coming out again next week, part 2. So tune in, check it out. We're going to let you all run. Thanks again, Mr. Steve, for hopping on. Mr. Steven, I appreciate it. Check him out. If you have any questions, y'all can check us out. Send us a comment in the chat. We'll respond to you.
All right. Be good, everyone. Have a great weekend.
Thanks. Bye, everyone.
What's up, Main Street? How y'all doing? I got a question for you before we start. This is a question from my friend Sam over here. Sam, is water wet? Is what water touches wet, or both?
I'm not entirely sure. I'm inclined to say that water is wet, but I'm not a scientist, so I've never really thought about it too much.
Perfect. And that's exactly where we are with the SCOTUS rulings, the economy, and everything that's coming out. So part of what we're going to do in this Main Street Meets Wall Street episode right here, we have an insider, business insider journalist, Samuel Brent. He's going to hop in with us for a little while. We're going to talk about SCOTUS. We're going to talk about geopolitical tensions. Some stuff might happen this weekend. We're going live in case you don't know. Talk about the dead money rotation, trade policy, and the kitchen table inflation. And then we'll also talk about Main Street's impact on AI and its disruption. So without further ado, I'm going to go ahead and let Sam just jump in and start talking. Sam, I want obviously everyone has heard today about the Supreme Court ruling. What are you hearing on the inside, Samuel?
Hi, Marcus. Thank you so much for having me. Now, I would say that, well, firstly, this ruling just happened. So I have personally not heard too much. But what I would say is that based on the very smart people, almost all of whom work in finance, who I have spoken to and heard from in the past few hours, the consensus is definitely that this development is positive for the stock market because, as many have said, the uncertainty that has sort of clouded markets for months based on just the sheer not knowing what Trump is going to do, what he can do, and what's going to happen has cast a bit of a dark shadow. But temporarily, at least, that's been lifted. And most people were not surprised that market moves were a bit tepid today because, according to what I heard, it was sort of assumed that this was going to happen. Now, of course, no one really knows how Trump is going to move forward. He gave a statement and he was not happy about the ruling. So we're still in the wait and see phase. But for now, the consensus is positive for Wall Street.
Nice. Yeah, it was interesting when they first announced it. I heard them say something when he was speaking about 10% cap, and it seems like Wall Street was just kind of like, okay, we can deal with 10%. Wall Street, one thing that people don't realize, like Wall Street and these giant investment banks or corporations, they're pretty agile and they know how to figure out different moves and different things. They just kind of want the rules. And like Samuel said, they kind of want to just have a clear roadmap to whatever that may be. On the other side of that, you say, I'm hearing people respond that this actually just created less clarity. As I listened to President Trump's conference today, and he was speaking on things that they can do now, and it may take tariff levels higher, but for shorter periods of time. Are you familiar with anything like the Section 122 or parts where we can only tariff countries where we have a deficit, just different? I know this is all hot off the presses.
I have not heard too much about that just yet. Still looking into it. When my team put out a feature on the impact today, it was mostly with context from people who were reacting to the news and assessing the immediate impact on the market. As far as what may happen in the future, I think it's a little tougher to say. We know that Trump is someone who reacts quickly, and if he doesn't like something, he's not shy about letting us know. But right now, I just think because he is so unpredictable, it's difficult to say. and I think it will be moving forward.
Yeah, and that goes right into the next topic, man. The unpredictability. We're in excessive geopolitical tensions around the globe. We know that we have our largest carrier going to reinforce another aircraft carrier in the Mediterranean. What are you hearing from insiders regarding this move? Are people looking to invest in oil, or what? Are they just taking this as, because Trump's unpredictable? I mean, if you just think back to the original Iran strike, we sent our planes around the other way. He said 10 to 15 days before something happens, but he's not going to just show his cards on this move if he makes a move.
No, absolutely. Now, regarding oil, so most recently I saw an interview with Goldman Sachs's head of oil, who spoke to CNBC about this exact topic. And I believe he said that that their base case isn't too impacted by the uncertainty surrounding the U.S. and Iran's tension right now. Both nations have made it clear that they don't want to back down. And of course, Iran knows that its leverage with the U.S. lies in oil, typically the Strait. And as Goldman's head of oil mentioned, if they were to reduce oil flows into the U.S. just for the coming year, that would severely diminish the U.S.'s supply. And of course, supply and demand math make it pretty clear that this would definitely push prices up. According to what I've seen, prediction markets are pricing for moderate escalation as the base case and the long-term supply disruption as a meaningful but fairly small tail risk. Last I saw, they were signing odds that were roughly 60 to 75% that the US and Iran would see some form of kinetic escalation, which could mean strikes, could mean actions on the oil front. However, they maintain that odds of a full-scale conflict are significantly lower. I think they were in the single digits to low teens last time I saw.
Gotcha. That's very interesting. So odds that you can jump into a hot war, but not necessarily, it sounds like they're expecting for this to be a shortened engagement, perhaps.
That does seem like the consensus as of now, based on prediction markets. But of course, things can change quickly. I know that Trump gave some statements on, I don't know if he gave statements, but I know there were headlines on Trump and Iran today. Was focused on other stories, so I was not able to look too closely. But it does seem like that is the consensus right now, that traders are not anticipating a significant spike in oil prices, but with the lack of clarity around what's going to happen, they can't roll out some risk that would push prices higher.
Got you. I've never played the poly market, so I don't quite understand. I understand the work. I've never done it, but I know that the odds are like they're higher or lower depending on how far out you're investing or into the when it's going to happen. The hit, the action, the kinetic motion inside of Iran. And do you know like what the odds are if it happens like this weekend?
Not specifically. I had not looked too recently, but the odds I mentioned were from, I believe from, I think yesterday. So they're pretty current. But as I noted, they can change pretty much on the dot.
Yes, they can.
Not how people are feeling. Sometimes it's reactionary.
Right. Do you think poly markets, and I'm sorry, we're veering off a little bit. Do you think poly markets have become like predictive markets? Like it seems like you can pick the winner with those.
That definitely seems to be the definitive consensus. You might have seen that the Federal Reserve just put out a report on Kalshi, poly market's biggest rival, essentially touting its prowess as a means of gauging economic outcomes. The power of these platforms has certainly become undeniable. I remember when they were just for sports gambling, people would laugh about how you could bet on the weather, but now they're everywhere. And there's no denying that investors are using them for other things. A while back, I spoke to Danny Moses, the trader from The Big Short, if anyone has seen that film.
Great movie.
He was happy to tout just how important prediction markets are as a tool in the investing world.
Got you. What's his forecast for the world right now? Is he a pessimist, a bear, I guess? Michael Blurry clearly is.
The last time I spoke to him, he was still bullish on the AI market. As far as the world goes, we didn't discuss that. When it comes to conversations with people in the financial sector, I try to stick to financial questions.
And now we're going to shift into this dead money rotation, man. That was a great explanation for Main Street, right? There's been a growing narrative among tech strategists about the Mag 7 and how it's become dead money, and how we're kind of seeing the new economy money flowing into other areas. Based on the flow of your funds that you've been tracking, is that fundamental shift in investor appetite? Is that what you're seeing?
Definitely seems to be the consensus. Now, can I quickly explain the concept of dead money for anyone who might not know that term? So, most recently, I was listening to George Noble's podcast in which he discussed that concept with Brian Shannon from Alpha Trends. Brian is a technical strategist, and he laid out that concept, I thought, very well, in which he described it as essentially a stock that is, let's just say, unlikely to generate meaningful returns for investors over the coming period. Now, it doesn't necessarily mean a crash. That's not what he was saying, but that its price action is essentially stagnant. A stock that trades, let's say, in a range for months. He used examples like NVIDIA and Microsoft. I don't think anyone would say that those are bad companies to own. They've been incredibly strong performers over the AI boom, Microsoft for even longer. But right now, as he noted, they've both been kind of stagnant price-wise. And the other part of the dead money concept involves how capital rotation is taking place, in which investors are rotating money out of these companies into other ones. On that episode, the consensus was definitely that things are shifting into areas like, say, utilities and energy, areas that might not make quite as many headlines or seem as exciting as these big tech stocks, but that experts see as having overall more growth potential.
Got you. And clearly a cyclical rotation is happening, right? As you see international picks up, we've seen a shift in the value, like these energy stocks, right? The new tech stocks, like, is that what people are trading on now? Another one, speaking of dead money, a good example, and I got to put my hand up on this one, is Oracle. We spoke about Oracle earlier this year. I still have the same thesis on Oracle, not making stock recommendations for anyone on the show. Oracle, I said, would be dead money. We were speaking for probably the first half of the year, but I expected to bounce back. But it's exactly what Samuel just described.
Exactly. I can confirm that markets did, in fact, make that prediction multiple times when we spoke.
Yeah, I probably shouldn't be saying that on air right now because it doesn't look like the greatest one. But it's what it is. It's what it is. Let's talk about trade policy and the kitchen table inflation. We had GDP come out today that was 1.4, expected to be 2.8. And I'm hearing people talk about GDP. They're trying to square the 1.4 versus 2.8 and maybe tie in seasonality. When it comes to those numbers, Main Street, just try to take a trek of 3 or 4 months and smooth those out. But then we also saw the PCE, which is the Fed's preferred gauge. I'll let you speak a little bit about that for measuring inflation, come in a little bit hot, 0.4 versus 0.3. So if you want to jump into that for Sam.
Absolutely. So I think you kind of just said it all. It was a little hotter than expected, and numbers being a little better than expected has kind of been the name of the game with economic data lately. When the January jobs report came out after a 5-day delay, things were definitely better than better than expected. And of course, when it happens, the immediate reaction is to say, "Oh, this is good. This seems like the economy is rebounding." And some say it is, some say that it isn't. I have 2 different economists who I've written about recently who I can compare who have taken different stances. Ed Yardini from Yardini Research predicts that we're not going to see any kind of recession because the economy, in his view, is just too resilient. The U.S. economy, I should say. he had talked about how he just thinks the resiliency is strong enough that we are going to see what he called another roaring 20s. And he didn't mention anything about how the original roaring 20s ended in a stock market crash. So that I'm not sure about. But he did mention that and touted the growth of the S&P 500, boosted mostly by AI stocks as a reason for his bullishness. Now, on the other hand, there's Mark Zandi of Moody's, who is someone who I've interviewed multiple times and who has been very good at showing the data when he has a prediction. And when the jobs report came out for January, he shared a chart that showed that yes, it's true. In January, the numbers were better than expected, but very late in the year in 2025, the job numbers were pretty bad. They were in the red. So yeah, it's easy to celebrate when report comes in a little above line in the green. Zandi also predicted that we would not be seeing too many months in 2026 with this kind of job growth. Right now, it seems that, as they always are, experts are mixed. Those with all the data seem to be erring on the more bearish side when it comes to overall economic rebound.
Got you. Yeah, Dr. Ardeen he is one of the most bullish people you're ever going to meet. And yeah, a good point that people seem to forget about is that the roaring 20s of old ended in the Great Depression. But a lot of things are so different now versus when that happened. I mean, you have the speed of information is what I see is like the greatest difference in between then and now. They were sitting there waiting for hours to find out what happened with those trades, and people were trying to panic sell. It's just so hard to be in the dark with this stuff right now, but it does move so fast.
Absolutely. There's a great book by Andrew Ross Sorkin that recently came out on the crash of 1929 that does a great job of highlighting exactly what you mentioned. One of my teammates at Business Insider, a Will Edwards, had a great piece on it and illustrated that extremely well, that these days when people talk about the stock market crash, because we're in the 20s again, it can be tempting to lean into mindset of, oh, it's going to happen again. But as you just said, it's definitely true that certain things are very different this time around. So it's really impossible to say.
People can have the information, but if you look back to historical crashes in the U.S., like 1907, that was, actually private individuals came in and saved the economy that time. They created the Federal Reserve, right? Because that will help us if we get into a situation like that. But 1929, when the market did crash, the Federal Reserve made the wrong move and tightened money. So they made money harder to get, raised rates when they should have loosened money. Hopefully these Fed people are learning from all of history. And then we have Kevin Warsh coming in. I mean, I know we got another topic to cover, but you hear about Kevin Warsh while we're digging into this Fed stuff, man. How is that affecting the markets? Because everything went down the day that he was announced.
Well, there are certainly concerns about Fed independence. Now, based on what I've seen, the general consensus among economic experts is that Warsh is a fair choice. Those are Mark Zandi's words to lead the Fed. And it doesn't seem that there's too much negative speculation about Warsh being chosen. I think partially because it wasn't that surprising when he was chosen. As I understand it, for a long time, Trump was between two guys named Kevin, and they weren't that different as far as Fed choice candidates goes. And of course, with all the tension between Trump and Powell that had happened over the past, I'd say past few months, but really it's more like most of the past year because just so many questions and so much just not really knowing what's going to happen with the Fed, which of course is supposed to be an institution that we can rely on to always know what's going to happen because that's why they're there to help provide these economic answers. And based on it does seem like the market's response to Warsh's appointment might have been a bit of a knee-jerk reaction, and that I remember some experts saying that when the dust settled, conditions would stabilize fairly quickly.
The last part you said again?
Based on my understanding, some economic experts had definitely said that once the initial shock of Warsh's appointment sort of wore off, market conditions would stabilize because ultimately he was seen as bullish for the stock. His appointment was seen as bullish for the stock market.
Whenever a new Fed chair comes in, the market always finds something. Something's always happening. I don't know if it's causation or correlation where that Fed chair is challenged. I don't think anyone, even on the finance committee, has a problem with Warsh. I think he was nominated unanimously last time. I think Chuck Schumer brought him to his nomination. So I don't think anyone has a problem with him. I think, and down here in North Carolina, Wall Street South, Tom Tillis is my senator. He has a problem with the process going on. We're not going to dig into all that right now. I want to dig into one last point on how Wall Street, everyone's still worried about AI. I was talking to Adam Parker earlier. That episode will come out later. And we just talked about, he gave me examples of how AI can disrupt his industry, specifically what he does. He does research at Trivariate for the institutional investors.
AI is disrupting essentially every industry. And it seems like the question's too big to sure. I mean, not too long after, Marcus, you and I actually discussed discussed the impact on stocks in the on brokerage companies like Schwab and Fidelity, because of course an altruist rolled out that update, and of course this came just after the software sell-off, and of course I remember stocks falling, but it wasn't anywhere near to the point that it was what was happened to software. Brokerage stocks bounced back fairly quickly, even after it became common knowledge that altruist had the little update that was, I should say, the plugin that kind of enhanced its capabilities for financial advisors. Ultimately, as far as AI disruption goes, it's difficult to really say overall, other than the fact that it seems poised to disrupt most industries. But I do have to give you credit for being correct when you told me that you didn't see the altruist news as having a long-term impact on brokerage stocks.
Well, thank you. And yeah, Sam and I, for those who don't know, me and Sam have done a lot of stuff together. Sam's a really great journalist or writer. I don't know. I need Sam to elaborate on that at some point, the difference. But we've done a lot of good collaborations, I don't think, throughout like this whole entire year, last year. But yeah, one of the things I saw is like altruist, and full disclosure, I use altruist as my custodian. Altruist uses Hazel, which is the AI tool, to enhance advisors so we can help our clients in that type of way. Boom. You heard it there. AI can't do that. I love it, Sam. That's good stuff. Like I said, I want to respect your time. Sam was only going to talk to me for like 10 minutes, I think, and I just kind of stole him, and he's such a wealth of information, man. I appreciate it, Sam. If people want to get in touch with you, or if they need anything from you, how could they reach out to you?
Well, the best way to reach me is on LinkedIn. But if you have a tip or a story you think I should hear about, I am reachable at SOBRIENT, last name, at insider.com.
Got you. And the LinkedIn was fine, the Business Insider, where if someone wanted to send something in, what would you say?
Yes. So I am reachable at SOBRIENT, first initial, last name, at insider.com. And I'm also on Signal. If you'd like to chat with me on there, message me. We can go from there. The only place you can find my work these days is on BI. Marcus, thank you for having me. It has been really great to chat, as always. Thank you all.
Whew. We spent the last hour in the war room, but now we pivot to the kitchen table with our friends over at Policy for Normal People. But before we talk domestic policy, remember, March and April are dropping this weekend. If you haven't subscribed to the Main Street Meets Wall Street podcast feed yet, this is your moment. Don't be 24 hours behind the economic fog. hit subscribe on the YouTube channel.
Hello, friends. Welcome back to Policy for Normal People. I'm your host, Christy Amata. I'm joined by special guest Marcus Sturdivant, Senior of the ABC Squared. We meet once monthly, although we've taken a little bit of a hiatus the last couple of months with the holidays and my absence for other reasons. But we're back into it here in 2026. And this is our special episode of Policy for Normal People that I like to affectionately call the monthly market update with Marcus. Marcus, how are you?
Hey, Christy, I'm doing great. Thanks for having me back on. So good time. Always good to see you. How are you?
Yeah, you too. I'm doing great. Got the new year started off strong enough, but I am anxious to get an update from you on market activity, what's going on with Chairman Powell. How are things going with that? Lots of new proposals too. Everything from credit card rates to the Trump baby fund and everything in between. Affordability is a big issue right now, whether that's housing or otherwise. So I thought I'd turn it over to you, let you give us some highlights of what you're seeing out there, what you've been talking about in other spaces. And then I've got a specific question I want to ask you later about the credit card rates, because that's probably the thing top of mind for me right now that I'm just curious about.
Perfect. Yeah. All right. Well, let's jump in. So yeah, as we sit here right now, recently we just had the Dow Jones hit 50K. That was a big mark for investors to see, but it came back down. The markets have been in turmoil, really volatile start this year. As far as stocks and trading goes, the things that were leading last year, so like tech and those industries are now lagging. We have industries like industrials and materials are starting to lead. People seem to be moving towards investment styles right now where they're trying to figure out what can't be disrupted by AI. It appears that everything is in a rolling cycle with what is being disrupted. We noticed a few weeks ago, we had the Claude incident. It was like 2 Fridays ago, actually. We had the Claude incident where he came out or announcement, I should say, where they came out and announced that they had an agent that could do a lot of the legal work, paralegal type work. So we saw companies like LegalZoom, a lot of the SaaS software as a service companies go down, CRM or Salesforce, Accenture, companies like that, where they have a seat-based model. So they're paying money per seat. This just seems to be a model that is going to eliminate some of those seats. Inside that, we saw a sell-off in that. Then, like earlier this week, we saw Altruist come out with a tax planning tool called Hazel. That shook up some of the fintech sector where we saw companies like Schwab start to go down. Robinhood has been going down in correlation with cryptocurrency as we've seen the swoosh from Bitcoin. I think when we started talking or back in around October, Bitcoin was like 120,000. It's pretty much half that since then, down to near 60,000.
That's a big dive.
A big dot splits in half, but Bitcoin is also something that rotates on cycles. So like every 4 years it halves. But so that was another scare to the fintech side of it. And then today we're seeing, what is it today? There's another disruptor today. It is the garbage industry, maybe? No, it's trucking. It's trucking. There's an AI disruptor coming in trucking that can help small companies use their freight services more with to compete more with large companies. Freight and supply chain, that stuff's so important. It's also something I study in schools. It's just right now we're seeing the AI disruptor. So inside the actual stock market, we're seeing the market rotating out of what we've seen the last few years and growing into a different kind of market with a different kind of economy. And that's not even talking about the policy and the inflation and the data that we have.
Yeah. What's going on? What do you the big companies like NVIDIA, Microsoft, and all of them who are, I guess, Amazon too, maybe, that are really investing heavily in data centers, which of course, is connected directly to, the demand from AI services or AI adjacent services. What are you seeing there? I've heard some things about that there may be a bit of saturation, that some of the smaller investors in it could suffer longer term because a lot of people have jumped into this and not everyone is going to benefit. What's your thought on that, or what are you seeing?
Right. So what we're seeing right now, as I mentioned just a few minutes ago with the software, you mentioned Microsoft and NVIDIA, though. So those are perfect examples. Microsoft seeing more of a software play. I know a big thing right now we're hearing is the K-shaped economy, but it's kind of K-shaped with the AI play as well right now. So you have the software companies like Microsoft, which are going down. NVIDIA, software companies, people who are making the chips, were continuing to go up. So that part of the tech sector was actually up a little bit this month or for the year, but where we saw the software part of it pulling it down as a whole. So it is separate and it's divided. One big thing, I know we spoke about it months ago.
In October, November.
It was local to where I live, down here in Wall Street South. That's Charlotte, Wall Street South, not my creation. They were looking at building a data center in a little local town, and the residents rejected it. Now we're starting to see that more, where people don't want data centers built near their homes.
Yeah, that's absolutely true. I see that in my home state of West Virginia. They're fighting it hard in the southern part of the state. And they're fighting it here in Northern Virginia, too. I mean, I think sometimes the residents are losing in this part of the country, or in this part of the state, rather. But yeah, there's definitely a pushback. And I don't think that we talk enough. This is my personal view on this. I don't think we talk enough about the consequences of data centers. We talk about money to be made. We talk about all the advantages. AI is revolutionary. I mean, I use it every day in my running my business, but at the same time, I don't think we talk enough about the impact on the ground with people. So that's interesting to hear. That kind of confirms, what I've been seeing and hearing as well.
Right. And then the impact on your wallets. These data centers consume a lot of energy. We just got the inflation report earlier today around 2.5%. But if you look at electricity inflation, it's like 6.7%. So there's so much inflation inside electricity. Then we just had these storms that came through. So the seasonality in that will increase your costs. The heating costs are going to increase, or energy costs are going to increase when we see these storms come through. Also, another reason why you see, as they construct these data centers, we're seeing investments going to companies that are used to build them. The picks and shovel type companies right now, people that are actually going to be involved in building the data centers. So you see a lot of that right now as a shift inside the AI by investments. And investments still happening. Mentioned capital expenditure earlier as well. People are worried about the level of capital expenditure that we're seeing out of these companies and whether it can be sustained. That's TBD. These are some of the largest companies in the world, some of the greatest companies in the history of the world. If you look at the history of just business and technology, some of the greatest free cash flow that we've seen, but they are now tearing into some of their free cash flow. I was in a call yesterday with an advisory board, and they mentioned how I think it was Microsoft is spending, no, it's Google. They're spending like 40% of their total revenue on capital expenditure, not their free cash flow, total revenue. So that's just a huge shift in AI investment.
Yeah, and I was going to ask about that. I mean, maybe you can help me understand a little bit better, because I read things that seem kind of confusing to me. I'm not an expert in this field or anything. When you see things like these companies that have massive, that they have massive amounts of funds, and of course, that's not all liquid funds as we know, but nonetheless, I mean, they're still taking out loans to invest in the AI boom. Why would they do that if they have, risky?
Right. Well, it depends on how you want to finance this debt, right? So Oracle, we spoke about Oracle before. That was the poster child for Oracle. They went out and financed a lot of their build out for these data centers via debt versus pledging some of their securities or selling some of their stocks. One reason could be that you fix the rate on that debt, 5, 10%, whatever the rate may be. Whereas if you have a stock, that stock could go up 10, 20, 30%. Who knows what that stock move could do? And then on the person who's taking that stock or whatever is collateral for that debt, they know that stock could also go down. So maybe they're not as secure as taking that stock as collateral for that investment. But yeah, generally when you finance things, businesses, when they build out, they do generally go out and finance debt. But the level of debt is the problem, and the return on investment. See, that's the thing. People have been hearing about AI. We really start hearing about AI like 23, 24, 25. People want to see where's the return on investment now, right? Where are these dollars coming back? People have been spending hundreds of billions of dollars to grow out this AI infrastructure. So they want to see where's the return on investment, the ROI, in these moves with data center.
Yeah, sure. I mean, you can only give so much leeway to the spending side, and then you want to start seeing some return on investment. And that would include the average investor too. I mean, I'm curious, how much has this phenomenon, this AI revolution and the investing that at the top going, how is that affecting, the average person's, say, retirement investments and things like that? How should the person on Main Street think about what that may or may not do, or does it impact really, at least yet, things like retirement funds and long-term savings?
It definitely impacts retirement funds, depending on your person's age. If you have a longer investment time and you own like individual positions in some of these great companies that are going down right now, this is a great opportunity to buy these companies at a great price and see the appreciation in years from now, right? But if you're a person who's about to retire next 6 months, hopefully you already repositioned your portfolio where you weren't in so many individual stocks anyway, but more towards, if you do have stocks, you're on the indexes. The market has been broadening out this year. So that's another thing that we've noticed with the market, right? The equal weight markets. The markets and the way the indexes work, some of them are like weight cap. So the bigger the stock, the bigger the percentage, like NVIDIA, the Mag 7 is a build out where that's like 30% of the S&P 500. Then there's also a thing called an equal weight market cap, where they just take the stocks and divide them all up and everyone gets an equal amount in the stock to where it equals out the industry. So in those type of positions, NVIDIA and companies like that don't have as much of a move. Those companies, if you have the equal weight portfolio or a stock index like that, they perform much better this year than those indexes that were skewed heavier towards the Mag 7 layout. So ideally, if you're going closer towards retirement, you're going into a more diversified portfolio that way anyway. You're going to have something that's more broad span. So when you see the moves and you see you don't get the volatility up, you don't get the volatility down. You're positioning yourself. You've already accumulated your money. Now you're getting into a position where you want to get into the distribution portion. So you shouldn't, if you're looking to retire, you're about to retire soon, you shouldn't be heavily investing in these things anyway. Play it via index if you have to have stocks. But if you have time, I mean, I'm saying more than 3 to 5 years, invest. But know that these markets can go down and they will go down. We're in the midterm election year. We have a new Fed chair coming in. We have geopolitical turmoil going on. We don't know where the data is with the inflation and jobless claims right now.
Yeah. And tariffs, I mean, there's still, a lot of those haven't taken their full impact, not even close yet. I think we'll see that, this year much more than last. Wouldn't you agree?
Yeah. Then with tariffs. So, and you have different reporting on tariffs. So we have one report coming out that says the American people are bearing the burden of the tariffs costs. Then we have inflation that comes out like today, and the places where you're looking, where you would expect to see the impacts of tariffs, is like these numbers are cooler, 2.4 versus 2.5. Where is it actually
question about gouging. I mean, that makes me question about price gouging too, because prices seem to go up immediately when we started talking about tariffs. But tariffs take a while to take effect. We talked about this in earlier episodes too. So that's kind of interesting that there's two sides of that story being told right now.
That's the country we live in. There's two sides to every story, right? It's good when we have this platform here where we don't
sometimes more than two.
Well, yeah.
3. Yeah, you're right. Yeah, that's part of that. That's actually why you and I do what we do, why we do this every month, And friends, just a reminder that the ABC Squared, Marcus, I love what he does. He tries to help Main Street meet Wall Street by providing financial literacy. And this podcast is just one example. I'm really grateful that he's willing to come on and help, my listeners and viewers with that. But I know that's a core part of your services at the ABC Squared, is it not?
Yeah. So financial literacy is a big thing for me. And, financial planning, financial advice. That's what we do at the ABC Squared. Yeah. Just kind of like what we were just speaking about, those type of things we help people out with, not just investments, but like if you have longer in the market, maybe you should be buying more right now if you can afford it. Affordability is a really big thing, big issue in America right now. I heard a stat that your dollar from 1997 to today has lost like a third of its value. So, right. So people are like, I'm staying safe in the dollar. I mean, think about it. Think about how much things cost in like 97. Think about how much a gallon of gas costs versus how much it costs now.
True.
Right.
Yeah, for sure. No, it's a real effect for sure. And and the dollar doesn't go as far.
It doesn't go as far. And